Hello future CAs, welcome to the most awaited CA Inter Income Tax Marathon for May and September 2025 exams. In these 8 hours, we run through the entire syllabus including the amendments that is there for your direct tax exams. Sir, what are you doing in income tax marathon, sir? Are you going to take this? Absolutely not, guys. But for you to understand the 8 hours, I'm just giving you an overview of all the free resources available from our side. Who's going to take this marathon? Of course, it's going to be CA Rahul Agarwal, sir. Just to give you a small introduction about sir, I mean the knowledge and experience he has is immense. I'm sure you all know there is a material called Taxman material. Many years back, Rahul Agarwal sir was the main author for Taxman direct tax book, guys. So remember where his experience comes from. Currently, he is working in direct tax. Many faculties, including myself, our practical exposure is very limited. But Rahul is the head of direct taxation in a listed company called Randstad, which has more than 60,000 employees. Last year in 2024, he was in Europe for 6 months, guys, not for going around Europe. He was heading the international taxation, working with the international taxation team for 6 months in direct tax department. So imagine the practical exposure he will be having, guys. And Rahul sir also has a color material with simple concepts. I will proudly say that this is one of the best color books I have seen. Even I don't have color books for my subjects, and I take inspiration only from Rahul sir's books for my concept books. Now, Rahul sir has 3 books, guys. The marathon of 6 to 7 hours will be based on the concept book. Color PDF is available for you for free, 190 pages. Let me show that, guys. This is the concept guide, guys. Just look at this. All the chapters are here, and when you just keep scrolling down, you can see it is simply in easy language. It's over there. There is a lot of animation also that will be there as part of this, guys. Like look at this: residential status, tax rates, all of that. Very simple book in just 190 pages. This PDF is also available for you guys. So the marathon will be based on this concept book. Sir, what is the additional resources we can expect from Rahul sir and the CA classroom team? We are also giving you soft copy of the question bank of 175 pages. This is the question bank, guys. Look at this. Again, it's a color question bank, latest for your syllabus, guys. Here you can see all the questions and answers over here. We will also be giving you remarks like section D, this is only for legends, and like this is for which person. So study material questions will be given, RTP, MTP questions will be given. This is roughly about 250 pages that is there, guys. Solution guide. I will tell you how to access this also. Okay, effectively 175 pages if you remove all the repeated questions. Then sir also has something called cheat sheet, guys. I'm telling all of this here because marathon will not address these things. Look at this cheat sheet. It is just a 14-page document, effectively 12-page if you remove the preface and the top. I think this is the secret of sir, but somehow we got this. For your total income computation, all the adjustments from all chapters, it will be covered over here. It is basically a format, guys. It is just a format of 14 pages covering all possible adjustments that is there in income tax in one place. We call this the income tax cheat sheet, guys. This also you will get access. Now, sir, where do I get access for all of this? All you have to go is go to the CA Classroom website, click on free resources, and then you go into direct tax, and you will have all the materials over here, guys. All the materials which you can download. Now, one last thing, sir, then what do we get in direct tax workout batch, sir? Regular batch is going to be 100-150 hours of full concepts. You don't have time for that because you are watching marathon. That is where the workout batch comes. Workout batch is just 35 hours in total, guys. Just 35 hours for direct tax. Sir, what can we expect in 35 hours of direct tax? Using the concept material which I just now showed, first Rahul sir will run through all the concepts, and sir has specifically prepared something called workout material, taking the top 30 comprehensive and difficult questions from the entire syllabus. This is the workout material, guys. Look at this, already solved workout material, 30, more than 30 questions actually. I'm just saying roughly 30. It's 30 pages actually, covering all the adjustments from the full syllabus. Our workout batch focuses on library of adjustments, taking all the unique adjustments. So 30 pages, close to 50 questions. Sir will be solving all the unique questions that you have in the syllabus, guys, and that will be the bonus that you get in the workout material. So if you love the marathon, if you want workout of these top 30 comprehensive sums, all you have to do is you just have to go to CA Classroom website, and when you scroll down, you need only tax. So look at direct tax, individual subscription, just 1500 rupees, guys, where you get entire package of 35 hours of comprehensive solving of questions. Because I believe at this point what you guys need is unique adjustments. So these 35 hours will be covering all unique adjustments. Sir, in this video what you can expect, the video that you are watching now is going to be a 6 hours latest marathon. I mean, we recorded yesterday and we are uploading today, guys. That's how latest it is. And in the link to this video in the description, we are also giving you amendments. All the amendments which is there is also available for May exams. This video is a separate 2 hours video of amendments. So all put together is 8 hours. This is the free resource we are giving you. So go enjoy the lectures of Rahul Agarwal sir. Of course it is a marathon. Marathon is meant to be fast so that when you know the syllabus, you can revise everything quickly, guys. That's about it. Enjoy the lectures. Whatever you know, you need, let us know in the comments, guys. Thank you.
Awesome. What we're going to start, people, is something called as your basics of income tax. Let's try to understand what happens in the chapter of the starting. This chapter basically comes and says when you're getting into income tax, people, the power to levy or collect taxes is given by the Constitution of India. Article number 265 comes and clarifies that there is a power to collect and levy taxes only by the government. If you want to bring a law in India, it is done by article number 246, which contributes into 3 lists: union list, state list, concurrent list. We are discussing about income tax, part of union list, but this income tax clarifies that we do not take into consideration income taxes from agricultural income. That is part of state list. So as part of our syllabus, people, agricultural income is exempt from taxes, but if you are computing taxes, you do something called partial integrations. That is what happens when it comes to basics of income tax. Yes or no? Yes. As you proceed forward, people, income tax will come and say there are 2 types of taxes. One is direct tax and indirect taxes. We are discussing about direct taxes, the tax which is levied on your incomes. These are directly charged on your incomes, cannot be shifted burdens to anyone else. Opposite of these are indirect taxes like GST. When it comes to your current year, people, since you are doing assessment year 2025-26, you are liable for Finance Act number 2024. Along with Finance number 2 Act 2024. You have 2 acts to read for your exam. It doesn't matter. You are reading assessment year 25-26. As you proceed, people, income tax will come and say if you want to create an act, there are some additional items to be created. One is called circulars and notifications. Circulars are something which clarifies items. Notifications are for you to inform something. Which of the two is binding on department? Both are binding on department. Even circulars are binding on department. Notification is also binding on department. Which is binding only on department? Circulars are binding only on department. Notifications are binding on both assessee and department. Yes or no? Yes. MCQ question number 1, people, what is binding? Then, people, when you move on forward, income tax will come and say if you want to define persons in India, persons are defined as individual, HUF, firm, companies, AOPs, BOIs, AJP, local authorities, AJPs and local authorities, where income tax says every person in India will be turned into someone called as assessees. If you are going to become an assessee, you should be a person liable to pay tax or liable to get a refund or liable to have a loss or liable to compute your income, not just for yourself but for any other person included, and at the same time you'll also be called an assessee if you are an assessee in default for TDS or TCS or advanced tax payments that is what the provisions come and clarify. Then people, if you move on forward, comes your income definition, where income tax says income means those incomes which we discuss in subsequent chapters. Yes, but income is clarified to mean any component. It can either be one time or it can be regular. It can either be revenue or capital. It can either be from your business or from your personal capacity. It doesn't matter. It can also be in cash or in kind. Some items of income will allow expenses. Some items of income will not allow expenses, like winnings, like online winnings, like unexplained income. These items are not eligible for any expenses. MCQ question number 2. What are the items where you will have revenue receipt or capital receipt? If you want to classify whether it is revenue or capital, income tax says tell me whether the income is more regular. If the income is more regular, it is revenue receipt. If it's one time, it is capital receipt. If it is done in business, it is revenue receipt. If it is done outside business, it is capital receipt. If it is helping generate revenue, it is capital receipt. If it is helping generate revenue, it is capital receipt. If that itself is generating revenue, it is revenue receipt. People machinery vechittu revenue generate panna, that is capital receipt. Adu item vittale you are getting money, that is revenue receipt. Yes or no? Yes. People, if that is something which is dependent on your career, if that is gone, that is capital receipt. If it is not going to affect your career, it is revenue receipt. Yes or no? Yes. Examples are as follows, people. I am going to buy an asset. Department comes and says, boss, if you are buying an asset and you get penalty on that asset because the asset is delayed, in that case the asset money which you are getting is capital receipt. Kaila kaas vandirukku for an asset, meaning that money is for capital receipt. Compensation receipt for termination of agency business being the only income source. People, if this is my only income source, this is capital receipt. Compensation receipt for one agency business out of various agencies held. People, multiple agencies I have, one alone gone. Career stop, not stop. Career has not stopped. This is revenue receipt. Compensation receipt for premature termination of employment. I am working as a salaried person. Company told they will throw me out. People, this is my bread and butter. Poichana. Capital receipt. Agreed, not agreed? Yes. Next. Compensation receipt for modification of business contracts. I have a contract with you on business. You are telling I don't want to work with you anymore. People, my bread and butter will go off. That is capital receipt. And finally, I am planning to give you a gift. Capital revenue. Hey, you are not going to get daily gifts from me. Am I going to give daily gifts to you? You are going to receive once in a while. This is capital receipt. Income tax says when you receive revenue receipts, that is always taxable. But if you receive capital receipt, it is only taxable if income tax permits it. For example, people, veetla fridge vechirken. I have a fridge at my home. I am selling the fridge. Revenue receipt, capital receipt. Capital gains chapter comes and says personal fridge is not an asset and therefore not taxable. Correct, not correct? Anna, I am running a fridge business and I am selling a fridge. This is revenue receipt. This item is taxable. This item is tax. Correct? No. Yes or no? Yes, that is what the provisions come and say when it comes to revenue or capital. MCQ number 2, mark important. Yes. Third, I am coming and telling you, what do you do in income tax? Income tax says you have to charge income tax on total income for the previous year in the assessment year using the tax rates. So take your total income, compute your income tax in the assessment year using data in previous year, where income tax comes and clarifies when it comes to previous year is for less than or equal to 12 months, but assessment year is always for 12 months. Assessment year is always for 12 months. Assessment year will never be for less than 12 months. You are writing previous year 24-25, assessment year 25-26. In your previous year 24-25, if you start a new business, your previous year will start from the date of starting the business. So if you start on 5th October, your previous year starts from 5th October to 31st March. Your assessment year starts from 1st April of 25 to 31st March 20. That is what the idea is. Clear, not clear? Yes, but income tax comes and clarifies some exceptional rules where assessment year and previous year become the same. Theory question number 1, last question of your exam. Theory question number 1, cases where previous year and assessment year will become the same. Cases are if you are a ship of a non-resident entering into India. Case number 2, individual is leaving India with no intention of coming back. Case number 3, AOP or BOI formed during a particular year, dissolved in the same year. Case number 4, person likely to discharge away his assets with an intention to avoid taxes. Case number 5, a business or profession is discontinued in the previous year. 5 cases where your previous year and assessment year will become the same. For those who remember my example, people, the story which we create in homes, what is the story? You are a person called Mr. Vijay Mallya. Going to start something called as an F1 race. F1 race. You're going to start something called as an F1 race. For doing F1 race, people, you wanted help. So you approached a person called Mr. Nirav Modi. And told we'll together form a F1 team. Let's buy an F1 team. Tomorrow what happened? You went and you played with the F1 game and you lost money. People are coming and asking for money. You decided you want to pay, not pay. Indian people. You decided you want to not pay. If you don't want to pay, people, you can't sit in India. You need to abscond, leave India. For doing that, people, you need to first do some things. Close F1, then sell your assets, close your Kingfisher, then leave India. So what are you deciding? Step number 1, close F1. Step number 2, sell assets. Step number 3, close Kingfisher. 3 steps done. All the activities over. You are now ready to leave India. But you can't leave India because you sold your flight. So you need to catch a ship. So you called some friend from outside. Friend from outside came, brought a ship, took you and left. Therefore, non-resident ship take and left. People, you are going to come back. No, individual leaving India, not coming back. What is F1, people? F1 is AOP, BOI. 2 people came together, no? So it is BOI, came together, created F1, shut down F1. AOP, BOI, created in the year, dissolved in the year. Second case, selling of your assets with an intention to avoid taxes. Step number 3, closing Kingfisher, which is your business or profession. So business or profession discontinued in the previous year. Case number 4, friend coming from outside, non-resident ship coming from outside, leaving India. Step number 5, you are leaving India, no intention of coming back. 5 cases for you, people. Theory question for your exam. You can make your own stories. This is my story. I am a typical Indian. I like people leaving India. Yes. So this is my story, how I want to portray it. You can figure your own story, but theory question for your exams. Clear with me? This is your chapter number 1, people, which talks about basics. 3 things to remember in this chapter: circulars and notifications, revenue or capital receipt, cases where PY and AY become same. The same. Clear enough? Yes. Moving on to chapter number 2, people. In my book, we are looking at what is called as tax rates. Income tax says when it comes to tax rates, you need to ask for 2 regimes. Regime number 1, alternate tax regime. Regime number 2, default tax regime. Section 115 B, A, C. Income tax comes and clarifies if you are under alternate tax regime and you are an individual, tell me what your age is. Tell me what your age is. If your age is below 60, if your age is below 60, income tax slab becomes 0 to 2.5 lakhs, 0, 2.5 lakhs to 5 lakhs, 5%, 5 lakhs to 10 lakhs, 20%. After 10 lakhs, it becomes 30%. If you tell me your age is above 60, I will ask you, tell me, are you resident or non-resident? If you are a non-resident, old slab of 2.5. But if you are a resident, age 60 and above, income tax slab becomes 0 to 3 lakhs, 0, 3 lakhs to 5 lakhs, 5%, 5 lakhs to 10 lakhs, 20%, after 10 lakhs, 30%. If you tell me you are above 80, I will again ask you, tell me, are you resident or non-resident? If you are a non-resident, move to first. If you are resident, 0 to 5 lakhs, 0, 5 lakhs to 10 lakhs, 20%, above 10 lakhs, 30%. That is what the rules are. But income tax also comes and clarifies 60 and 80 is checked as on 1st April of your assessment year. 60 or 80 is checked as on 1st April of your assessment year, meaning if your birth date falls on 1st April 1965, you are 60 years. If it falls on 1st April 1945, you are 80 years. You are 80 years. Anything before that, you are senior. You are senior. If it is 2nd April, people, you are 59 or 79, as the case may be. So keep that in mind. That is one circular for you to keep in mind. That is a circular for you to keep in mind. Yes. Then income tax comes and says, if you are a alternate tax regime person, tell me, are you poor or rich? Tell me, are you poor or rich? If you are having a total income up to 5 lakhs, up to, income tax says you will get something called rebate with the total income of 5 lakhs, tax at the rate of 12,500 or actual tax, whichever is lower. However, you will not get rebate on long-term capital gains under section 112A. Under long-term capital gains of section 112A. Please mark this as important. You cannot get 112A ke liye rebate. You do not get 112A ke liye rebate. If you are not a poor person, you may be rich, liable for surcharge. Surcharge applies if your total income is more than 50 lakhs. In that case, you get a surcharge of 10%. Above 50 lakhs, up to 1 crore, it is 10%. Above 1 crore to 2 crores, it is 15%. 2 crores to 5 crores, it is 25%. After 5 crores, it becomes 37%. That is what the surcharge rules are. But again, people, income tax comes and clarifies the surcharge rate of 25 and 37 will not apply for 4 incomes. Income number 1, short-term capital gains under 111A, long-term capital gains under 112A, long-term capital gains under 112, and dividend income. 4 incomes not liable for 25 and 37. Maximum surcharge on those 15%. At the same time, income tax says if because of these incomes your other incomes are going beyond 2 crores or beyond 5 crores, look at the other income on a standalone basis. And decide whether surcharge will apply or not apply. What does that mean, people? This is how the template will look like. Tell me what your total income is. If you tell me your total income is below 2 crores, people, will 25, 37 apply? No. In that case, look at your total income as such. In which case 0 to 50 lakhs, no surcharge. 50 lakhs to 1 crore, 10%. 1 crore to 2 crore, 15%. If you tell me my total income is more than 2 crores, income tax will say split into that 4 incomes and other incomes. 4 incomes and other incomes. For 4 incomes, surcharge becomes 15%. For other incomes, check standalone. If the standalone is between 0 to 2 crores, surcharge is 15%. 2 crores to 5 crores, 25%. Above 5 crores, 37%. That is what will happen, people. Let's take an example. Let's see if you understand this carefully. I am telling you that I am giving you incomes. You need to tell me what is the surcharge. Look at 3 things carefully, people. I have specified income, other income, total income. A specified means 1 1A, 1 1 and very good. This is what the 4 cases are. You are going to tell me what surcharge will apply, people. Case number 1, it says my normal income is 15 lakhs. sorry, my special income is 15 lakhs, my normal income is 25 lakhs, my total income is 40 lakhs. People, total income is more than 2 crores, less than 2 crores. Therefore, you will split that together. Check together. If you are checking together, together is 40 lakhs below. Therefore, surcharge becomes for, very good, for both. Case number 2, people, my normal income is 75 lakhs, my special income is 15 lakhs, my total income is 90 lakhs. People, total income is 90 lakhs. I will check together. If I am checking together, this is 50 lakhs to 1 crore. Surcharge becomes 10% for, 10% for both. You are checking together, no? If you are checking together, it is 10% for both. It is 10% for both. Agreed? No. Yes. Case number 3, people. 15, 170, 1 crore 70 lakhs in special, in other incomes, 15 lakhs in normal income. Total becomes 1 crore 85 lakhs. More than 2 crores, less than 2 crores. Therefore, combine and check. People, combine and check. 1 crore to 2 crore. Surcharge becomes 15% for both. Therefore, left also 15, right also 15. Case number D, people. I have 15 lakhs and I have 3 crore 95 lakhs. Total becomes 4 crore 10 lakhs. People, total income is more than. Therefore, split and check. Split panna, special will become 15. Others will check on standalone. Standalone is 3 crore 95. More than 2 crores. Less than 5 crores. Therefore, very good. Case number E, I am 15 plus 565, total becomes 580, 5 crore 80 lakhs, more than 2 crores. Therefore, split panna, 15 becomes 5 crore 80 becomes super. F case, 60 plus 30 becomes 90. I will check together. Together is 50 lakhs to 1 crore. This becomes 10 for both. 10 for both. Then I have G. G is saying 60 plus 125. Total becomes 185. 185 is less than 2 crores. Therefore, combine panna. 15 for, very good, 15 for both. Then I have H. H says 60 and 350. Total becomes 410. 410 is more than 2 crores. I will split panna. 60 becomes 350 becomes, very good. I becomes 60 and 520. Total becomes 580. 580 is 5 crore 80 lakhs. I will split panna. 60 becomes 520 becomes 37%. I am in J. J says 130 plus 55. Total becomes 185. 185 is less than 2. Therefore, together panna it is 15 for special, 15 for normal. I am in K column. K column says 130 plus 280. Total becomes 410. 410 is more than 2 crores. Therefore, this is split panna. 130 becomes 280 becomes 280 becomes. People, notice this is 25. This is 25. Check for the next one. It is 130 plus 450. Total is 580. Total panipata 37 vardu. But I am not looking at that because I am splitting. Split panna 130 becomes 450 becomes 25. Very good. It becomes 25 because I am not checking the total. I am checking separately. I am checking. Correct? No. Yes. Next, people. I am at 220 plus 190. Total becomes 410. Special is 220. Surcharge rate becomes 15 on this. Look at 190. 190 is between 1 crore to 2 crore. Surcharge becomes 15 on this also. Surcharge becomes 15 on this also. Then I have 220 plus 360. Total becomes 580. I will split panna. 220 becomes 580 becomes, sorry, 360 becomes. Sweet. Last one, people, the most important one. I am looking at 525 plus 25, 55, totally becoming 580. Total is 580. I will split panna. 525 is 55 is 15%. 55 is 15%. People, the moment income goes beyond 2 crores, minimum surcharge is 15%. You cannot come down to 10%. You cannot come down to 0 because total income is more than, if you remember, I told you total income more than 2 crores, minimum surcharge 15. So therefore, if you come here, it says where the total income is more than 2 crores, for all other incomes up to 2 crores, it is 15%. Up to 2 crores. Now 0 indalo 15, 2 crores indalo 15. It is only after 2 crores that it changes. Very, very important from exam perspective to keep this in mind. Yes, which means people, the moment an income goes beyond 2 crores, minimum 15 will apply. You can only decide to go 25 and 37 provided individually other income is more than 2 crores. Individually other income is more than 2 crores. If other income is less than 2 crores, minimum surcharge is 15%. Minimum surcharge is 15%. Clear with me? Are we good to go? Yes. If you are done with alternate tax regime, people, then comes in something called default tax regime, amendment of current year. Default tax regime comes and says no matter who you are, for the first 3 lakhs, 0, 3 lakhs to 7 lakhs is 5%, 7 lakhs to 10 lakhs is 10%, 10 lakhs to 12 lakhs is 15%, 12 lakhs to 15 lakhs is 20%, and then all items above 15 lakhs is 30%. That is DTR, that is default tax regime. Again in DTR, people, income tax comes and says if you are following DTR, you may again be liable for rebate or surcharge. Income tax says under DTR, rebate is applicable if your total income is up to 7 lakhs, where you get a rebate of 25,000, where you get a rebate of 25,000, or actual tax payable, whichever is lower. If you are liable for surcharge, income tax says surcharge will apply above 50 lakhs. 50 lakhs to 1 crore becomes 10%. 1 crore to 2 crores becomes 15%. Above 2 crores, everything is 25%. You don't have 37%. That is what the rules are. Yes. At the same time, people, income tax comes and says if your income is a little bit more than the surcharge slab, you are eligible for marginal relief under both the regimes. Whereas if your income is little bit more than 7 lakhs, you are eligible for marginal rebate. Only under default tax regime. You do not get marginal rebate under alternate tax regime. That is what marginal relief looks like, and marginal rebate. Then comes in your other categories of people, where income tax is saying if you are a firm, you are liable for a tax rate of 30% with a surcharge of 12% with an income more than 1 crore. If you are cooperative society, for the first 10,000 you are doing 10%, balance 10,000 you are doing 20%, anything more than that you are doing 30%, where the surcharges will remain same as domestic company. Domestic company tax rates, income tax says if you are going to be a domestic company with a previous year turnover less than or equal to 400 crores in previous year 22-23, you will get a tax rate of 25%. If it is not this case, then you get a tax rate of 30%. But if you are a foreign company, current year's amendment, you get a tax rate of 35%. Please mark this one as important. You are expecting question on this year. Yes, foreign companies current year tax rate is 35%. Tax rates ke apron, their surcharge rules are as follows, where income tax says if you are a domestic company, surcharge rates will be 0, 7 and 12. If you are a foreign company, it is 0, 2 and 5 depending on your incomes. For the first 1 crore, no surcharge. 1 crore to 10 crores, it is 7 or 2. After 10 crores, it is 12 or 5. That is what the tax rates are. And then people, after you do all those things, you will have to do a health and education cess at the rate of 4% on the final number. Once you do all this, people, 2 things to be kept in mind. Golden rule number 1, all total incomes to be rounded off to the nearest 10. All tax liability to be rounded off to the nearest 10. Both these things carry half of mark each. To be mandatory quoted in exam. After you do all those things, people, you will then arrive at your special tax rates, where income tax says if these items are given to you, then you do separate taxes. First item is current year's amendment of capital gains, where income tax says if you are doing capital gains in the current year, tell me what kind of capital gains do you have. Do you have 112A? 112A means long term capital gains from listed items. Income tax says tell me whether it is transferred before 23rd July or on or after 23rd July. If it is transferred before 23rd July, income tax says tax rate will be 10%. If it is on or after 23rd July, income tax says tax rate is 12.5%, but the 12.5% will apply only after an income more than 1.25 lakhs, will apply only after an income more than 1.25 lakhs. People notice 1.25 lakhs is for both, meaning no matter what you have, whether it is 10% or 12.5, you will consolidate both. First remove 1.25 and then give the balance tax, How to decide, where to decide, we'll do in practice questions. Second, if you are doing LTCG under 112, income tax is before 23rd July it is 20%, after 23rd July it is 12.5%. If you are doing 111A, then it is 15% before 23rd July and 20% after 23rd July. That is what the tax rates are. Yes or no? Yes. Then if you are going to do casual incomes, lottery incomes and all those things, income tax says tax rate is 30% without allowing any expenses. And finally, if you have any kind of online games, you are liable for a tax of 30%. Formula is closing balance at the end of the previous year plus amount withdrawn during the year minus non-taxable deposits made minus opening balances. So whatever is your closing balance, add whatever amounts you have taken out, remove whatever amounts you had in the opening balance, and remove whatever amounts you have extra put in. You will get the taxable income tax at the rate of 30%. Yes or no? Yes. Here income tax says for all these special incomes, people, some rules to follow. Rule number 1, when it comes to these incomes, slab will not apply. These are the standard tax rates. Whether you are going for DTR or ATR, it doesn't matter. Question number 2, will you give rebate on all these incomes? Yes, rebate is eligible on all these incomes except 112A. People, can lottery claim rebate? Yes. Can online winnings claim rebate? Yes. All those can claim rebate except for 112A. Is all these items liable for surcharge? Yes, they are liable for surcharge, whereas capital gains maximum surcharge 15%, all other incomes maximum surcharge 37%. Yes or no? Yes. Point number 4, can you claim expenses? Capital gains? Yes. Other incomes? No expenses. Can you set off losses? Capital gains? Yes. Other incomes? No, can't set off losses. Can you claim chapter 6A? Capital gains? No. People, important thing to be note from exam perspective, capital gains is not eligible for chapter 6A deductions. Don't claim chapter 6A on capital gains. Can you claim chapter 6A on other incomes? No, nothing you can claim chapter 6A on. Yes, which means technically all items eligible for capital gains except for chapter 6A. Then comes the question, if I have not used my basic exemption limit, can I use capital gains for it? Yes, provided you are residents. Can I use other incomes for it? No, you can't use it. Very famously, I call this Kaju Katli example, people. What does Kaju Katli mean? When something comes to your home as a gift, first item will be used by the guest. If guest is not able to use, you will eat. If you are also not able to eat, parents will never touch. Kaju Katli is your basic exemption limit. Will be first used by slab rate incomes. Slab rate is not able to use. Capital gains will use. Capital gains is also not able to use. No one will use. That is what Kaju Katli example looks like. Yes. So basically, when you have a question, check for your basic exemption limit. If the slab uses it, super. Slab is not using it, give it to capital gains. Capital gains also not using it, let it go. No one can use it. Very, very important from MCQ perspective. Every attempt, one question will come on this. Mark this as important. You need to know this from exam perspective. Yes, this is your tax rates. Any doubts on tax rates? No. From an exam perspective, people, how do you approach a total income and a tax rate question? Step number 1, find out your total income. Step number 2, round off to the nearest 10 rupees. Step number 3, check whether you are eligible for rebate or liable for surcharge. Step number 4, split all your incomes into special income and normal income. Step number 5, compute tax. Answer will come. Answer will come. That is how you need to do your tax rates, people. Yes, yes, this is your tax rates, people. Any doubts on the tax rates? Any doubts on the tax rates? Good enough to go. Yes, this is your summary on your basics and rates of taxes. Starting with the revision of chapter number 2, people, we are looking at what is called as your residential status and scope of total income. Yes, fairly very easy chapter. It takes hardly 5 minutes to complete the chapter off. The chapter in very simple terms comes and says two things are to be determined. One, what is your residential status? Second, depending on your residential status, what is your taxable incomes? What is your taxable incomes? Yes, that is what this chapter is going to talk about. First thing and the most critical thing from exam perspective, residential status of an individual. Income tax comes and clarifies when an individual has to be determined as a resident, three things will be checked. Either he is an ROR, resident and ordinarily resident, or NOR, resident but not ordinarily resident, and NR, non-resident. Three things will be done. Three things will be done. To ignoring the whole thing, people, we can quickly look at one chart and the chart will tell you what to do with this. The chart will tell you what to do with this. Very simple words. We are going to first look at the basic condition. The first and the most primary basic condition, people, to check whether you are staying in India for 182 days. If you satisfy the condition of 182 days, I will move you to the right side. I will move you to the right side because the moment you satisfy 182, you are automatically a resident. You are automatically a resident. If you don't satisfy the 182 days, I will ask you to move to the left side. Now the left side will come and tell me other categories of people. Category number 1. If you are an Indian citizen, leaving India for employment, or you are an Indian citizen who is a crew member leaving India in a ship, income tax is come and clarified. There is no second condition itself. Because you did not satisfy 182, there is no second condition. You are automatically non-resident. You are automatically a non-resident. If you tell me, no, Rahul, I am an Indian citizen or a person of Indian origin who is outside India, visiting India, visiting India, I will ask you a question. Tell me what is your Indian income. If you tell me your Indian income is less than 15 lakhs, income tax again says there is no second condition. Because you did not satisfy first condition, you are automatically non-resident. If you say no, my Indian income is more than 15 lakhs, then in that case income tax will say, tell me what is your current year stay. If you tell me that the current year stay is more than 120 days and last 4 years stay is more than 365 days, I will term you as a resident. But because you are satisfying this condition, you will be deemed as a RNOR, resident but not ordinarily resident. If you tell me, Rahul, I have an Indian income more than 15 lakhs but I am not satisfying this condition, income tax will say first condition also did not satisfy, second condition also did not satisfy, you are a non-resident. You are a non-resident. If you don't fall in any of these two, then income tax will say the basic condition is to check for 60 days in the previous year and 365 in the last 4 years. If you satisfy that condition, you become a resident. Don't satisfy the condition, you are non-resident. You are non-resident. Yes. Now, people who satisfy the 60 plus 365 or automatically satisfy the 182 are termed as a resident. Should be classified into R and OR provided they have been in India for less than 730 days in the last 7 years, or they have been non-residents in at least 9 out of 10 years. They have been non-resident in at least 9 out of 10 years. You satisfy the condition, you are R and OR. You don't satisfy both the conditions, you are ROR. You are ROR. This is a very simple bird's eye master chart on how you need to determine whether you are a resident or a non-resident. If you are a resident, whether you are ROR or RNOR. In all these things, people, income tax is said at any point of time, if you are a non-resident, but I find out you are an Indian citizen having Indian income more than 15 lakhs but is not liable to tax anywhere, whether in India or outside India, I will automatically call you as deemed resident and make you RNOR. That is what the rule says. Agreed, not agreed? Yes. In this, people, income tax has two additional conditions. Condition number 1, your date of departure and date of arrival are both assumed as stay in India. Unless you are a crew member. If you are a crew member, the date on which the ship leaves and the date on which the ship arrives are both assumed outside India. are both assumed outside India. So income tax says if you are a crew member, the date on which you board the ship and the date on which you sign off from the ship are both assumed to be outside India, and that will be taken as differential. Yes, which means if you are not a crew member, the date of departure, date of arrival is India. If you are a crew member, date of departure, date of arrival is outside India. That 2 days will make a difference. That 2 days will make a difference. How do you become a person of Indian origin, people? Income tax says you will become a person of Indian origin if either you, your parents or your grandparents are born in undivided India, meaning India, Pakistan, Nepal, Bangladesh, Bhutan, Myanmar, Sri Lanka included. All these states, if you have, all these countries, if you have been born, you will be called as a person of Indian origin. One critical thing to be kept in mind, people, when it comes to deemed resident, you will only be called a deemed resident if you are an Indian citizen. If you are a person of Indian origin, will that provision apply? No. Notice very carefully, here it says only Indian citizen. If there is a person of Indian origin, that condition will not apply. You don't check for deemed residency concept when it comes to person of Indian origin. Be very mindful on this. Same logic, people. If you are a person who's leaving India for employment, you are only considered for condition number 2 when you are an Indian citizen. If you are a person of Indian origin, that condition is not there for you as well. You will automatically fall in either the second one or go to the basic condition of 60 plus 365. Is this clear? This is your RS on an individual. Clear till here? Yes. Then we're moving on forward, people, to the other category of people. The other category of people like HUF, income tax says you will be called as an RS in India, a resident in India, provided your control and management is situated in India wholly or partly. Meaning, if it is wholly outside India, then you are a non-resident. Part also in India, it becomes a resident. But when it comes to HUF, income tax says you also need to classify them into ROR and RNOR depending on the status of Karta. Meaning, if Karta is ROR, HUF is ROR. If Karta is RNOR, HUF is also RNOR. But if Karta is NR, still HUF can be ROR or RNOR depending on Karta's previous year data. We'll do some examples, you'll understand this better. Yes. Cases like this, people. Imagine a case where I'm coming and saying HUF is in foreign, which means HUF becomes NR. Look at Karta current year stays 200 days. Karta current year becomes 200 means Karta is a resident. Karta's last 7 years, every year is 185, meaning Karta is every year resident, which means Karta is ROR. Very good. So which means in this case, HUF has become NR, Karta has become ROR. Case number 2, HUF is showing foreign, Karta is showing 200, but last 7 years is 100. HUF is foreign, which means HUF is NR. Karta is showing 200, so Karta is R. But last 7 years he was only 100 days, which means last 7 years he became 700 days. I want 730. This is 700, so Karta is RNOR. So here is HUF being NR, but Karta being RNOR. Case number 3, again HUF is foreign, Karta is 59. People, HUF is foreign, so HUF becomes NR. Karta is 59. Basic condition at least needs 60. 59 means NR. So Karta is also NR, HUF is also NR. Look at case number 5. Case number 5 says HUF is India. The moment HUF is India, HUF becomes R. Karta is showing 200 days, so Karta is also R. Karta is showing 185 days in last 7 years, so Karta is ROR. Because Karta is ROR, HUF becomes ROR. Second case, HUF is showing India, Karta is showing 200 and 100. HUF showing 200 means, HUF showing India means R. Karta showing 200 means R. Karta showing 100 means R. NOR, because last 7 years less than 730. Because Karta is RNOR, HUF becomes RNOR. Come to third scenario. Karta is showing 59, which means Karta is NR, but HUF is showing India, so HUF is R. Now comes a problem, because Karta is NR. If Karta is NR, you don't make him into ROR and RNOR. For the limited purpose of finding HUF, you will assume Karta is R. If Karta is R, last 7 years says 185, meaning Karta would have been ROR. Because karta would have been ROR, HUF becomes ROR. HUF becomes ROR, but in reality, karta is NR. For the purpose of exam, karta is NR, which means now answer is HUF is ROR, karta is NR. Karta is NR. Same logic, people. Last case, HUF is showing India, so HUF is R. Karta is showing 200, so karta becomes, sorry, HUF is karta is showing 59, so karta is NR. Karta is NR, HUF is R, HUF has to change, so karta will be assumed as R. If karta is assumed as R, last 7 years is showing 100 days, karta would have been, HUF automatically becomes, which means answer is karta is NR, HUF is R N O R. R N O R. This is how it operates, people. This is how it operates. Any doubts on this? Are we clear? Yes. On the similar lines, people, if you are other categories of people like firm, AOP, BOI and all those people, income tax says you will be called as an R or NR depending on control and management. If your control and management is wholly or partly in India, you are R. If not, you are NR. People from firms, there is no split between ROR and RNOR. That is only for individual and HUF. That is only for individual and HUF. Then you move on to someone called as companies, where income tax says if you are a company, which is registered in India, meaning you are an Indian company, in that case you are resident. If you are not registered in India as an Indian company, then tell me what is your poem. Tell me what is your poem. Place of effective management. If your place of effective management is in India, then you are resident. If not, you are non-resident. If not, you are non-resident. That is how residential status works. That is how residential status works. Any doubts till here? Are we clear? Yes, this is your first half of the chapter, people. What is RS? What is RS? Depending on your RS, now comes your scope of total income, where income tax says, depending on your RS, let's find out what your scope of total income is, where income tax said 3 categories of people, NR, ROR, RNOR. If you are an NR, 4 incomes are taxable. Income received in India, income deemed to receive in India, income accruing or arising in India, income deemed to accrue or arise in India. If you are an RNOR, 4 income plus 1 income is taxable. Income accruing and arising outside India from a business controlled from India, profession set up in India, If you are an ROR, everything is taxable. Global income becomes taxable. But please bear in mind, what is taxable is income. What is not taxable is receipts. What is not taxable is receipts, meaning if I receive the money outside India and I summa do a bank transfer to India, is it taxable? No, that is not taxable. That is not taxable. Agreed, not agreed? Yes. Think about this, people. I am coming and telling you income is received in India. For RNOR, taxable, not taxable? Taxable. For NR, taxable. For ROR, income deemed to receive in India, ROR, taxable. RNOR, NR, taxable. Income accruing or rising in India, ROR, taxable. RNOR, taxable. NR, taxable. Income deemed to accrue or rise in India, ROR, taxable. RNOR, taxable. NR, taxable. Income accruing or arising outside India from a business controlled or profession set up in India, NR, not taxable. RNOR, taxable. ROR, taxable. It is from a business controlled or profession set up outside India, NR, not RNOR, not taxable. ROR, taxable. If it is income from other heads arising outside India, RNOR, not taxable. NR, not taxable. ROR, not taxable. Correct? Taxable. ROR is taxable. ROR is taxable. Global income becomes taxable. Last one, income earned and received outside India, later on brought to India. Later on brought to India. NR, not taxable. RNOR, ROR, not taxable. Even for ROR, people, this is not an income. This is receipts or remittance. This is income of receipts or remittances. Receipts and remittances are not taxable even for ROR. Even for ROR. Yes or no? Yes or no? Yes. Then people, what do you mean by income deemed to accrue or rise in India? Income taxes, if you want to find out income deemed to accrue or rise in India, depending on your heads of income. Depending on your heads of income. First head of income is salaries. Income taxes, when it comes to salaries, if you are having an income arising for services rendered outside India, if you are having income for services rendered in India, even for a person situated outside India, income is taxable in India. Income is taxable in India, meaning if you are coming down to India and providing services in India, income is taxable in India. If you are not a person like that, then you should be a government employee. You should be a government employee working outside India. Basically, embassy people. So income tax says if the salary is paid by the government of India to a person situated outside India who is an Indian citizen, then it is taxable in India. However, special exemption says you are exempted for all your allowances and perquisites. Please mark that purple box important. That is important for exam purposes. Your allowances and perquisites become exempt if you are receiving money from government for services rendered outside India. After salary comes HP. Income tax says if the house is located in India, income is taxable in India. Then comes PGBP. Income tax says when it comes to PGBP, all business connection items are taxable in India. However, 5 exceptions to the rule. These 5 exceptions, even if they have a business connection, will not be taxable in India. Item number 1, all items which are not attributable to operations carried on outside India. If the operations are not carried out in India, it is not taxable in India. Second, any kind of purchase of goods in India for the purpose of exports. I will buy goods in India but then export it outside. In that case, this income is not taxable in India. Third, any kind of collection of news or views for transmission outside India. I am collecting data from here and transmitting outside India. Income tax not applicable. Point number 4, any kind of shooting of cinematographic films. By a non-resident. All people are outside India, coming to India, just shooting films and going. Income tax is not taxable. And 5th item, if you are displaying uncut and unassorted diamonds. As a foreign company, then also it is not taxable in India. Notice carefully, the words used is display, does not use the word sale, which means if you sell in India, it is taxable. Only display is exempted. Yes or no? Yes. Item number 4, capital gains. Income tax says if the asset is situated in India, income is taxable in India. If the asset is situated in India, then the income is also taxable in India. Leaving you with the last item, which is IFOS. Income tax says if you receive any dividend company by an Indian company, if you receive dividend from a Indian company, it is taxable in India. Whether you are situated in India or outside India, it doesn't matter. Company is in India, dividend from Indian company is taxable in India. Next, any kind of gifts which you are receiving, will become taxable in India if the money is received from India. To a person outside India. Any person outside India receiving money as a gift in India, it is fully taxable in India. Please note, this is subject to IFOS. Meaning if the number is less than 50,000, will you tax? No, you will not tax if the number is less than 50,000. You will only tax if the number is more than 50,000. Yes or no? Yes. That leaves me with the last 3 people, the critical items, your interest, royalty, FTS. For interest, royalty and FTS, income tax says, tell me where are you getting the money from? If you are getting the money from government, it is fully taxable in India. If you are getting the money from government, it is fully taxable in India. If you are getting the money from a resident, people who's getting money, non-resident is getting money from a resident. Hey, if resident is paying you money, he's paying you for doing services in India or outside India? In India. Income tax says if the money is received from a resident, non-resident will be taxable in India because it is assumed that resident will use the service in India. If you confirm that the resident is using the service outside India, then it is not taxable. So if you notice, people, it says for a resident it is always taxable except where the money borrowed, technical service used, or the royalties utilized for business or profession or for any other reason outside India. So if it is only for other reasons outside India, then it is exempt. If it is for India, it is taxable. But if you are receiving this money from a non-resident, meaning non-resident is receiving money from non-resident, India it will be not taxable. But if the non-resident confirms that is using this item for India, then it is taxable. Then it is taxable with only one exception. With only one exception. The exception is in interest. Income tax says interest will be taxable only when the non-resident uses it for business in India. If he is using it for any other reasons, it is not taxable. If he is using it for any other reason, it is not taxable. He should use it only for business. If it is royalty and FTS, whether you use it for business or for any other reason, it is taxable in India. It is taxable in India. So I am repeating myself once again, people. If a non-resident pays money to non-resident, it is normally not taxable, but it will become taxable if non-resident is using it for India, only in case of interest for business and in case of royalty and FTS for any reasons. Royalty and FTS for any reasons. But if a resident is paying money to a non-resident, it is always taxable in India unless the resident is using it for services outside India. Unless the resident is using it for services outside India. That is what the logic is. That is what the logic is. Any doubts on the logics? Are we clear on this? Yes, this is your chapter on residential status and scope of total income. Clear? Everyone, good to go. We're looking at what is called as agriculture income. We're looking at something called as agriculture income. Normally the chapter which I like to avoid for exams, but Jan 25 was a lesson for me. Jan 25 was a lesson for me. When suddenly mulberry leaves and all start coming in, you start worrying about things. Yes, so we're focusing on residentials. We are focusing on agricultural income as a part of topics as well. Although yes, honestly speaking, since it's come in Jan, expectations on May is close to zero. Close to zero, it will not come, but nevertheless, let's be safer on what we're doing. Yes, we're looking at a very easy chapter, people, which is called as agricultural income, where income tax is basically coming and saying generally agricultural income is not taxable under income tax. State is going to collect taxes, and therefore I need to decide what is agricultural income. I need to decide what is agricultural income. Income tax comes and says agricultural income is basically all that income which you generate from a rural agricultural land. All incomes which you generate from a rural agricultural land in the nature of agriculture is called agricultural income. All those incomes can be of any types, people. Imagine you have a building on that rural agricultural land and you're giving this building for rent. Will it be agricultural income? Yes. Imagine if you have a land itself of rural agriculture and you sell it to someone and you get capital gains. Is it agricultural income? Yes. If you do some activity of, let's say, sowing seeds, making some crops, cutting the crops and selling it off, is it agricultural income? Yes. If you decide to open a nursery and in that nursery you decide to grow seedlings and saplings, is that agricultural income? Yes. All those are agricultural incomes. What is not agricultural income then? If I grow crops, cut the crops and start using it in my factory, after factory usage, whatever final goods comes is not agricultural income. On that same land, if I am doing dairy farming, if I am cutting poultry and all those things are not agricultural income. Those things will not be taken into consideration. And items where I don't put efforts, meaning on the land randomly one crop is growing, I just cut the crop and sell it off without doing anything on it. Is that agriculture? No, those are also not agricultural incomes. Yes, so in simple words, people, agricultural income is all activities which is done on a rural agricultural land and is sold in the market as if it is an agricultural produce. As if it is an agricultural produce, those items are called as agricultural income. What do you mean by a rural agricultural land, people? Income tax says rural agricultural land are those land which are not urban agricultural land, How do you become a urban agricultural land? Income tax says tell me where the land is. If the land is situated in the municipality, then population size should be more than 10,000. Population size should be more than 10,000. If the population is more than 10,000, it is urban agricultural land. If the land is situated within 2 kilometers, the population remains at 10,000. If the land is situated between 2 kilometers to 6 kilometers, income tax says the municipality population should be 1 lakh. If the population is more than 1 lakh, it is urban, less than 1 lakh, it is rural. And if you are going to a point where the land is between 6 to 8 kilometers, income tax will say it should be 10 lakhs, more than 10 lakhs urban, less than 10 lakhs rural. If a land is situated above 8 kilometers, it is always rural. If it is after 8 kilometers, it is always rural, you don't check for urban itself. You don't check for urban itself. That is how a land is decided whether it is rural or urban. Rural or urban. Is that clear? Yes. So that is what the first part will come and say, people. What is agricultural income? Any rent or revenue received from a land situated in eligible lands of India. Any kind of income which is derived from agriculture. Any kind of process which is done, which is ordinarily required to sell the produce in the market. Any kind of income derived from dwelling houses or any rent received from a building which is situated in the premises. All those incomes are exempt in India, provided the land is situated in India. The land is situated in India. Any agricultural income coming from outside India is fully taxable. Eligible land means all those lands which are treated as rural agricultural land. Treated as rural agricultural land. Agreed? Not agreed? Yes. But imagine a case, people, where I'm coming and telling you that I have a crop which I'm growing. I'm cutting the crop and then I'm putting it in my factory. And then factory is making a final product. I told you the moment the factory makes the final product, it is called business income. But initially also I cut some crops, and therefore to that extent it was agricultural income. These items are called as composite incomes. Income tax says when you have composite incomes, meaning an activity has both agriculture and business. Do nothing. Stand on the land and tell me what activities you did on the land. Stand in the factory and tell me whatever activities you did in the factory. People, in the land, what and all I did? I grow the crops, I cut the crops, and I sell it to my factory. So what and all expenses I incurred in my land? Cost of cultivation. Come to my factory. What and all did I do my factory? I took the raw materials, made further processing cost, and then sold from the factory. What and all activities happen in factory? Processing cost, selling of produce. What is missing? Crops are being sold from land to factory. Income tax says what is the price at which I sell here will be the cost at which factory will take. In simple words, tell me what is the fair market value of the crops which are being sold from land to factory. That fair market value will become the sale price of the crops and the cost price of the factory. Keeping that sale price, find the agriculture income. Keeping the cost price, find the business income. Split over. In simple words, people, income tax says for your PGBP, tell me what is the sale value of the final product. Reduce the market value of the product which you got from factory and reduce what is the further processing cost. For your agricultural income, you already know what your cost of cultivation is. Your sale price will be the price at which you sold to the factory, and that will give you your agricultural income. This is basically your costing chapter of process costing. Your process costing of costing is what I am doing. The only difference is from one process to another, I am selling it at market value. Clear? Yes. But for 3 goods alone, people, income tax says don't do this method and do method which I tell you. Item number 1, rubber. Income tax says if you are into a rubber business, compute the full PGBP. 35% of it becomes business income and 65 becomes agricultural income. If you are into the business of coffee, with 2 words, grow and cure, then it is 25 and 75, 25 being business, 75 being agriculture. If you are in the coffee business with 4 words, grow, cure, roast and ground, in that case it is 40, 60, 40 for business, 60 for agriculture. If you are in tea business, it is same as coffee with 4 words, which is 40 and 60. Always keep in mind, people, the higher percentage is for agriculture. That is how the split happens. Yes or no? Yes. Which means here, people, I don't care what the market value and all is. I compute the full PGBP and split it accordingly. That is what the answer would be. Yes or no? This will help you find out what is your PGBP income and what is your agricultural income. If an exam question comes where they come and ask you, tell me your total income, you will simply take your agricultural income and tell it is exempt. But if the question asks compute tax liability, agriculture income is not exempt. Agriculture income is partially integrated. Agriculture income is partially integrated. What does partial integration mean, people? It's very simple. Always create an income line. Always create a income line. Yes. If for an example, I tell you that my total income is 3,50,000. My total income is 3,50,000 and my agriculture income, for example, is 10 lakhs. My agriculture income is, for example, 10 lakhs. Income tax will say, boss, the 10 lakhs is exempt. Don't worry about it. Don't worry about it. But for the purpose of computing tax, I'll play a game. I will create an income slab which starts with 0 and ends at total of both 13.5 lakhs. Ends at 13.5 lakhs. Income tax says first basic exemption limit will go to central government, which means income tax department will keep it. After basic exemption limit, first priority given to agricultural income. People, how much is my agricultural income? 10 lakhs. So from 2,50,000 to 10 lakhs is 12,50,000. This is fully for agricultural income, and therefore for me it is exempt. Whatever is the remaining will again go back to income tax. For 0 to 2.5 lakhs, tax rate is 0. From 2.5 to 12.5, I don't care, which means I am only going to tax 12.5 to 13.5. People, assuming I am in alternate regime, 12.5 to 13.5, tax rate is 30%. Extra income 1 lakh, tax at the rate of 30% gives me, add your 1,200, my tax is 31,200. This is called partial integration. Now this is in timeline chart. If I give it in English, income tax says compute tax on full 13.5. Step number 2, compute tax on basic exemption limit plus agricultural income. Basically, in simple words, they are saying, people, first compute tax for the full number, then compute tax for this number. Step 3 is 1 minus 2. That you write in English, I put it in maths. The logic remains the same. Basically, compute tax on the full 13.5, compute tax on 12.5, and then 1 minus 2 will give you the right answer. Or if you want, you can directly do this. Where what will you do, people? Whatever incomes you have, first basic exemption limit will go to central, then everything will go to state, and then again come back to central. In my example, 3.5 was my income in central. First 2.5 I gave to central, became 0. Then I moved fully to agri and left off with extra 1 lakh which I gave to central again in the highest slab. That is how it works. If I give you another example, people, you help me this time. I am coming and telling you that your agricultural income is 16 lakhs. Your agricultural income is 16 lakhs and my total income is 12 lakhs. I am doing DTR. Tell me how to do the timeline chart, people. I will start from 0. I will go until 28 lakhs. Income tax is first 3 lakhs will go to income tax. From this 3 lakhs start agriculture. Agriculture is 16 lakhs, which means up to 19 lakhs will first go to agricultural income, which means exempt. From the 19 lakhs to 28 lakhs will go to income tax department. Check, no, income tax department got 3 here, 9 here, which is 12. Hey, which one am I going to tax? I'm going to tax 19 to 28. As per default tax regime, extra 9 lakhs will be taxable at the rate of 30%. Number becomes 2,70,000. Add cess on this, you'll get the answer. This is how partial integration works. If you want to do it in that boring English format which your study material says, compute tax on full 28 lakhs, then compute tax on 3 lakhs plus 16 lakhs, which will give you 19 lakhs, and then step 1 minus step 2, which is the same answer. which is the same answer. Whichever works for you in exam, people. As long as you remember to do it, that is fine for me. That is fine for me. Notice only one thing in agricultural income. If the question asks for income, income is exempt. If question asks for tax, you need to do partial integration. You need to do partial integration. You cannot avoid this. You cannot avoid this. Is this clear? Are we good on this? Are we good on this? Yes, yes, yes. All right. Starting with this important chapter for your syllabus, people, we're looking at what is called as income from salaries. We're looking at income from salaries. This get covered in two places. One is either in question number 1 for your compulsories, or it comes in your question number 3, part number A. It happens in either of the two. An important chapter, but at the same time the easiest chapter for you to know, people, because no rocket science. Just use the formula and the answers come automatically. We're looking at the chapter called salaries, people, where income tax stands and comes and says, if you want to tax something under the head salaries, two things to be satisfied. One, there should be an employer-employee relationship, and second, the payment should happen under such relationship. Yes, if these two conditions satisfied, then the income gets taxed under the head salaries. Income tax comes and clarifies when it comes to salaries. Salaries are taxable on due or receipt, whichever is earlier. Due or receipt, whichever is earlier. Some type of advances which can be given to you, people, is that if you receive salary in advance, then it is taxable as and when it is received. But if you receive advance against the salary, meaning you are promising him that you give me money today, I will work for you in the next 5 years and I will adjust it against them, then it is not taxable today. It is taxable when it becomes due. It becomes taxable when it is due. And third thing is, I am coming and saying I want loan. In that case, income tax will say the loan is not taxable. The loan is not taxable because it is anyway payable back. It is anyway payable back. At the same time, people, if the question says that there is something called arrears of salary, then it will be taxable as and when it is accrued itself. As and when it is accrued itself. So you will take that into consideration as well. Yes, yes. Couple of things apart from that, people, where income tax comes and clarifies when it comes to salaries. When it comes to salaries, any salary received by a partner from a partnership firm is not taxable under the head salaries. It is taxable under the head PGBP. Any salary which is received by an MPs and MLAs will not be taxable under the head salaries, will be taxable under the head IFOS, will be taxable under the head IFOS. Any salary will be taxable here even if you decided to not to take it into your hand. Meaning, if someone is giving you salary and you say, I don't want the salary, give it to charity, income tax will say it is still taxable for you because you earned it. You only decided to root the money and therefore it is still taxable for you. At the same time, income tax comes and clarifies all types of salaries are taxable, whether it is received before employment, during employment, or after employment. Before employment would be any kind of joining bonus, during employment will be all your salaries, and after employment will be your pension. All the three are taxable. All the three are taxable. Yes or no? Yes or no? Yes. As we move on to salaries, people, there is a template format which is there in my books, not relevant for you. You can follow the same template which you have in your respective books. But what does this provisions come and say? Every item will be taxed as it is. Every item will be taxed as it is. For example, basic salary is taxable as and when due or received, whichever is earlier. DAs can be of two types, forming part, not forming part. If DA is forming part, it is taxable. If DA is not forming part, it is taxable. Both are taxable. Both are taxable. Just that DA forming part is used for the purpose of computation of salaries. Computation of salaries, but both DAs are taxable. When it comes to bonus, income tax says bonus is only taxable when it is received and not when it is due. And then comes your commission and fees, which also income tax says will be taxable as and when accrued or received. But after this starts your allowances, people. After this starts your allowances, where the first allowance which income tax is notified is called as house rent allowance, where income tax says whatever HRA you receive will be fully taxable, but subsequently you will give an exemption for least of the three. Item number 1, actual HRA. Item number 2, 50% of salary or 40% of salary depending on where the house is located. If it is located in metropolitan city of Chennai, Delhi, Mumbai, Kolkata, then it is 50% of salary. Everyone else has 40% of salary. And finally, it is rent paid minus 10% of salary, where in all the two cases salary means basic plus DA forming part plus turnover commission for the respective months. However, please note this HRA is not eligible for default tax regime. You do not get this claim under DTR. So under DTR, whatever HRA you receive is fully taxable. Second, after that you have other allowances, people, where income tax says if you are receiving something called transport allowance, income tax will only give you an exemption of transport allowance provided you are disabled, where you get an exemption of 3,200 per month. If not, you are receiving something called child education allowance, which is exempted for 100 per month per child, 2 children, provided education is in India. Child hostel allowance, it is 300 per month per child, 2 children, provided education is in India. Provided education is in India. And then you have other allowances like traveling allowance, daily allowance, conveyance allowance, helper allowance, research allowance, and uniform allowances. These are all allowances used for business purposes. Income tax says will become fully exempt provided you spend the money. Provided you spend the money. So exemption amount is amount spent. Under DTR, people, all items are not allowed as deduction except for transport allowance. Transport allowance is allowed as deduction under DTR. Every other item is not allowed as deduction. Yes. In the next page, you are allowed for deduction of traveling allowance, conveyance allowance, and per diem allowance. You are not allowed for helper allowance, research allowance, and uniform allowance. In simple words, people, under DTR, you can only claim 3 items: transport, traveling, conveyance, per diem. Transport, traveling, conveyance, per diem. These are the 4 items you can claim under DTR. All other items, if you want, you can only claim under ATR, alternate tax regime. Yes or no? Yes. After allowances, people, comes your other allowances, where income tax says other than this, any other English used in exam fully taxable, except for items like allowances given by government to a person situated outside India. Embassy case that we already discussed is fully exempt. Yes. Then comes your leave salary and leave encashment, people, where income tax says if you are receiving any kind of leave salary or leave encashment, tell me, is it during employment, after employment? During employment, fully taxable. After employment, tell me, government employee, non-government employee. Government employee, fully exempt. Non-government employee, first taxable, then allowed for an exemption, list of 4. Item number 1, actual amount received. Item number 2, average salary for the last 10 months. Item number 3, average salary for the last 10 months divided by 10 into leave balance available, in terms of months. And item number 4, 25 lakhs for your lifetime, for your full lifetime, whatever amount you have received, 25 lakhs is the maximum you can claim. Here salary means basic, DA forming part, turnover commission for the last 10 months, divided by 10 will give you your average salary, When you compute leave balance, people, income tax says take the total leaves which you have received minus the leaves which you have utilized. That will give you leaves in number of days. Divide that by 30 days in order to get your leave balance, in months. If you have received more than 30 days in a year, income tax will say restrict to 30 days. After leave balance, people, comes in something called as your retirement benefits. First item being gratuity, where income tax says if you are receiving gratuity, again tell me whether you are receiving during employment, after employment. During employment, fully taxable. After employment, government employee, non-government employee. Government employee, fully exempt. Non-government employee, are you covered in POGA? Not covered in POGA. If you are covered in POGA, fully taxable, least of the 3 allowed as exemption. Item number 1, actual amount received. Item number 2, 15 by 26 into number of completed years, rounded off if more than 6 months, into last drawn salary, where salary here means basic plus all DAs. If you are not covered by POGA, then income tax says it is fully taxable, least of the 3 allowed as exemption. Actual 1 by 2 into number of completed years, no round off concept, into average salary for the last 10 months, where salary means basic plus DA forming part, and finally maximum of 20 lakhs for the whole lifetime. This is how your gratuity will get covered. After gratuity, people, comes something called pension, where income tax says when it comes to pension, if you are receiving pension in commuted format, which is lump sum, then you get an exemption. But if you receive a pension in uncommuted format, meaning monthly, then it is fully taxable. Commuted pension, income tax says again tell me whether it is government employee, non-government employee. Government employee, fully exempt. Non-government employee, taxable, but allowed exemption depending on are you receiving gratuity, not receiving gratuity. If you are receiving gratuity, exempt amount is 1/3 of total pension, and if you are not receiving gratuity, it is 1/2 of total pension, where total pension means take the pension which you received in commutation divided by the percentage which you received, divided by the percentage which you received. You can ignore VRS, you can ignore retrenchment compensation. Moving on to the next item, which is your contribution to funds. Income tax says if you are receiving any kind of PF, if you are receiving any kind of PF, then if you are receiving statutory provident fund, everything you receive is exempt, everything which you withdraw is exempt. If you receive anything in PPF, public provident fund, only you can contribute. So what you contribute becomes ATC, what you receive is exempt. If you are in RPF, if you are in RPF, income tax says who is contributing is the question. If employer is contributing, employer can only contribute up to 7.5 lakhs. Employer can only contribute up to 7.5 lakhs. If he contributes more than 7.5 lakhs, fully taxable above 7.5. For whatever he contributes below 7.5 lakhs, he can get an exemption up to 12% of salary, where salary means basic plus DA forming part plus turnover commission for the respective months. If it is employee, no matter what you contribute, you will get a deduction of 1,50,000 under 80C, under 80C. If you are receiving interest on employer, if you are receiving interest on employer, wherever you contributed more than 7.5 lakhs, whatever extra money you have, interest coming on that will be fully taxable. Interest on interest will also be fully taxable. But if you are receiving contributions less than 7.5, interest on that will be exempt up to 9.5% per annum. Very good. It is 9.5% per annum, meaning interest rate is exempt up to 9.5. Any interest rate more than 9.5 is fully taxable. If you are receiving interest on employees contribution, income tax says if the contribution made by the employee is up to 2.5 lakhs, then exempt up to 9.5%. But if the employee is contributing more than 2.5 lakhs, whatever interest comes on that is fully taxable. Fully taxable. When you start withdrawing money from RPF, income tax says don't withdraw within 5 years. If you withdraw after 5 years, fully exempt. But if you withdraw within 5 years, fully taxable. However, if you can prove that it is because of medical reasons, it is because you have shifted your company and transferred this PF to another account, it is because company has been shut down and you have been forcefully removed, in that cases it will not be taxable even if it is within 5 years. Even if it is within 5 years, these are the cases where you will get an exemption to the rule. You will get an exemption to the rule. Yes, yes, yes. Apart from that, people, you have something called your statutory provident fund, your superannuation fund. Same logic as statutory provident fund. Whatever you receive, fully exempt. Unapproved statutory fund will be fully taxable, same as URPF. And then we have contribution to NPS. I want you people to mark this one as important for the current year because there is an amendment on this. Income tax comes and clarifies any kind of contribution to NPS which you have will be fully taxable under the head salaries, because you're going to get a deduction under chapter 6A. You're going to get a deduction under chapter 6A. So this is important for you to keep in mind. This is important for you to keep in mind. Yes, yes. Then people, what are the other items? Income tax also comes and says if you have made a contribution to Agniveer Corpus Fund as a central government employee, then that is also fully taxable because you will get a deduction under chapter 6A. After this, people, starts your items called as perquisites, where income tax says what are the perquisites which I can give to you. First perquisite I can give to you is called leave travel allowance or leave travel concession, where if you are traveling for business or personal reasons, where if you are traveling for personal reasons, you are allowed for an exemption. You are allowed for an exemption for not just yourself, you are allowed exemption for self with family, where family means spouse, 2 children, but third children permitted if the second born is a twin, and dependent parents with dependent siblings, you can make trips of 2 in 4 calendar years, and you will be allowed on exemption of economy class fare in flight, first class fare in railways, and first class fare anywhere else, That is what will be allowed as exemption to you. Please notice that you will only be allowed exemption for the travel part of it. You will not be allowed exemption for the accommodation and stay part of it. You will not be allowed exemption for accommodation and stay part of it. After LTA comes your other perquisites, people, like your medical treatment, where income tax says tell me whether the treatment happened in India or outside India. If the treatment happened in India, I will exempt it for you if it is any of the 4: employer's own hospital, government hospital, specified disease, COVID-19. For 4 reasons I will exempt it for you. Any other reason, if you receive this medical perquisites, it is fully taxable. taxable. If you are going to have a treatment outside India, then in that case you can go for a foreign travel. You can go for a foreign travel. Any treatment plus stay will be exempted if RBI approves. For the travel expenses which you incur, it will be taxable if your GTI is more than 2 lakhs and it will be exempt if your GTI is less than 2 lakhs. This whole medical treatment procedure is only allowed as an exemption for family members, where family means self, spouse, all children, self, spouse, all children, dependent parents, dependent siblings. Dependent parents and dependent siblings, your grandparents are not covered. Your grandparents are not covered. That is what the rules are. Next comes in your amendment of current year people. You will have an amendment coming from here, your RFA. Your RFA, where income tax comes and says, if you have been received in rent-free accommodation, what have you received? Rent-free accommodation. I will ask you, tell me, are you government employee, non-government employee? If you are a government employee, you will be taxable for whatever license fees has been determined. But if you are not a government employee, I will ask you, tell me, are you owning the house or leasing the house? Who is owning? Employer. If the employer is owning the house or employer is leasing the house. If the employer is owning the house, you will be taxable for 10% of salary where the population is more than 40 lakhs. You will be taxable for 10% of salary where the population is more than 40 lakhs. But if you are leasing the house, then it is actual lease charges paid by employer or 10% of salary, whichever is lower, where salary definition means basic plus DA forming part plus all bonus, all commission, all taxable allowances. It is basic plus DA plus all bonuses plus all commissions plus all taxable allowances. RFA is always the last thing to do in your paper. RFA is always the last thing to be done in your paper. Never do it on the first. Always do it in the last. Yes, that is what RFA rules come and say. Yes, but the thing which is going to be tested in the current year is that people, income tax says, if you have RFA for more than 1 year, if you have RFA for more than 1 year, meaning you had RFA last year and you have RFA current year your RFA will not be computed based on salary. Current year your RFA will be computed based on indexation benefits, meaning whatever RFA was determined yesterday, last year, whatever RFA was determined last year, multiply with inflation of current year. So which means RFA of last year into CII of current year divided by CII of last year will be the current year's RFA. You will not compute RFA every year. You will not compute RFA every year. You will only compute RFA in year 1 and then give inflation changes. Yes or no? Yes. This was notified last year but could not be tested because last year was the first time. Current year they will test you on this. So if they give you a question where they come and say the RFA already determined for last year is this much number, current year you will not compute RFA. You will take the last year number, multiply CII and get the answer. At the same time, people, income tax is coming and clarifying, if you have taken this house on a furnished level, meaning you are also given furniture, then again income tax will ask, tell me, is the furniture owned by the employer, hired by the employer? If the furniture is owned by the employer, then it is 10% of the cost of the asset. But if it is hired by the employer, then it is higher charges. Hotel accommodation says take actual higher charges or 24% of salary, whichever is lower, where salary definition is same as RFA rules. Then comes your other items, people, something called concessional loan. If employer is going to grant you free loans or lower interest loans, income tax says, tell me what is the SBI rate. SBI rate minus what employer gave you will become your perquisite value, but because that is an interest rate template, you will also multiply this with your loan outstanding as on the last day of each month. So find out what is the outstanding amount on the last day of each month multiplied by SBI rate minus employer rate. Will become your concessional loans. This will not be taxable if the loan amount given is less than 20,000 or the loan is given for specified disease purposes. Then comes your item called as subsidized food and food coupons, where income tax says if employer is going to provide you food or food coupons, he will be exempted up to 50 per meal, but this only includes meals, people. If you are going to give beverages, it is fully exempt. If you are going to give alcohol, it is fully taxable, and if you are going to give him food in a place of remote areas, then it is fully exempt. Then comes your gifts and vouchers, people, where income tax says if an employer gives you a gift, cash gifts are fully taxable, kind gifts are exempt if it is up to 5,000 rupees. If it is more than 5,000 rupees, it is fully taxable. Attention point here, employer gifts are 5,000, other gifts are 50,000. Other gifts are 50,000. Intention avoid. Yes. Next, so ESOP shares, people, income tax comes and says if company is going to give you ESOPs where they are going to give you at a price lower than market value, then whatever is the market value minus the price given by employer will become your perquisite value. If you don't know how to find out market value, take the average of the opening and closing of the shares. Take the average of the opening and closing of the shares. If you are going to have an asset which is sold to you by the employer, if an asset is sold to you by the employer, income tax says tell me what the asset is. If the asset is a computer, I will ask the employer to first compute the WDV. WDV will be computed by allowing 50% depreciation WDV method, and he will arrive at a WDV. This is the price at which he should have sold to you. If he sells at a price lesser than this, the difference will become your perquisite. If it is not a computers, people, he may give you a motor car. Again, income tax says compute the WDV, where WDV here would be cost minus 20% depreciation WDV method in order to find the WDV. If it is not any of these two and it's other assets, income tax says do cost minus 10% SLM method in order to arrive at the WDV of this. But ignoring transfer, people, if question comes and says that I am not selling the asset to you, I am giving you the asset to use, then income tax says tell me what has been given. If they give you computers or laptops, then it is given for office purposes and therefore fully exempt. If they give you any other asset, ask yourself if it is owned by the employer or hired by the employer. Owned by the employer, it becomes 10% of the cost of the asset. Hired by the employer becomes higher charges. But if they give you an asset which is motor car, I will then ask, tell me, is it for official reasons, personal reasons, or part official, part personal? If you give it to me for official reasons, I will fully exempt it. If you give it to me for personal reasons, whatever is the asset, 10% of the cost, whatever is the expenses you pay, fully included, plus all driver charges which you have paid will be fully taxable as a perquisite. But if it is given for part official, part personal, then a table will start. The table will come and say if the employer is owning the car and the employer is maintaining the car, then you will be liable for a tax of 1,800 per month or 2,400 per month, depending on what is the cc of the car, cubic capacity of the car. If the cubic capacity is less than or equal to 1,600, then it is 1,800. If it is more than 1,600, then it is 2,400. If employer is giving you the car but not taking care of maintenance, he says you take care of maintenance, then it is 600 per month or 900 per month. But if employer comes and says you have a car, I will take care of maintenance, then whatever employer pays will be fully taxable, but you will be allowed an exemption of 1,800 per month or 2,400 per month, depending on the cc of the car. If I am itself having a car, I am itself maintaining the car, employer has nothing to do with me. In that case, it is not a benefit. At any appropriate stages, if the employer furnishes you a driver or a chauffeur, in that case, whatever amount you have, add an extra 900 per month to the same. That is what the car rules are. This is something which is tested in every exam if a salary question comes. Yes. After this, people, comes your other items called education facilities, where income tax is saying I am not giving you money for education. I am telling you I will take care of the education. In that case, income tax says tell me who is getting the education. If the education is being given to the employee, then it will help business grow and therefore it is fully exempt. If it is given to the child of the employee, then income tax says it should only be exempted provided the school is employer's school or employer's tie-up school. It should either be employer's school or employer's tie-up school, and the cost of education in the school should be less than 1,000 per month per child. If the cost is more than 1,000 per month per child, the cost is fully taxable. If it is anyone else, it's not the employee, it is not the child, the cost whatever is incurred by the employer is fully taxable, is fully taxable. Last couple of items, people, where income tax is saying if you are going to have a transportation facility given to companies which are engaged in transportation business, if the transportation business is of airways and railways, it is fully exempt. If it is anyone else, it is fully taxable. Items which are fully taxable are servant charges, gas, electricity, credit card, all club expenditures and all is fully taxable unless any amount is spent for business reasons. Unless any amount is spent for business reasons. If they are spent for business reasons, it is fully exempt. It is fully exempt. Items which are fully exempt even though it may be for personal reasons, people, is what you need to pay attention to. Item number 1 says any reimbursement of telephone expenses, whether it is for business or personal reasons, fully exempt. Perquisites given by government for rendering services outside India, like we discussed, embassy case. Third, any kind of recreational facilities given to all employees, all these holy festivals, all those things which is happening in office, fully exempt. Any kind of training expenses incurred for the employee for them to train better for office, fully exempt. Tax on non-monetary perquisites, fully exempt. And RFA and all given to judge of High Court and Supreme Court, fully exempt. These are all items to be kept as exemption. Items to be kept in mind, people, is first, after you compute this whole thing, you will receive at something called as gross salary. In this gross salary, you have to reduce standard deduction of 50,000 rupees if you are under alternate tax regime, 75,000 rupees if you are under default tax regime. If you get an exam question and the exam question comes and says total income as per alternate is this much, compute the total income as per default. Compute the total income as per default. What will you do, people? I will give an additional deduction of 25,000. If the question says total income as per default is this much and I want total income as per alternate, I will add back 25,000. I'll add back 25,000. Don't start reworking the whole thing. Just make modifications. Just make modifications. Second, income tax says if you're receiving any kind of entertainment allowance as a government employee, you will first tax it in allowances and then allow exemption for least of the three, which is actual amount received 1/5 of the basic salary or 5,000 rupees per annum. It is 5,000 rupees per annum. Finally, if you are receiving any kind of professional tax, income tax says who is paying the tax is the question. If the employee pays the tax directly, then I will directly reduce from my gross salary. If employer is paying the tax, I will first tax the salary and then allow as a deduction. After all these things done, people, one thing to be kept in mind is that if an exam question comes where they say salary is given in scale model, meaning they have told 20,000, 2,500 and 30,000. What does this mean? My initial salary is 20,000 per month for 1 year. 1 year later, my salary will become 22,500 per month. 1 year later, it will become 25,000 per month. 1 year later, it will become 27,500 per month. When will it go? It will go on until it becomes 30,000. It will go on until it becomes 30,000. That is how pay scale model works. What is the relevance of pay scale model, people? It is very useful when you are having questions with average salary. If a question comes with average salary of the last 10 months and all, this number will impact, and therefore you have to pay attention there. Yes or no? Yes. Summaries are given to you as to what do you mean by salaries in various topics, which you can keep in mind. Some items which you need to keep in mind from default tax regime, people, is that in all the items we told, items which are not eligible for default in allowances, we told HRA not eligible. Any helper, uniform, research allowance not eligible. Underground personal allowance not eligible. Coming to perquisites, people, what and all is not eligible? First item which is not eligible in perquisites is your leave travel concession. Leave travel concession has been notified as not eligible under default tax regime. Second item which is not eligible under default tax regime is something called as food coupons. Pay attention to the fact, people. If I receive food in office, it is exempt. If I receive food in office, it is exempt even under DTR. But if the question says I have given food coupons, then DTR says fully taxable. Then standard deduction we already discussed, people. 50 has now become 75,000. Other two items of entertainment allowance and professional tax is not allowed as deduction. The one thing which I wanted to pay attention to, people, if a question comes in exam for DTR, and they come and say professional tax paid by employers 2,000 rupees, people, in that case you will first add it to gross salary. Deduction will get denied, which means only add 2,000 rupees because you are in DTR. So please pay attention to that fact, people. If the same question comes for ATR, then you will add 2000 to gross salary, claim 2000 as deduction, net off is 0. Net off is 0, but when it comes to DTR, 2000 will simply get added, no deductions, no deductions. That is how salary will operate. That is how salary will operate. Yes or no? Yes. So couple of items in DTR, people which are not eligible: HRA, allowances except for transport, traveling, per diem, conveyance. Yes. And then items which are not eligible: leave travel concession, food coupons, entertainment allowance, professional tax. Items extra allowed under DTR, standard deduction of 75,000. Standard deduction of 75,000. This is your chapter on salaries. This is your chapter on salaries. Any doubts on this? Are we clear on this? Yes. So let's do a revision of what we call as income from house property, people. The provisions of income house property come and very simply come and say income is going to be taxed under the head house property if one condition is satisfied. There should be a house which is owned by the person, which means this is only going to be taxable under that house property if you have a house. What does income tax say? Income tax say house literally means a land and a building attached to it. A land and a building attached to it. There is no other conditions attached to it, which means anything can become a house. Anything can become a house. That is what the rule. Rule number 2, they are coming and saying it can only be taxable under house property provided you are the owner. So if you are not the owner, it is not taxable under house property. Then it's a sublease. It's a sublease which goes into IFOS or PGBP depending on the facts of the case. Yes. Second, income tax comes and says if you are only going to rent out a land, then it is not house, it is moving to IFOS or PGBP as the case may be. Yes. Yes. But earlier people, income tax used to come and say when it comes to house property, if I am in the business of letting out houses, then it is taxable under PGBP. Then it is taxable under PGBP. However, current year amendment comes and clarifies that if you are in the business also, but the property you are letting out is residential property, then it is still under HP. It is still under HP, which means only one thing which is taxable under PGBP now is commercial properties. So expect an MCQ question in exam in this, people, where if you are in the business of letting out residential property, you are still under HP provisions. That is rule number 1. Then income tax talks about some exceptional rules, people, where they say even though you are not the owner, I will deem you as owner. Case number 1, income tax says if you are the person who's transferring the house property to your spouse for inadequate consideration, or you're transferring it to your minor child for inadequate consideration, then it is taxable in your name. Exceptions are as follows. 1, you are given it to her for an agreement to live apart, her, him, whatever, you have given them for agreement to live apart. Second, if it is given to a minor married daughter, because minor married daughter is taxable under clubbing rules. They are taxable under clubbing rules. Item number 3, where they say if you are going to hold impartial estates, then the person of the holder of the case will be treated as deemed owner. If you are a cooperative society and all, then you will still be called as a deemed owner if you are enjoying the rights. And if you are going to get any part possession by making part payments, then also you are the deemed owner as per Transfer of Property Act. Finally, if you are going to give this property to someone for at least a period of 12 years, then also you are treated as a deemed owner. Yes, when it comes to house property, people, income tax says that house property can be of 2 types. One is SOP and one is LOP. But SOP also, income tax says, can only be maximum 2 properties based on my preference. I can choose which 2 properties to make it SOP. The moment I choose 2 properties as SOP, all other properties become deemed let out properties. But if you are in the business of letting out properties, or you are in the business of making properties, basically you are holding these assets as stock in trade, income tax says you will not be taxable under the head house property for the next 2 years. From the end of the financial year. If you are able to sell all these properties within the next 2 years, then it is not taxable. If you go beyond 2 years, they will start treating these properties as deemed let out properties. They'll start treating it as deemed let out properties. How do you do HP, people? Income tax says you follow a certain format. You start with municipal value or fair rent, whichever is higher. Compare that with standard rent, whichever is. This answer will give you something called expected rent. This expected rent will then be compared with actual rent minus unrealized rent, whichever is higher. Do bear in mind that the actual rent here is not the actual rent, it is actual rent receivable, meaning ignoring vacancy losses. You ignore vacancy loss and you compare and you compare. If your actual rent minus unrealized rent becomes higher than expected rent, you will be permitted to claim your vacancy loss. If you don't understand that, then you don't get vacancy loss. Meaning if ER is more, you don't get vacancy loss. If AR is more, you get vacancy loss. Once you complete this, people, you will arrive at gross annual value. From that, you reduce municipal taxes which are actually paid by the owner in the current year. In the current year, there is no rule that you have to pay current year's tax in current year. Whatever you pay, you get deduction. Whether it is current year's, next year's, or 10 years later, it doesn't matter. What you pay, you get a deduction of what you pay, and you now arrive at something called as NAV. From that NAV, you will reduce two components. But before you reduce two components, always add arrears of rent and arrears of unrealized rent and arrears of rent, which is of past years. Add that number, you will get the total NAV. From that, you will reduce 30% of the total NAV and then reduce interest on loan to arrive at your income from house property. Although do bear in mind, when it comes to SOP properties, none of these items are there except for one item called interest on loan. And when it comes to DLOP, all of the items are there except for actual rent. In which case, when it comes to DLOP, the GAV is directly expected rent. That is what the rules are. Yes or no? Yes. Some things to be kept in mind, people. First of all, when it comes to vacancy loss, please ensure that vacancy loss is not reduced while comparing with expected rent. You compare expected rent directly, and then if the actual rent is more, you reduce vacancy loss. Otherwise, don't reduce vacancy loss. Rule number 2, when it comes to municipal tax, like I said, you need to pay it in the current year to get the deduction, and owner should pay it. If the tenant is paying it, no deduction. Then when it comes to interest on loan, people, income tax says, tell me whether the property is SOP or LOP. If the property is SOP, you will be allowed a deduction of 2 lakhs per financial year, per house. If you satisfy three conditions. Condition number 1, loan is taken after 1999. Loan is taken for purchase and construction of the asset, and house is completed within 5 years from taking the loan. If three conditions are satisfied, you get deduction of 2 lakhs per house per financial year. If these conditions are not satisfied, you get 30,000 per house per financial year. But as an owner, I can maximum claim only 2 lakhs per financial year in SOP. Yes, so even if I have two SOPs, if I accumulate both, I can maximum claim 2 lakhs. So it is 2 lakhs per financial year. However, if you are an LOP case, whatever interest you pay is fully allowed as deduction without any restrictions. Whether you take it for repairs, whether you take it for purchase, you take it for construction, you complete the house 10 years later also, it doesn't matter. As long as the house is LOP, you get full deductions. Next, you need to keep in mind, people, is that if I have a loan and I have repaid this loan by taking a new loan, the interest on the new loan can also be claimed as deduction. But if I have a loan and I have not paid the interest, because of which bank is levying interest on interest, I cannot claim it as deduction. I can also claim those interests which are paid outside India, people, provided I have paid TDS on those properly. Yes or no? Yes. At any appropriate stages, if you get an exam question where they come and say that the loan is taken earlier and the house was completed later, you will accrue an item called as pre-construction interest. Income tax says, if a loan is taken prior to the house is completed, accrue a pre-construction interest from the date of the loan till 31st March of the preceding previous year in which the house is completed. So if the house is completed current year, ignore this year and take until last year. Whatever period of pre-construction interest you get, you can allow it over 5 years. But when you say allowed, people, it does not separately get allowed. It gets added to the normal interest. Meaning this will also be restricted to 2 lakhs or 30,000 depending on the property case. No restrictions when it comes to LOP houses. That is what the pre-construction period interest looks like. Yes. After that comes your unrealized rent, people, where income tax comes and clarifies, if you have any rent which you could not recover from the tenant, this will be called as a bad debt or unrealized rent, provided some conditions are satisfied. Condition number 1, the tenancy should be bona fide. I should have a genuine case with you. Condition number 2, I have tried my best to recover rent from you. Condition number 3, I have asked you to vacate the premises, or I have tried to vacate the premises. Condition number 4, if you have vacated the premises, I should have not given you a second premise to live. I should have not given you second premise to live. If all the conditions are satisfied, income tax will let you reduce the unrealized rent from actual rent. Will let you reduce the unrealized rent from actual rent. If not, actual rent will be remaining as it is. Will be remaining as it is. On a subsequent year, if you receive the money back, bad debts recovered, you will take it as taxable component and add it to your NAV, which means this number will be allowed a deduction of 30% separately. Please note that this will be taxable even if the house is not in your name anymore. Even if you have sold the house, it will be taxable because the money pertains to earlier years. Some special scenarios for you to keep in mind, people. If your question comes and says that the person is having a house and is taking the part house for SOP and part house for LOP, income tax says assume both the divisions are two separate houses. Whatever is the common cost will get apportioned between both. To the extent the cost pertains to SOP, delete all the cost, because you can only allow interest on loan. Whatever is LOP, you consider as it is. Second, if the house is not owned by me but is owned by many people, we have a co-ownership case. All incomes will be computed up to NAV stage and then will be split to both the owners in profit sharing ratio. After which, people, whatever interest on loan you have paid will be allowed 2 lakhs per owner. So even if this property overall has an interest of 4 lakhs, both the owners can claim a deduction because each owner gets 2 lakhs ka deduction. So it is 2 lakhs per owner. It is not 2 lakhs per house. It is 2 lakhs per. That is what the rules are. Yes. Finally, people, to conclude this chapter, income tax comes and says when you have anything called composite rent, meaning I have decided that I don't want to give you house alone. I'll give you house with some amenities. Income tax says if you're able to split the rent, house will go under HP. The amenities will go under IFOS. If you're not able to split, everything will go to IFOS. This is very important and critical, people, because if you move something to IFOS, the rules do not remain the same. There is no 30%, there is no interest on loan and all. Whatever you have fully allowed. Here we have restrictions, and therefore your classification makes an impact. Yes or no? Yes. So bear that in mind. Finally, income tax comes and says if you end up in a loss under HP, rules of set off. First, set off against income from HP. If you're not able to set off against income from HP, set off against other heads up to a maximum of 2 lakh rupees. If that is also not happening, you can carry forward the balance losses for a period of and set off against house property incomes. You can carry forward for a period of 8 years and set off against house property incomes. Clear, not clear? Yes. This is all provisions relating to ATR. Under DTR, people, what changes? Income tax says the SOP property is no more valid. And therefore under DTR, what will happen? Income tax will say the interest on loan which you are trying to claim under SOP is not allowed. This will be denied to you. Second thing, what is happening, people? Income tax comes and says if you have any loss from house property, what do you have? You have a loss from house property. You can set off the loss against income from house property in current year. You can set off the loss against income from house property in the current year. If you are not able to set off, nothing else is allowed to you. Meaning neither will you set off against other heads, nor can you carry forward. This number will get permanently lapsed. The moment you opt for default tax regime. So look for those questions, people, where the question is doing default tax regime and you have HP losses. If you're able to set off against HP income, do it. If you can't set off, this will permanently lapse. You can't claim it anymore. And the rules remain the same for past year losses also, people. If the question comes and says I have past year HP loss and current year I am doing DTR, first delete that loss. Tell them that you are not eligible for that loss before you set off in the current year. This is your rules on income from house property. In chapter, you're looking at your PGBP, profits and gains of business and profession. Yes. Couple of things which you need to know before you start the chapter itself, people, as to what items are those which are first taxable under the head PGBP. Yes. First, income tax is coming and saying if you are in the business of any activity. If you're in the business of any activity or you're undertaking any profession, then the income coming from it is taxable under the head PGBP. That's a straightforward case. Yes. But what other items do you need to keep in mind? First is, if you're going to have received a salary from a partnership firm as a partner, it is taxable under PGBP. Any other remunerations you're receiving as a partner from a partnership firm, PGBP. Any kind of gift you're receiving it under a business is called as PGBP. Any value of perquisites, value of benefits coming in the course of business is also PGBP. Any kind of gifts received as stock in trade, inadequate considerations, all are PGBP items. All are PGBP items. That's what you have to first keep in mind. Yes. So that is the first rule to be kept in mind when it comes to PGBP, people. Yes. Yes. Apart from that, people, some other items you need to keep in mind. For example, any kind of government grants you get from government. If it is relating to a capital asset, it goes to capital assets. But if it is not relating to capital asset, a revenue item, it goes into PGBP again. It goes into PGBP again. This is what you would have learned in your accounting standards as well. Yes. So couple of things which you need to keep in mind as you go into the topics of PGBP. Yes or no? Yes or no? Yes. Now, if you start PGBP, people, some things to be kept in mind. Some things to be kept in mind. First is 4 words. First is 4 words. We call it as disallowance, allowance, addition, reduction. Disallowance, allowance, addition and reduction. What does disallowance mean, people? Disallowance means an expense is there in P&L. Income tax says cannot claim, and therefore it gets disallowed. Therefore it gets disallowed, or in simple words, added. Or in simple words, added. Allowance means item is not there in P&L. Income tax says claim it, and therefore I am reducing it. And therefore I am reducing it. Addition is an item which is not there in P&L. Income tax says should be there in P&L. This is an income which income tax recommends you to add. This is an income which income tax recommends you add. And the fourth item is reduction. Item is there in P&L. Income tax says is not part of PGBP, is part of some other head. Therefore, reduce it off. Therefore, reduce it off. 4 words which you need to keep in mind, people. The whole PGBP revolves around this, which means if you want to do PGBP properly, the first thing you need to know is what is happening in P&L. Unless you know what is happening in P&L, you can't do what is happening in income tax. Without understanding what adjustment took in P&L, whether it is there in P&L or not there in P&L is the first question. If it is there in P&L, if it is there in P&L, you will ask yourself, is it an expense or an income? If it is an expense there in P&L, income tax will say either you should not have the expense or you can have the expense. If you say it should not have the expense, then you will disallow. If you say it should be there, P&L already has it, you also want it to be there, therefore ignore it off, no adjustment, no adjustment. Same way, people, if there is an income in the P&L, income tax says should not be there because it is other heads, you will reduce it. If there is an income tax says should be there, you will ignore it off. You will ignore it off because it's there in P&L, you also wanted it to be there, therefore no adjustment. Therefore no adjustment. On the contrary, if items are not there in P&L, not there in P&L, if income tax says this expense should have been there, you will allow, you are going to reduce, you're going to reduce. But if item is there, not there in the P&L, and income tax says it is an income which you should have put, you will add, That is how you have to work on it, people. Yes, that is why we are doing that workout thing, the practice session, where we'll come and tell whether the item is there in the P&L or not. Then you will answer whether it is to be there or not, and then we will make adjustments, but these 4 words are critical for you to keep in mind. Yes, keeping those 4 words, people, I'm going to tell you the chapter of PGBP. The chapter of PGBP comes and says, as you start the chapter, first thing you need to do is split your business into 2: speculative business, non-speculative business. Speculative business are those businesses where there is no delivery happening for the transaction. And therefore income tax says whatever losses you make from speculative business can only be set off against speculative profits. If there is no speculative profits, you can carry forward to set off against speculative profits for a period of 4 years, provided you file your returns on time. Yes. Items which are not speculative profits, people, some items which you need to keep in mind: any kind of derivative items, agricultural commodity products, any kind of other products listed on stock exchange, provided you pay STT and CTT on those. All those items are not called as speculative business. From an exam standpoint, I will tell you whether it is speculative or non-speculative transaction, so you don't have to worry about it. Yes, as you progress then further, people, we are going to start understanding what are the items income tax says can be allowed, allowed. So we will ask you what are the items which can be allowed, people. If these items are there in P&L already, you will ignore it off, because income tax is allowed. You also have it in P&L, no adjustment to make. No adjustment to make. We are starting with section 30 and 31. Section 30 and 31 comes and says, if you are going to have a building or a plant and machinery, whatever expenses you incur for it, if it is relating to business, allowed as deduction, except if it is capital repairs, because capital repairs will get added to the block to claim depreciation, added to the block to claim depreciation. That is section 30 and 31. Then comes section number 32, which talks about depreciation. Income tax says, if you want to claim depreciation in income tax, first of all disallow depreciation as per accounts. First of all disallow depreciation as per accounts, then we will do depreciation as per income tax. To do depreciation as per income tax, some rules to follow. There should be an asset. You should be the owner of the asset. Asset should be first put to use, and it should not be an asset of land, goodwill. It should not be an asset of land and goodwill. 4 conditions for you to satisfy in order to claim depreciation. If all the 4 conditions are satisfied, you can claim depreciation based on one method only, which is called WDV method. You can follow SLM method if you are in power sector, but power sector will not be tested in exam. WDV method is what you need to follow. Yes, when you follow WDV method, people, income tax says you need to tell me when was the asset first put to use. If the asset was first put to use for more than 180 days, you get full rate of depreciation. But if the asset was put to use for less than 180 days, you get half rate of depreciation. What is this cutoff date, people? It is 2nd October. Assets after 2nd October 50%, assets before and on 2nd October is 100% of depreciations. What are the rates of depreciation income tax is notified? Income tax is told if you are doing buildings, then it is 10%. If you are doing furniture, it is 10%. If you are doing plant and machinery, it is 15%. Vehicles is also 15%. Laptops is 40%. Printers is 40%. Computer software is 40%. Intangible assets is 25%. Ships are 20%. Flight airplanes is 40%. Books are 40%. Mobile phones is 15%. EPABX Yedo Puri Lana 15. It's always 15. Plant and machinery is the answer. 40% only happens when the asset is either going to depreciate faster or income tax feels that this asset is good for India. Good for India. Windmills 40%. Life saving surgical equipments 40%. All these items go into 40% brackets. Yes, yes. Apart from this, people, income tax comes and clarifies this is what you will be eligible for. But if you are a manufacturing concern who is going to bring in new plant and machinery, you will be eligible for additional depreciation at the rate of 20%. But if the asset was put to use for less than 180 days, claim 10% in year 1, 10% in year 2. This 10% is 10% of the cost of the asset. It is not 10% of WDV. So meaning original cost to the 10%, year 1 you claim that number, same number you will claim in year 2 as well. Same number you will claim in year 2 as well. Although please bear in mind, if you are doing default tax regime, no additional depreciation will be granted. No additional depreciation will be granted. How do you do WDV method, people? Income tax says start from opening asset. Start from opening asset, add all the assets which are put to use for more than 180 days, less than 180 days, not put to use. From this you will reduce one critical component called as sale value of the asset itself. Sale value of the asset itself. The value of the asset in sale terms, not the WDV, will get reduced directly. You will arrive at the cost of the block. On that cost of the block, if it is opening plus more than 180, do full depreciation, less than 180, do half depreciation, balance asset, no depreciation. You will arrive at your closing WDV. You will arrive at your closing WDV. Income tax comes and says at any appropriate stages, if the sale value goes more than the cost of the block, you will stop depreciation and move to capital gains. You will stop depreciation and move to capital gains. If that is not happening, but all the assets in the block are sold, then also you will stop depreciation and move to capital gains. You will move to capital gains. We will discuss when we do capital gains on that. How do you do cost of the asset, people? Same rules as accounts. All the cost which you have incurred until the asset is first put to use will get capitalized. Will get capitalized. Interest cost, borrowing cost, all your expenses which you incurred to bring the asset to installment and all those things, all costs will be taken into consideration. Remove any kind of ITC which you can claim as deduction. Remove any kind of subsidies which you receive from government, provided these subsidies are capital subsidies. Subsidies are capital subsidies. And one critical thing from income tax, do not take into consideration any cost which you have paid by cash more than 10,000 per person per day. More than 10,000 per person per day. Notice carefully, I am in asset right now. Nothing gets disallowed here because you never claimed it in P&L. I am only trying to ignore my cost for the purpose of depreciation. I am going to ignore my cost for the purpose of depreciation. Don't disallow something in P&L. Don't disallow something in P&L. Yes or no? Yes. After you do the cost, people, some special scenarios which you got in your Jan exam as well. Cases where asset cost will be in different terms. Income tax says take all the cost of the asset as it is normally, unless for two reasons. One, if you are bringing building from personal to office. If you are bringing a building from personal to office, you will depreciate for all that years it was there in personal and then bring the WDV to the business. Second, if you are receiving this asset as a gift, then whatever is the depreciated value alone will be brought into the business. Except for these two scenarios, whatever was the original price you paid for the asset will be the same price you will bring it in the business. So if you get an exam question which comes and says, I have a car which I bought 5 years ago in my home for 10 lakh rupees. Today market value is only 2 lakhs. You will bring it into the business for directly 10 lakh rupees. You don't care what depreciated value it is. But if the question says I bought a building for 10 lakh rupees 10 years ago and then I am right now bringing it into my business, I will take the 10 lakhs, depreciate for 10 years and bring the WDV to the business. That is what this section comes and says. Yes. Apart from that, people, you then move on forward to your next topics, which is your unabsorbed depreciation, where income tax says if you are going to make a loss in the business, the first priority of the loss will be given to your depreciation. To the extent of the depreciation, you will be called as unabsorbed depreciation, which can be carried forward for unlimited years and can be set off against any head other than salaries, whether in current year or in future years. Return filing condition is not mandatory. Any losses other than unabsorbed depreciation will be called as business loss, which you can carry forward for a period of 8 years, provided return is filed on time. This loss can be set off against any head other than salaries only in current year. In the future years, you can set off only against business incomes. After that comes in your section 35, people, which talks about scientific research. The logic is only one. All expenses allowed as deduction except for land. All expenses are allowed as deduction except for land is the rule. No matter where you pay it, it is allowed as deduction except the payment is used for land. Payment is used for buying a land. However, if you are going for default tax regime, income tax says under default tax regime, if you are going to contribute to someone else, meaning you are going to give a donation to someone else, that is not allowed as deduction. Under default tax regime, you can claim in-house expense. You can't claim donations. Under alternate regime, you can claim both. Provided it is not used for land. Please bear in mind, I am talking about me purchasing a land. If you get an exam question which comes and says, I have donated money and the person has used to buy a land, I will be eligible because I donated. He bought a land, his headache, not my headache. So I will still be eligible under alternate regime. Under default regime, will get disallowed because donations are not allowed as deduction. Same logic as unabsorbed depreciation, people. If you have any scientific research of capital nature, the loss coming from that will be treated same as unabsorbed depreciation, meaning that also can be carried forward for infinite years, can be set off against any head other than salaries. Yes. After that, people, comes in your 35 AD, investment linked business, where income tax is some businesses which income tax appreciates and would give you 100% of the deduction on his capital expenses, except for land. Items to be kept in mind: any kind of hospital with 100 beds, any kind of hotels with 3-star and above, any kind of warehousing facilities for sugar, agricultural produce, do not cover edible oils. These items are not eligible for 35 AD. Any warehousing facility for edible oil is a normal business. Income tax says take these businesses, whatever expenses you incur, 100% allowed as deduction except for land. Please ensure expenses are paid more than 10,000 only in permissible modes. Only then will you get the deduction. This whole section is not applicable under default tax regime. Under default tax regime, the capital expense will be allowed as depreciation. You don't get deductions on this. But yes, if you have a loss from 35AD business under alternate regime, you can carry forward the loss for infinite years. And set off only against profits from 35AD business. Any asset which you claim deduction under 35AD, you need to hold it for at least 8 years. If you decide to sell it within 8 years, whatever profit you made will be taxable under PGBP. If you sell it after 8 years to your existing business, then you can sell it to your existing business at zero value. But if you sell it to your existing business within 8 years, income tax will say, assume that this asset was already there in existing business and only allow the depreciation which you could claim till now. Balance everything will get reversed. And will be taxable under PGBP. After that comes 35AD people, where income tax says if you have any preliminary expenses, the rules will apply same as pre-construction interest. You can claim it over the next 5 years, subject to the condition that you only claim preliminary expenses of 5% of the cost of the project. And then comes your next items, people, your voluntary retirement scheme. Income tax says you can claim VRS for same 5 years. And then comes something called as family planning expenses for CA inter syllabus. Family planning expenses is disallowed for CA inter syllabus. Family planning expenses is disallowed because it can only be claimed by companies. You are only going to get a question for individuals and firms. You will not be eligible for this. So if you see an exam question says expenditure on family planning, disallow the expense of. Summary for you people: items which you can claim over 5 years, preliminary expenses, VRS expenses, family planning only for companies. All these expenses allowed over a period of 5 years. After that comes your other items, people: zero coupon bonds. Income tax says any loss which you make from zero coupon bonds, allow it over the number of months. Number of months will be calculated by using round off method, which means if there are less than 6 months, less than 15 days, you will ignore the month. More than 15 days, consider the month. When it comes to interest on borrowed capital, the rules will remain same as your borrowing cost standards. Any kind of interest which you incur for business, allowed as deduction. If you incur it for an asset, you will capitalize it until the asset is first put to use. After the asset becomes ready, put to use, you can claim the interest as deductions. However, if the interest is paid to any banks, PFIs, NBFCs and all, you will have to pay the money within due date of return filing, section 43B. You will have to pay the money within due date of return filing, section 43B. That has to be done. The amendment of current year to be paid attention to, people. Income tax says from current year, if you are going to contribute any money to NPS account for your employee, you can only contribute up to a maximum of 14% of his salary. If you contribute anything more than 14%, excess money will get disallowed. Where salary means basic plus DA forming part. That's all. Salary means basic plus DA forming part. Amendment question definitely will come for exam, mark important. Yes. Then you have your employers and employees PF. Income tax says when any contribution happens to any provident fund, any other fund for the welfare of employees, two people will contribute. Employer, employee. Employer's contribution is an expense for income tax, and therefore they said you have to pay this money before the due date of return filing. If you make the payment before due date of return filing, expenses allowed as deduction. If you don't make the payment before due date of return filing, I will disallow the expense and allow in the year in which you make the payment. When it comes to employees contribution, income tax says whatever money you get from the employee is an income for you. If you make the payment before the due date of the PF Act, you can claim it as deduction. Therefore, net effect becomes 0. However, if you don't make the payment before the due date of PF Act, income tax will not allow any deduction permanently, meaning this money will get deemed as income permanently. Even if you make the payment on a subsequent date, you will not be allowed as deduction. So pay attention to the fact, people, as to whether it is employer or employee. Employer is due date of return filing employee is due date of PF Act. Employers you can disallow, allow subsequently also. Employees once added as income, permanent income, permanent income. Yes, yes. Next you have bad debts provisions, where income tax says if you are going to create any kind of bad debts, I will allow it as deduction under income tax, provided two conditions are satisfied. Condition number one, you should have offered this income earlier. You should have offered this income earlier. Condition number two, the debtor should have been written off in the books. The debtor should be written off in the books. Two conditions you satisfy, I'll give you the deduction. Otherwise, no deduction. At subsequent stages, if you recover bad debts, that will become taxable under the head PGBP. Even if you don't have the business running, it will continue to be taxable under the head PGBP. At any stage, if the assessing officer has already disallowed the bad debts which you tried to claim, so much of that bad debts will not be offered to income on recovery basis. What does that mean? If I had tried to claim 5 lakhs in year 1, assessing officer only allowed 2 lakhs, meaning he did not allow 3 lakhs. Current year I recovered 4 lakh rupees. Will I offer to tax 4 lakhs? I will say, sir, in that 4 lakhs I already paid tax on 3 lakhs. So I am not paying tax on 3 lakhs, I am paying tax only on 1 lakh. 4 lakhs is in my P&L. I want to pay only on 1 lakh. I will reduce 3 lakhs. Correct? Yes. Pay attention to that. Then we get other sections, people, where they say if you pay any insurance premium and all, that is allowed as deduction as long as it is for business purposes. And then comes your section number 37, which says if any other expenses are not covered here, then we will cover it under 37. Rules to follow, that you have to follow same as accounting rules. It should be incurred by the assessee, should be revenue in nature, should be incurred for the business of the person or a profession of the person, should not be incurred for any personal reasons, and should not be a payment for any offense of a law. Any bribery, illegal payments and all not allowed as deduction. Some examples for you people: if I give any kind of free goods to doctors, not allowed, because prohibited under Indian Medical Council. I am coming and saying I have paid penalty to income tax department, expense will get disallowed. I have gone to income tax department and said, sir, don't put me in jail, I will pay compounding fees. Disallowed. I have gone to income tax department and said, sir, if I want to settle this proceedings, I am ready to pay you 2 lakh rupees, close the matter. Because illegal payment, this is illegal payment. I go to GST department and I say, sir, I want to pay interest to you because I did not file my GST return properly. Allowed as deduction. Penalties are disallowed. Interest is allowed. There is no restriction on interest. Interest is allowed as deduction. Interest on income tax alone is not allowed as deduction. So any income tax related payments fully disallowed. Any other law related payments, penalty is disallowed. Interest is allowed as deduction. I have paid donations to a charity. Donation payments to charity disallowed, not incurred for business. Donations paid to political parties disallowed. Any kind of building made for poor people disallowed. Again, CSR expenses, all your CSR expenses is also disallowed. Any interest paid to MSME, micro, small and medium enterprise, special notification says it is disallowed. Special notification for interest on MSME alone, it is disallowed as payment expense. It is disallowed as payment expense. Like I said, penalties are fully disallowed. Interest allowed under GST law, not allowed under income tax laws. This is your sections on deductions. Yes. Comes in next your sections on disallowances. Income tax says even if an expense is allowed till now, if you don't satisfy these conditions, I will disallow the expense. First and the most important thing from exam, we are looking at TDS defaults. Income tax says if you are going to have an expense, please ensure that TDS is done on the expense appropriately. If you have not deducted the TDS before 31st March, and whatever you deducted has not been paid before due date of return filing, the expense will get 100% disallowed under non-resident payments and 30% disallowed under resident payments. Understand, two conditions are there. First, you should deduct before 31st March. Second, you should pay before 31st October. Pay before 31st October, your return filing due dates, both to be satisfied in order to claim the expense. Anyone also not satisfied, expense will get disallowed. Expense will get disallowed. Notice this one carefully, people. I am coming and saying case number 4. Case number 4. Case number 4 says it's an expense of 2425. I have deducted on 9th April 25 and deposited on 6th June 25. People, will this get allowed or disallowed? It will get disallowed because I deducted after 31st March and therefore the payment got disallowed. Now I paid the money before due date of return filing. Doesn't matter because you did not deduct properly. You did not deduct properly. People, all expenses which are disallowed here will get allowed in the year in which the TDS is paid off. The TDS is paid off, or you have a proof that the other person has filed his return, offered this income, paid the tax and given you a proof for it. Either of the two, whichever happens, you can claim the deduction in that year. In that year. Yes or no? Yes. Look at next case, people. Case number 5. It says 2425 order case. I deducted on 26th July 25. I paid on 14th May 26. I paid on 14th May 26. People, deduction happened after 31st March. This expense will get disallowed. Will be allowed in the year in which TDS is paid off. TDS is paid off on 14th May 26, which means financial year 26-27. So I will disallow in financial year 24-25. I will allow in financial year 26-27. That is how it will operate. Yes or no? Yes. After 40AI and 40IA people comes here 40A2, which I said any kind of payments you make under income tax will get disallowed fully. Any kind of payments you make under income tax will get disallowed fully, whether it is tax, provision, interest, late filing fee, penalty, whatever it is will get disallowed. After that, people, you'll directly move to 40A5, where income tax says any tax on non-monetary perquisites, if it is exempt in the hands of employee, it will be disallowed in the hands of employer. It will get disallowed in the hands of employer, provided it is exempt for the employees. And then comes your critical one, people, 40A2, which talks about related party transactions. Income tax says if you are going to make a payment to your related party, please ensure the payment is happening as per market values. If you find that the payment is unreasonable or excessive, the extra expense will get disallowed. Three rules to follow in this, people. Rule number 1, this is only applicable if the expense is there in the P&L. Meaning if it is a capital purchase, you will ignore it off. Because it's not an expense. It's a capital purchase, will not be taken into consideration. Second, this section is only applicable if it is an expense. If you do an unreasonable sale, income tax will say no problem, let it go. This will only apply if you are doing unreasonable expense. Third, what do you mean by related parties? Income tax says left side of the family, meaning my spouse, my lenient ascendants, my lenient descendants, my siblings. Spouse siblings not covered, meaning even if you make a payment to spouse siblings for inadequate payments, unreasonable payments, excessive payments, all expenses are allowed as deduction. Only those expenses which are in P&L and given to my side of the family will get disallowed. Yes or no? Keep that one in mind, people. And then we are moving on to the next important section, section 40A3, which says when you have made payments other than by permissible modes, more than 10,000 per person per day, the expense will get disallowed. Permissible mode of payments are account pay, check, account pay, draft, electronic clearing system, any kind of other prescribed modes like debit card, credit card, Bheem Aadhaar Pay, NEFT, RTGS, IMPS, UPI payments, all those payments are considered as it, people. Yes, but if I tell you that I have claimed an expense in the past on accrual basis, accrual basis, and in subsequent year I make the payment in cash. Subsequent year I make the payment in cash. Income tax will say it was an expense of past, so nothing to disallow. But because you have made a wrong payment, I will deem it as income in the year of payment. In the year of payment, meaning I will add the number. I will add the number. However, exception to the rules, people, income tax says if the payment is happening to a transport operator, no disallowance if it is up to 35,000. No disallowance will happen if the payment is made to a farmer. Made to a farmer for buying agricultural produce. But please ensure it is only a farmer. Any kind of trader, middlemen's, not allowed. Any kind of payments made to a person who's deputed to a different location, for more than 15 days, where he does not have a bank facility, payment is allowed. If it is made on a date when the bank is on a holiday, payment is allowed. If it is made to an employee for retirement benefits up to 50,000 rupees, allowed. If it is made to your agent for buying goods and services, payment is allowed. If the payment is made to RBI and all those things, payment is allowed. If I am doing a book adjustment, I am opening my creditors, you are opening your debtors, we will cross adjust. This is also allowed as a deduction. This is also allowed as deduction. This is what is 40A3. This is what is 40A3. Yes. After 40A3 people comes 40A7, where income tax says if you have any provision for gratuity which you created during the year, I will only allow it as a deduction provided you make the payment before due date of return filings. If it is an unapproved gratuity, then it is not allowed as deduction itself. It is not allowed as deduction itself. If you are going to make payments of the following natures, any kind of tax, duty, cess, any kind of employer's contribution to funds, any kind of interest paid on loans taken from banks, PFIs, NBFCs, any kind of bonus and commission paid to employees, any kind of leave encashment to employees, or any kind of use of railway assets, please ensure that the payments are happening on or before due date of return filing. If the payment happens after the due date of return filing, I will disallow the expense, allow it in the year in which actual payment is made. However, from last year, if you are going to make a payment to micro and small enterprise, more than 45 days, the payment will get disallowed after the 45th day and will be allowed only in the year in which payment is made. However, if you don't have an agreement with the person, oral agreements, your due date becomes 15 days, you will disallow it after 15th day, allow it in the year in which payment is made of. Please note, it is only for micro and small enterprise, not applicable for medium enterprise. Medium enterprise, even if the payment is late, it is allowed. But medium enterprise, interest is not allowed. Interest Puerto Rico, micro, small, medium, all disallowed. But actual payment Puerto Rico, micro, small, disallowed, medium allowed. Medium is allowed as deduction. Also, people, income tax says if you have interest which you have not paid of the past, and that got disallowed. In the current year, if you decide to convert the interest into a loan, you will not be allowed the deduction merely on conversion. You will be allowed the deduction only when the loan is repaid off. That is what 43B comes and talks about, important section from exam perspective. After that comes your last leg, people. If you are going to end up in a firm, whatever you did till now is correct. One small adjustment you will make. You will start talking about what payments are happening to partners. Income tax says partners can receive three kinds of payments. One is share of profit, interest on capital, any remuneration payments. Income tax says if a share of profit is given to a partner from a partnership firm, it is exempt in the hands of partners. If the partner receives any interest on capital, he will be allowed 12% of the capital as an interest. If he receives more than 12%, that extra money will be exempt in his hands because it will be disallowed in the hands of firm. So if the firm pays more than 12%, firm will take a disallowance, partner will only be taxable for 12%. And if the partner is receiving salary, if the partner is receiving salary, income tax says firm will first compute something called as book profits. Firm will compute something called as book profits, where what income tax will do is, income tax will say compute the full PGBP, compute the full PGBP, disallow whatever salary you already paid, disallow already what you paid as salary, allow any kind of unabsorbed depreciation of past years, allow any unabsorbed depreciation of past years, you will arrive at the book profit. Take this book profit for the first 6 lakh rupees, amendments of current year, for the first 6 lakh rupees, you will be allowed a 90% of the 6 lakhs or 3 lakh rupees, whichever is higher, and for all the balance it is 60%. For all the balance it is 60%. This will give you the number which firm can pay, which firm can pay. Then you will ask a question, how much did they actually pay? How much did they actually pay? Whichever is lower will be allowed as deduction. Income tax says you can pay 5 lakhs. I have only paid 4 lakhs. I will give deduction of 4 lakhs. I'll give deduction of 4 lakhs. That will be allowed as deduction, thereby arriving at your PGBP. Thereby arriving at your PGBP. So what is the answer, people? Start with your PGBP. Disallow any salary already paid to partners and allow any kind of unabsorbed depreciation. You will arrive at book profit. Compute the salary as per income tax. Compare that salary with the actual salary, whichever is lower, and you will arrive at your PGBP. You will arrive at your PGBP. Yes or no? Yes or no? That is what your PGBP provisions are regarding your partners. Regarding your partners. Once you do your computation, people, some administrative provisions to be mindful of. First administrative provision comes and says all people who are doing business will have to maintain books of accounts. Will have to maintain books of accounts. Books of accounts will need to be maintained if you are in profession having a gross receipts more than 1,50,000 for the last 3 years. All the last 3 years you should have more than 1,50,000. If you are into business, you should have a PGBP more than 2,50,000 or a turnover more than 25 lakhs in any of the last 3 years. If you are not an individual or a HUF, then it is 1,20,000 and 10 lakh rupees. 10 lakh rupees in all the last, in any of the last 3 years. If a professional satisfies the condition, he will maintain books as per what income tax says. As per what income tax says. If he does not satisfy the condition, he will still maintain books, but whatever he wants. Whatever he wants. If he is in business, and satisfies condition, he will maintain books, but whatever he wants. But if he is in business and does not satisfy condition, income tax says don't maintain books. Don't maintain books. If you have been obligated to maintain books and you don't maintain books, income tax says you'll be levied a penalty of rupees 25,000. You'll be levied a penalty of rupees 25,000, and whatever books you have to maintain it for at least 6 years from the end of the assessment year. From the end of the assessment year. For all the people who have books, if you are having a turnover more than 1 crore, income tax says you'll need to get a tax audit done in business, and a turnover more than 50 lakhs in profession, you'll have to get a tax audit done for your profession. However, if you are in business, where 95% of your payments and 95% of your receipts are happening in permissible modes, you will not be required to do tax audit until 10 crores. You will not be required to do tax audit until 10 crores. That is what the section says. All people who are liable for tax audit will furnish the CA certificate 1 month before the due date of return filing. So because your due date is 31st October, you will furnish it by 30th September. You will furnish it by 30th September. Failure to furnish a tax audit report makes you liable for penalty at the rate of 0.5% of the turnover or 1,50,000, whichever is lower. Once you're done with tax audit, people, income tax says if you are going to be a person having a business turnover less than 2 crores, you can opt for something called as presumptive taxation. But if you tell me that 95% of your turnover came by permissible modes, then you will be eligible for presumptive up to 3 crores. Where income tax says if you are an individual, HUF or any kind of firm not being an LLP, you can opt for presumptive at the rate of 6%, provided the money is received by permissible modes and is received before 31st July and is received before 31st July of assessment year. 31st July of assessment year. But if you are going to have a person who's not receiving the money by permissible modes or receives the money after 31st July, you will tax it at the rate of 8%. You'll tax it at the rate of 8%. If you choose to offer presumptive income, income tax will say you don't need to do anything under normal business. No PGBP computation to be made. All adjustments of PGBP are assumed to be done. No further adjustments will be required. Person opting for presumptive will have a due date of 31st July. Person opting for presumptive need not maintain books nor get them audited. But if he decides to not do presumptive, he will have to maintain books, get them audited, file the return by 31st October. Person opting for presumptive also has a benefit that he only needs to pay the last installment of advance tax, which is 15th March. But if you are a person who chooses presumptive, you need to do presumptive for the next 5 years. Opting out of presumptive in the next 5 years means you become ineligible for presumptive for the next 5 years. After business comes in something called as profession, where income tax says if your professional receipts are up to 50 lakh rupees, you can opt for presumptive. But if you tell me that your turnover by 95% is in permissible modes, you can opt for presumptive up to 75 lakhs. Any person under this category can offer presumptive up to 50% of your gross receipts. Choosing to offer 50% means you don't need to do any PGBP computation. You will not be liable to maintain books. You will not get them audited. Your due date becomes 31st July. Opting out means you will have to maintain books, get them audited, file return by 31st October. Rules remain the same. The last presumptive topic is what we call as transport operators, where income tax says if you are a transport operator holding less than 10 vehicles at any time during the previous year, less than or equal to 10 vehicles at any time during the previous year, you can opt for presumptive taxation. Where you will split your vehicles into two: heavy good vehicles, others. Heavy good vehicles means all those vehicles where the metric ton is more than 12. If you are having a heavy good vehicle, you will be taxable for 1000 rupees per ton per month per vehicle or part month thereof. For every month the vehicle was in use ownership. For every month the vehicle was in ownership. Use is not a criteria. If you are not a heavy goods vehicle, you are having normal vehicles, and it is 7500 rupees per month per vehicle. For every month this vehicle was in ownership. If you are under presumptive taxation of transport operator, same rules will apply. The moment you offer presumptive, no other adjustments will take care of. But extra benefit granted to you, you can claim salary to partners, interest on capital. This one thing you can do only under transport operators. You can't do it under business and profession. And your due date remains at 31st July. Maintaining books not required. Maintaining audit not required. Opting out of presumptive means maintain books, get them audited. 31st October becomes a due date. One exception between this and the other sections is, people, here even though you are opting for presumptive, advance tax will happen in 4 quarters. Whereas for the other two, advance tax was happening in last quarter alone. So two extra things which happen in this presumptive, people: you can claim all remuneration to partners and all interest on capital to partners. Second, you will pay advance tax in 4 quarters. All other provisions remain the same as other presumptive taxations. Bear in mind that in exam, presumptive taxation will not be informed. You will have to check for the turnover of the business, turnover of the profession, or the number of vehicles this person has, and then decide whether you should do presumptive or don't do presumptive. Yes, this is something you need to keep in mind from your side. Clear? Yes, this is your topic on PGBP. The topic of capital gains, people, important topic for the current year exams, because hell lot of things have changed in capital gains. A lot of changes to be discussed from an amendment perspective. So let's pay attention on capital gains and we'll try to figure it out together. Yes, the provisions of capital gains basically come and say if you want to tax something under the capital gains, there should be two things which is happening. One, there should be a capital asset. Second, it should be a transfer of capital asset. Two things happening for capital gains to take place, and in that case the capital gains will be taxable in the previous year in which the transfer takes place. What do you mean by capital asset in income tax, people? Income tax says capital asset means any asset except for items like stock in trade because it is taxable under PGBP, except for items like rural agricultural land because it is exempt under agricultural income, and items like personal movable effects, because these are exempted from taxes unless the items are BA, pass, DJ, bullions, archaeological collections, paintings, any work of art, shares, sculptures, drawings, jewelry. These items are taxable, all other items are exempt. One question which comes from the back of my head, Jan 25 came and said STCG on sale of home fridge or something. STCG on sale of home fridge or something. There it was exempted from taxes because it is a personal movable effects. Yes, keep that one thing in mind. Apart from that, people, income tax says if there is any weird asset, like 6.5% gold bonds, all those bonds and all, exempted from tax. Interest coming from that also exempted from tax. Take that as a boon. Yes. How do you do capital gains, people? Income tax says from the current year, your period of holding will undergo a slight modification. But that will happen from the middle of the year. From 23rd July, the period of holding is as follows. All listed securities get a period of holding of 12 months if they want to be long term. All other assets will be having a period of holding of 24 months if they want to be long term, except for one item which was a last minute change. They said slump sale remains at 36 months. So which means all assets have moved to 24 months except slump sale. For those who have my physical copies, this will not be there in your books. Please make that note of it. Slump sale is still at 36 months, even though everything else has moved to 24 months. Yes. However, if your transfer is before 23rd July, income tax at business trust units, which was now 12 months, will have been 36 months, and all other assets like jewelry and all, which was earlier 36 months, is now 24 months. That is the only difference between the amendments, people. Basically, the rules remain the same, just that all other assets moved from 36 to 24, business trust units moved from 36 to 12. That is the only difference, which means depending on the date of transfer, your period of holding will undergo a change. Yes, but the amendment of current year also comes and clarifies, people, after 23rd July, if you have sold any unlisted bonds or debentures, these assets will forever be called as short-term capital assets. Meaning if the asset is sold before 23rd July, they had a period of holding of 36 months. But if they are sold after 23rd July, they are always short-term assets. Yes, sir. That is your period of holding rules, people. After that comes in a definition of transfer, where income tax says transfer would be any of the items. It can either be a sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capital asset into stock in trade, any kind of part possession happening based on transfer of movable property assets. If you are going to have any kind of enjoyment of rights in cooperative or companies, all those things are called as transfer definition. The rule to be kept in mind here is that, people, normally transfer takes place on the date on which the sale deed is executed. That is what the rule is. However, income tax also comes and clarifies some cases where it is a transfer. I am saying it is not a transfer. Item number 1, the most important thing, gift. If you are going to give someone a capital asset for nil consideration, this transaction is not regarded as transfer. Bearing in mind one thing, this is for only nil consideration, not for inadequate consideration. Inadequate consideration is still a transfer. This is only not a transfer when it is nil consideration. This is a little different from IFOS, people, because in IFOS you are taxing nil also, inadequate also. Here you are exempting only nil consideration. Income tax says if you have any nil consideration transfers, then it is not treated as capital gains. But the amendment of current year says this can only happen by an individual or a HUF. This can only happen by a individual or a HUF. If any gifts like these happen by an individual or HUF, the cost of acquisition in the hands of new owner will be cost to previous owner. The period of holding of the new owner will start from previous owner. That is what the provisions come and clarify. Yes or no? Though bear in mind, people, that if the other person is going to be taxed under IFOS, then in that case these rules will not apply, because in that case he will take the gift element and add it to his cost, and his period of holding will start from that date, which means this rules only apply if IFOS is exempt These rules only apply if IFOS is exempt. Yes or no? Yes. Second, people, any kind of distribution happening on partition of HUF, whether it is total or partial. Third, if you are going to transfer anything between holding company to wholly owned subsidiary or wholly owned subsidiary to holding company, provided the person receiving the asset is an Indian company, meaning asset should come to India, asset should not go out of India. Asset should not go out of India. And then all other items you can ignore off. The last item to be kept in mind is your transfer on account of reverse mortgage. Transfer on account of reverse mortgage. Any transfer happening on reverse mortgage is also exempted from tax. For all these things, there is only one rule. Cost of acquisition of the new person is cost of old person. Period of holding of new person is period of holding of old person. That is what the rules are. Yes. Amendment for you to remember, and this is what has come in Jan 25 also, that when it comes to reverse mortgage, all transactions happening in reverse mortgage is exempt, whether you're talking about asset or you're talking about installment receipt In the whole reverse mortgage, there is only one transaction which is taxable, that is sale of the asset due to non-compliance. Sale of the asset due to non-compliance, meaning I have an asset, bank has taken my asset and sold it off because I am not paying money. In that case, whatever money bank realized will be taxable in my hands as capital gains. What money I give to the bank, exempt. What money bank gives me, exempt. All things are exempt. The only thing taxable is the money which bank gets on sale of my asset. Yes or no? Yes. In this, people, then income tax comes and says, what are the transactions? How do you tax capital gains? You'll have to prepare a template. The template starts with saying what is your full value of consideration. Reduce something called transfer expenses. Arrive at your net consideration, from which you will remove cost of acquisition, cost of improvement. Capital gains will get arrived. If you are doing this transfer before 23rd July and the asset is a long-term capital asset, cost of acquisition will be called indexed cost of acquisition, cost of improvement will be called indexed cost of improvement. But if it is after 23rd July, no matter what you sell, everything will be cost of acquisition, cost of improvement. How do you find your full value of considerations, people? Income tax says full value of consideration is nothing but the amount which you received for transferring the asset. However, two rules for you to keep in mind when it comes to full value of consideration. If it is an immovable property, you need to sell this property at least at stamp duty value. If you sell it at a price lesser than stamp duty value, income tax will assume stamp duty value as your full value of consideration, whereas this rule will not apply if your stamp duty value is within 110% of your consideration. Where two stamp duty values are given, you can take the stamp duty on the date of transfer. You can also take the date of agreement, provided advance is received by permissible modes. If you are not satisfied with SDV, you can approach valuation officer and request for an FMV. If FMV comes lower than SDV, you can take FMV. If SDV comes lower than FMV, you can consider SDV. In simple words, it is FMV or SDV, whichever is lower. That answer compared with sale value, whichever is higher. However, this whole thing will not apply if the SDV is within 110% of consideration, in which case you can directly take the actual sale value. Second, if you are planning to sell any unquoted shares, income tax tells please sell it at FMV. If you sell it at a price lower than FMV, income tax will assume FMV as the full value of consideration. This is what FEOC looks like. After FEOC comes, people, something called cost of transfer. Income tax says any expenses you incurred for making the transfer will be allowed as deduction, except for one item which is called STT payments, securities transaction tax, because the moment you pay STT, you get a beneficial rate of 112A, 111A, and 111A. So therefore, STT cannot be claimed as a deduction. Then after this, you arrive at something called as net consideration. From the net consideration, people, you can remove your cost of acquisition. Income tax says cost of acquisition is the price which you paid for buying the asset. But if you bought the asset before 2001, you can take FMV on 2001 or actual cost, whichever is higher. However, if it is an immovable property, then it is FMV on 2001, SDV on 2001, whichever is lower, that is compared with the cost, whichever is higher, At any appropriate stage, if you receive bonuses, the cost of acquisition for a bonus share is 0. The cost of acquisition for a bonus share is 0. If you have paid any STT, that is also ignored because you cannot claim it as deduction. Income tax amended the provisions last year and came and clarified. If you have any interest on loan, which you have paid for a house property, you can add it to the cost of acquisition, but don't take it into consideration provided you have already claimed it as deduction either under HP or under chapter 6A, which means indirectly they are coming and saying if an interest on loan is not claimed, you can add it to the cost. That's what the provision comes and clarifies, and everything else is fairly okay, people. You don't need to remember all those things. The cost of improvement provisions basically come and say all extra activities you have done after you bought the asset, if they are capital in nature, will be called as cost of improvement. But if you have a cost of improvement which is done before 2001, please ignore it as it is. You don't take cost of improvement before 2001. That will not be taken into consideration. Some special scenarios for you to keep in mind, people. Special scenario number 1 comes in for cases where you are not taxing it in the same year of transfer. You are saying I will have a asset transferred today, but I will not pay tax on it today because I have not received money. Cases of those are case number 1, insurance compensation. Income tax says if an asset is destroyed and you have applied for insurance, the asset is transferred on the date on which the asset is destroyed, but the money will be taxable only in the year in which the compensation is received. Here is a warning for you. If you get a question in exam and the question exam comes and says that asset was destroyed in the month of April, insurance money came in the month of Jan next year, you will tax it in Jan based on new rules, old rules. You will tax it based on old rules. People understand transfer took place in April, which is before July. Therefore, old rules will apply. You are only delaying payment of tax. You are not delaying computation of capital gains. Capital gains will be computed when asset is destroyed. The payment of tax alone is happening in the year in which money is received. Yes or no? Now, people, because it is happening as per old laws, you will be eligible for indexation. Tax rate will be as per old rates. So this is one thing very critical for current year exam. Focus on the fact that even if taxability happens subsequently, if the transfer happened before 23rd July, you will follow old rules. Yes or no? Yes. First item, people, insurance compensation. After insurance compensation comes conversion of capital asset into stock in trade, where income tax says if you are having a capital asset, you want to convert into stock in trade. Two transactions are taking place. First, you are converting capital asset into stock in trade. Then you will sell the stock in trade. So first you will get capital gains. Second, you will get PGBP. People, what did you buy? I bought a capital asset. So my cost of acquisition is as per capital asset. I sold stock in trade. So my sale value is as per stock in trade. I have an interim middle pending. The item which is converted from capital asset into stock in trade. Income tax says do nothing. Assume that you have sold the capital asset in the market and bought stock from the market. If you are selling capital asset in the market, full value of consideration is FMV on the date of conversion. I bought it from the market as stock in trade. I will buy it at FMV on the date of conversion. So income tax in simple words comes and says when an asset is converted from capital asset into stock in trade, the FMV on the date of conversion will be the sale value for the capital asset and the cost value for the stock. However, please understand, I am only converting. I have not received money, and therefore this will be taxable only in the year in which stock is sold off. The reverse of this is not true, people. If you are converting stock in trade into capital asset, First activity happening is PGBP. Second activity happening is capital gains. Income tax says the FMV on the rate of conversion will be the sale value for stock in trade, cost value for capital asset. First you will accrue PGBP, second you will accrue capital gains. Can you defer PGBP for the purpose of capital gains? No, which means PGBP will be taxable in the year in which the asset is converted, whereas capital gains will be taxable in the year in which the asset is transferred. So notice this carefully, people. Capital asset into stock in trade, both will be paid together when stock in trade is sold. Stock in trade to capital asset will be paid when capital asset is sold, but stock in trade will be paid when the asset is converted. When the asset is converted, the formula remains the same, the year changes. Next comes your important one, people, which is your compulsory acquisition, where income tax says if you have an asset which has been compulsorily acquired by the government, the date on which the asset is taken over is the date of transfer, but the year of taxability will be the year in which you receive the first installment of money. If you are not happy with the compensation, you can apply to court for an enhanced compensation, in which case the enhanced compensation will be taxable in the year in which the compensation is received. At any appropriate stages, if you go to the court and ask for an interim compensation, the interim compensation will only be taxable in the year in which the final order is received. That is what the whole template is here, people. Compensation is of two types: initial, enhanced. Initial taxable when first installment is received. Enhancement is checked into two. If it is interim, tax on final order. If it is final, then tax on money receipt. Although bear in mind, people, when it comes to enhanced compensation, there is no cost of acquisition, because the whole cost is given to initial. Therefore, whatever money you receive, fully taxable. You can only claim legal charges if you want. But the critical part here is the capital gains of enhancement will have the same nature as original. Which means if original is long term, enhancement is also long term. If original is short term, enhancement is also short term. At all these stages, people, if government is not giving you the money on time, you can request for interest on enhanced compensation, which gets taxable in the head IFOS in the year of receipt only to the extent of 50% of the amount received. And then you move on forward, people, to some special scenarios. First case of bonus shares. Income tax says when you receive bonus, cost of acquisition is 0. When you receive right shares, you have two options: either I can exercise the right or I can renounce the right. If I exercise the right, the price I pay to the company is my cost of acquisition. If I renounce the right, I made a profit. Whatever price at which I sold is my capital gains. The person who bought the rights from me will now pay two money, one to me, one to company. So his cost of acquisition is renunciation price plus exercise price. That is what will happen. Important part here is your depreciable assets, people. Income tax has come and clarified when it comes to depreciable assets, this will only happen when the block ceases to exist. Block will cease to exist in two scenarios: either sale value is more than the cost of the asset, or the whole asset in the blocks have been sold off. In which case you will compute capital gains by using the same formula. Full value of consideration will be the money received. Cost of acquisition will be the WDV of the assets, thereby arriving at something called, short-term capital gains or short-term capital loss. Depreciable assets will never be long-term. Can you give indexation on this? No, you can't give indexation on this. Even under old regime, no indexation was allowed on this. After depreciable assets, people, comes in your other items. The first amendment, like I told you, if you have any unlisted debentures and bonds in the current year and they are transferred after 23rd July, the asset will always be termed as short-term assets. If they are transferred before 23rd July, you will get a period of holding of 36 months in order to compute long-term. And then your 50C, which is what we discussed just now. Item other than this, people, to be kept in mind is something called as advance forfeiture, where income tax says if there is a advance money you received, if there is an advance money you received which you have forfeited, income tax will ask you, tell me when did the forfeiture take place. If the forfeiture took place before 2014, you will reduce it from the cost of the asset. If the forfeiture took place after 2014, you will tax it under the head, in the year of forfeiture, you will tax it under the head IFOS. That is what forfeiture comes and talks about. After you have done all this, people, the only thing left off is to grant exemptions. 3 exemptions for you to keep in mind: exemption of 54, exemption of 54 EC, and exemption of 54F. Exemption of 54 comes and says, if I have sold a house, and in turn bought a house, I will get 54. I'll get 54 to the extent of the money invested or capital gains, whichever is lower. However, income tax has some rules. Rule number 1, what you are buying should be a residential house property situated in India. Rule number 2, you can only invest in one residential house property. However, if you have long-term capital gains less than 2 crores, you can invest in 2 house properties for once in your lifetime. Rule number 3, you can invest only 1 year before or 2 years after the date of transfer, or if you are constructing, please complete construction within 3 years from the date of transfer. Until such time, please ensure that the money is invested in CGAS scheme before the due date of return filing. That is what the rule says. How much to invest, Rahul? I have to invest the capital gains. If I invest capital gains, I'll get full exemption. If I invest lesser than capital gains, I'll get less exemption. But amendment of last year comes and clarifies, you cannot invest more than 10 crores. If you invest more than 10 crores also, income tax will give you maximum 10 crores of exemption. Finally, whatever asset you are planning to buy, please hold the asset for a period of 3 years. If you transfer it within 3 years, whatever exemption you claimed earlier will be reduced from the cost of asset. This is section 54. Then comes 54 EC. Section 54 EC basically comes and says, if you are planning to transfer any land and building, including residential house property, and in turn are you planning to buy any kind of NHCI, REC, other notified bonds, you will be given an exemption under 54 EC for a maximum of 50 lakh rupees per annum. 50 lakh rupees per annum will be granted to you. Yes or no? Conditions to this, that you have to invest the money within 6 months from the date of transfer, and you cannot invest the money in CGAS scheme. Whatever bond you are planning to buy, please hold it for a period of 5 years. Failure to do so will tax the whole exemption in the year of violation. Amount to invest in this is your capital gains. Leaves you with the last section, people, 54E F. 54F basically comes and says, if you are transferring some other asset and in turn buying a residential house, you will be granted an exemption under 54F. Rules are same. You should invest the money within 1 year before, 2 years after, or complete construction within 3 years. Until such time, keep the money in CGAS scheme. Asset held should be held for a period of 3 years. Violation to do so will tax your exemption in the year of violation. The critical point in this one is that, people, you have to invest your net consideration. Here you don't invest capital gains, you invest net consideration. If you invest net consideration, I will give you capital gains exemption. If you invest less than net consideration, I will give you proportionate exemption. What does that mean, people? If my capital gains is 10 crores and my net consideration is 50 crores, if I invest 50 crores, I get 10 crores. If I give 40 crores, I will get proportionate change. Yes or no? That is what proportionate means. But here also there is a disclaimer. Income tax says you cannot invest more than 10 crores. If you invest more than 10 crores, I will assume you have only invested 10 crores and you will get proportionate exemption. That is what the rules is. Other than these, people, there is 54B, 54D and all, you can ignore it off. You can ignore it off. There is only one simple thing to be kept in mind. If you get a capital gains exam question, and the question then subsequently says in next para, the person has invested this money in some other asset, it is exemption. Take the money and exempt it off fully. That's all. Yes, that is what the answer would be. So randomly they'll give you a question. They'll come and say, I've bought a land, I've sold the land, then I again bought a land. People, when you sell the land, you will get capital gains. When you buy the land, you will get exemption. That is all the answer is. Take the number and exempt it off. That is what you have to do. Don't worry about conditions. Income tax will not ask you that. Three things for you to keep in mind. 54 EC, 54F. Once you do all these exemptions, people, you will arrive at your capital gains, where income tax says capital gains can be of four kinds. Long-term capital gain 112, long-term capital gain 112A, short-term capital gains 1A, and short-term capital gains others. If you are doing long-term capital gains 112A, it is taxed at the rate of 12.5% post 23rd July and 10% before 23rd July, but the whole capital gains will be eligible for an exemption of 1.25 lakhs. If you are doing 112, then you will be taxing it at 12.5 post 23rd July, 20% before 23rd July. If you are doing 111A, it will be taxable at 20% post 23rd July, 15% pre 23rd July. That is what the rules will say. Yes, however, the amendment of current year and a short question for your exam, which says that if you are going to transfer a long-term capital gain, which is an immobile property by an individual or a HUF resident, income tax says if you transfer it post 23rd July, you will not do tax as per new rates. You will do tax as per new rates, tax as per old rates, and check whichever is lower. That will be the final tax to pay. Income tax says you have to do it as such. You will take the long-term capital gains on land and building and then do tax at the rate of 20% with indexation, tax at the rate of 12.5% without indexation, and compute whichever is lower. The word of caution here is that people, this will only affect your tax. It will not affect your income. Your income will be as per new regime. You will not do income as per old regime. Yes. So if the asset is transferred after 23rd July, income will always be as per new only. Meaning income will be without indexation. When you compute tax alone, you will do whichever is lower. How to do indexations, people? Income tax says take cost of acquisition, multiply by CII in the year of transfer, divided by CII in the year of acquisition or improvement, as the case may be. If the asset is purchased before 2001, you can take 2001 ka indexation, which is 100. That is what the rule is. Finally, people, if you are going to have a 112 asset, which you purchased before 31st January 2018, income tax says you will have to compute the cost a little differently. If the asset is purchased before 31st January 2018, take the FMV on 2018 or sale price, whichever is lower, and then compare it with the actual cost, whichever is higher. This will become your revised cost of acquisition. How do you determine the FMV? You will take the highest price which is available on 2018. Here it is not average. Here it is highest price. That is what the rules are when it comes to 112A. There is no rocket science in 111A. 111A remains the same. Do 20% post and 15% pre. People, can you claim rebate on 111A? Yes. Can you claim rebate on 112? Yes. Can you claim rebate on 112A? No. Surcharge for 111A, maximum 15%. Surcharge for 112, maximum 15%. Surcharge for 112A, maximum 15%. That is what the rules are. Can you do Kaju Katli for 112A? Yes. Can you do Kaju Katli for 112? Yes. Can you do Kaju Katli for 111A? Yes. Basically, if the basic exemption limit is not utilized, you can adjust capital gains against them only if you are a resident individual or a HUF Only if you are a resident individual or a HUF, that is what the provisions come and clarify. Yes, now people, if you are doing an asset transfer before 23rd July, normally 112A is not eligible for indexation whatsoever. Short-term capital gains was never eligible for indexation whatsoever. Every other 112 asset before 23rd July is eligible for indexation except for two items, bonds and debentures. Bonds and debentures, meaning bonds and debentures before 23rd July also was not eligible for indexation, will not be eligible for indexation even now. What is the point I am trying to make, people? Unlisted bonds and debentures before 23rd July will be long term but without indexation. After 23rd July will be short term. So anyway, no indexation. So anyway, no indexation is what the rule says. Clear enough? Yes, yes. After that, people, comes the next chapter. The next chapter talks about what are your business reorganizations. What are your business reorganizations? Income tax says you may have three types of business reorganizations for inter-syllabus. One is called amalgamation, one is called demerger, and one is called slump sale. Income tax says if you do amalgamation in the nature of merger, same as AS 14, all the transfer will be exempt from tax. In which case the cost of acquisition for the amalgamating company will be cost of acquisition of the amalgamated company. Period of holding of amalgamating company will be period of holding of amalgamated company. The cost of acquisition of amalgamating company will be taken as cost of acquisition of amalgamated company. At the same time, people, because amalgamation has taken place, the old company shareholders will get the shares of new company, and therefore the share cost of acquisition of the new company will be the share cost of acquisition of old company. Period of holding of the new shares will be period of holding of old shares. The rules remains the same. The reverse is demerger. Demerger comes and says you have an asset which you have split into two. Income tax says if a split happens based on the same accounting standards, basically transfer at book value, transfer of all assets and liabilities, do not take any cash in middle and all those things, then in that case demerger is also exempted from tax. Cost of acquisition of the resulting company will be cost of acquisition of demerged company. Period of holding of resulting company will be period of holding of demerged company. Shareholder will receive shares of new company also and will have old company also. Do nothing, take the cost and proportionate into both depending on how much net worth is there in new company and how much net worth is there in old company. Yes, so if you have paid 1000 rupees for the old shares and currently the new company has 500 crores in old and 500 crores in new, 1000 will get split into 500. That is what the proportionate is. So the old cost of acquisition of the shareholders cost will get split in the ratio of net worth of the companies. The one thing which you need to pay attention, and probably you did when you did Jan 25 exams, we are looking at what is called as slump sale. We are calling it slump sale. Income tax came and said if you are going to transfer a business undertaking as a slump sale without assigning values to any individual assets or liabilities, you will be taxable for the same. Where the full value of consideration of the business undertaking will be the actual sale price or FMV of the undertaking, whichever is higher, less whatever is your transfer expenses, you will arrive at net consideration. From this net consideration, remove something called cost of acquisition. For a undertaking, cost of acquisition is the net worth of the business, where net worth means assets minus liabilities as per income tax. Meaning whatever value is there in income tax is the value. So depreciable assets order value will be WDV as per income tax. Goodwill order value will be 0 because intangible asset. Any kind of section 35 assets, scientific research assets, cost will be 0. 35 AD assets cost will be 0. Provision for tax will be 0. People, tax and all you cannot take in income tax, so those things are 0. Provision for bad debts will be 0 because I told you provision for bad debts is not allowed under income tax. So all those things will be taken into consideration. You will arrive at the net worth. Keeping that net worth, you can find out the capital gains. People, like I said, slump sale Puerto Rico, capital gains will be if your period of holding is more than 36 months. If your period of holding is more than 36 months, it is long term. If it is less than 36 months, it is short term. But whether it is long term or short term, there is no benefit of indexation. There is no benefit of indexation. Even if the slump sale happens before 23rd July, no indexation for the same. No indexation for the same. Like I said again, people, for those who have the books, you will find here as 24 months. Please delete that off and make it 36. Please make it 36 months here. Yes, yes. That leaves you with the last topic, people, which we have already discussed. What happens if you transfer income between shareholders to companies? You can transfer it in three formats. One, either as dividends, which we already discussed. Second, either as liquidation proceeds, where income tax says if you have given someone money under liquidation, to the extent the company has accumulated profits, you will tax it as dividends. You tax it as dividends. Whatever balance you get will become your full value of consideration. Will become your full value of consideration. Leaves you with the last and the amendment of the current year, people, where if you receive any kind of buyback money, the whole of the buyback money will be taxable as dividends under the head IFOS, regardless of whether the company has accumulated profits. Whatever cost you paid for the shares will be treated as capital loss, will be carried forward for a period of 8 years to be set off as per capital loss standards. To be set off as per capital loss standards. That is what your buyback will look like. Yes, yeah. We're starting with the revision on IFOS, people. 2 chapters in my book. I've split IFOS into 2 separate chapters. One is called IFOS, one is called dividend income. We're going to discuss both together and understand what is happening. Yes, the chapter of IFOS basically simply comes and says if you have an income which is not going to be taxed under other heads, you start taxing it under the head IFOS. Some examples of this is dividend income. Some examples of this is lottery income. Some examples of this is composite rent, house property related rent, which is not pertaining to house but pertaining to amenities. Examples would be all interest which you are receiving on deposits. Interest which you are receiving on deposits like savings, FD, RD, post office savings, where income tax says if you are receiving interest on post office savings, you will be allowed an exemption of 3,500 rupees. You will be allowed an exemption of 3,500 rupees. Second, you have something called interest on enhanced compensation, which we have discussed under capital gains, where income tax says if you have any enhanced compensation, whatever interest you get on it will be taxable in the year of receipt, will be taxable only for 50%. The balance 50% will be allowed as an expense, or a deduction. Other items like people, you can have royalty income, you can have online winnings, you can have items like proceeds from keyman insurance policy. All items which you think cannot be taxable under other heads will get taxed in IFOS. 2 critical things to read from an exam perspective. First is called proceeds from LIP, where income tax comes and says that if you are going to have a life insurance policy which you have taken on or after 1st April 23, what have you taken? Life insurance policies which you have taken on or after 1st April 23. Income tax says please ensure that the policy premium does not exceed 5 lakh rupees. You should not get a premium more than 5 lakh rupees on the policy. If you get a premium more than 5 lakh rupees on the policy will become fully taxable. The policy will become fully taxable on its maturity, not right now when you mature the policy. If you come and say no, I did not take a policy more than 5 lakh rupees, I have taken multiple policies, income tax will say please ensure the total of the policies does not exceed 5 lakh rupees. If the total of the policies exceed 5 lakh rupees, I will give you a choice. You decide which policy you want to exempt, provided total of that policy does not exceed 5 lakh rupees. Every other policy will become taxable. Second, income tax comes and says when you are doing all this, please ensure that the 5 lakh does not exceed not just in current year but in any years. If you have taken policy in year 1, another policy in year 2, another policy in year 3, in year 3 you will end up paying premium for all 3 policies. If in year 3 it exceeds 5 lakhs, then also it is taxable. So it is in any of the years. Couple of things to be kept in mind. 1, policy will not be taxable when you are paying premiums. Policy will only be taxable when you mature the policies. Point number 2, when you check the limit of 5 lakh rupees, please ensure that you check the premium without GST. GST is not checked for the purpose of premium. But when you compute the income, you can claim GST as an expense. So to check 5 lakh rupees, don't take GST. But when you check the income element, you can take GST as an expense. How do you do income, people? Amount received minus premiums paid. Amounts received minus premium paid. Whatever full amount I received minus premium paid will be my life insurance policy. Will be my life insurance policy. Yes or no? Yes. So income tax is when it comes to premiums, people do not pay more than 5 lakh rupees for individual policy. If you are paying aggregate premiums, then the multiple LIPs also should not exceed 5 lakh rupees in any of the previous years. How do you tax it? You will take it as amount received, whatever you have received, whether normal cash or bonuses, minus your premiums which you have paid till date. Minus the premium which you have paid till date. This will be taxable under that IFOS only in the year in which amount is received. Only in the year in which the amount is received. What is not covered, people? ULIPs because it is dealt in finals. Keyman insurance policy because it is part of PGBP chapter, and any insurance proceeds which you are getting on death. In this whole income tax syllabus, people, if someone dies and you get money, it is exempt. It is always exempt. In case of multiple LIPs, assessee may opt for LIPs it wants to claim exempt provided the aggregate does not exceed 5 lakh rupees, and whenever you check for premium, don't include the GST component on this. Don't include the GST component on this. For an example, people, I can show you illustration number 4. Look at illustration number 4. Illustration number 4 comes and says I have 1, 2, 3, 4, 5 policies. I have 5 policies. In that 5 policies, people, the first policy was taken in 2023, second was taken in 2023, 24, 24 and 24. Yes, so which means in 23 I had 2 policies. In 24 I have 5 policies. Looking at the premiums, I have paid 2 lakhs, 2 lakhs, 2 lakhs, 3 lakhs and 6 lakhs. Standing in 23, people, I would have paid a premium of 4 lakhs, less than 5 lakhs, therefore exempt. But when I am in 24, I have ended up paying 2 plus 2 plus 2 plus 2 plus 3 plus 6. You have paid 15 lakh rupees. The moment you touched 15 lakhs, income tax said, wait, the policies are now taxable. Tell me which policies you want to tax. Tell me which policies you want to tax. People, prima facie itself, in the 5 policies, the last policy is more than 5 lakhs, which means the policy will be taxable. You can't avoid this policy. This policy will have to be taxable. This policy will have to be taxable. Now I have 4 policies. I can decide which one to exempt. I can decide which one to exempt and which one to tax. People, if I don't know what to do, best way, check where the income is higher. The incomes are higher, policy will be exempt. Incomes are lower, policy will be taxable. Checking on this, people, if you notice, in the first case, I am going to pay a premium of 2 lakh rupees. And the premium I am going to pay for 4 years. For 5 years. I am going to pay it for 5 years, and therefore I am totally going to pay premium of 10 lakh rupees. I have received 12 lakh rupees, which means I made a profit of 2 lakhs. Come to this 23 ka policy, I am maturing in 33, 10 years. I have paid 2 lakhs per 10 years becomes 20 lakhs. Total paid 24. I am receiving profit of 4 lakhs. Here I am receiving profit of 4 lakhs. Here I am receiving profit of 6 lakhs. People, where the premium is, where the income is higher, 6 lakhs is higher, I would decide to exempt B. I would decide to exempt B. The moment I decided to exempt B, people, out of the premium of 5 lakhs, I have consumed 3 lakhs. I can now only consume 2 lakhs. So I need to decide which of the 3 policies I will consume. Notice the first policy, income is low. If income is low, I would like to pay tax, exempted. I would like to pay tax. So I am deciding X also I want to tax. X also I want to tax. This leaves me with 2 policies and 1 choice. 2 policies and 1 choice, whichever I want to tax. Whichever I want to tax. People, normally you would say, it doesn't matter. Take whatever you want. Take whatever you want. But if you are a smart CA, you will come and say, don't do that. Don't do that. Notice carefully, people. 24 ka policy will mature in 34. 24 ka policy will mature in 34. If you tax the 34 policy, you already have one income getting taxed in 34, which is LIPC, which means that income will get added to 10 lakhs and will get taxed at the slab rate of 30%. Will get taxed at the slab rate of 30%. But if you decide to tax the 33 ka policy, in 33 nothing else is taxable. So which means in 33 your income will show 4 lakhs. Total income is 4 lakhs. You will get tax of 0 because rebate will come in. Which means in the order of slab, I would prefer to tax 33 policy. I would prefer to tax 33 policy. The moment I tax 33 policy, A becomes exempt. A becomes exempt. Now notice carefully, people, two policies have decided to exempt. Policy number A, policy number B, total premium 5 lakhs. That is what I can do. That is what I can do. I can't claim more than 5 lakhs ka premium policies. So therefore everything else became taxable. Everything else becomes taxable. Now this is the smartest way to do. ICA has no preference. ICA has no preference. ICA will come and tell you do FIFO also, it is fine. You do FIFO also, it's fine. Meaning ICA will come and say what policy got matured first. X got matured, you exempt X. Then what is getting matured? A is getting matured, you exempt A. The moment you did that, people, 2 lakhs, 4 lakhs consumed. 4 lakhs consumed. Do you have any other policy with 1 lakh? Which means every other policy will become taxable. Every other policy will become taxable. That is what ICA would say if you do FIFO basis. But if you do that, people, you will end up in a problem, because the moment you do that, last 3 policies are taxable. Last 3 policies being 4 lakhs, 6 lakh and 10 lakhs. All 3 are getting taxed in 1 year, which is 2034. You're going to pay huge tax in 2034. You're going to pay huge tax in 2034. So therefore not preferable to do. But like I said, ICA can do whatever they want. Yes, sometimes ICA will come and say you decide what to do. Sometimes ICA will say I want X to be taxable. You tell me what else to do. Sometimes ICA will say I want X and A to be taxable. You tell me what else to do. All those combinations ICA will play, people. Yes, so whatever it is, just figure out the answer appropriately. Intention is very clear. You can only exempt up to 5 lakhs premium. You can only exempt up to 5 lakhs ka premium. Everything else becomes taxable automatically. Yes or no? Yes or no? Yes or no? Yes, yes, yes. That moves you to the next one, people. The important one, which we call as gifts. That moves to the next one, the important one, which we call as gifts, where income tax says if you are going to receive gifts, there are certain rules to follow. There are certain rules to follow. Rule number 1, tell me what is the asset. Tell me what is the asset. The asset should be either cash, immovable property, or specified movable property. Specified movable property are jewelry, paintings, archaeological collections, sculptures, drawings, shares and securities, bullions, any work of art. People, best way to remember, there is something called BA pass DJ. BA pass DJ. B for bullions, A for archaeological collections, P for paintings, A for any work of art, S for shares, S for sculptures, D for drawing, J for jewelry. J for jewelry. BA pass DJ is the mechanism. Is the mechanism. If you are getting an asset under BA pass DJ, it is taxable. Any asset other than BA pass DJ is exempt. Is exempt. So if you see a question called fridge, mobile phone, TV, AC, all are exempt from tax. All are exempt from tax. So 3 items you need to check, people. Either it is cash, BA pass DJ, immobile property. Rule number 2, income tax says if the asset is identified, tell me whether it is exempt because of rules. Tell me whether it is exempt because of rules. What are the rules, people? It should be exempt because of these reasons. Item number 1, D. D stands for death. So if you are receiving money on death, exempt. Item number 2, I stands for inheritance. Any money on inheritance, exempt. Item number 3, R stands for relatives. Any money receiving from relatives, fully exempt. Relatives has been defined as self, spouse, my siblings, her siblings, my parents, her parents, my kids, obviously her kids, my grandparents, her grandparents, my parents' siblings, and full stop. My parents' siblings and full stop, meaning none of the kids are covered. None of the kids are covered. My siblings' kids not covered. My parents' siblings' kids not covered. My spouse siblings' kids not covered. Also, my spouse parents' siblings not covered. My spouse parent siblings is not covered. 2 things which you have to pay attention to, not covered, people. Spouse parents siblings are not covered, and anyone's kids are not covered. Anyone's kids are not covered. Only my generational kids are covered. My siblings kids are not covered. What is siblings kids, people? Niece and nephews. Any niece and nephews are not covered into the scope. Are not covered into the scope. Second thing to be kept in mind, people, is that if you are a HUF, then the relative for an HUF means all members of HUF. You become a member of HUF by birth or by bringing into family. By birth or by bringing into family. Bringing into family can be of 2 types, either by marriage or by adoption or by adoption, either of the two works, either of the two works. After R comes people, something called T. T stands for trust. So if you have a charitable trust where you give money or you receive money, it is exempt. Then stands M. M stands for income tax. Says if you are receiving any money on account of marriage, it is exempt. Two rules to follow. It should only be for marriage, not for marriage anniversary, and it should be your marriage, not someone else's marriage, not someone else's marriage. If you are having a kid and kid is getting married, you are taxable. You are taxable. Kid will be exempt. Kid will be exempt. So parents getting money on son's marriage, fully taxable for parents. Fully taxable for parents. And also understand people, second marriage, third marriage and all fully taxable. All fully taxable. Sashtipada Purti, 60 years crossed and all fully taxable. Doesn't matter. Doesn't matter. After M comes I. I stands for individual having its private trust. Individual having its private trust. Money given to private trust, fully taxable. N stands for non-profit organizations. Other than charitable trust, any non-profit organizations like schools or colleges or any kind of educational facilities, medical facilities, hospitals and all fully exempt. After N comes C. C stands for COVID-19. Money received on account of COVID-19, fully exempt. And then you have L stands for local authority. O stands for other category, nothing notified for inter. And finally T. T stands for capital gains transfers. Capital gains transfer. If an item is exempt under capital gains, it is also exempt under IFOS except for gift. Except for gifts, because gift is also exempt under capital gains. Don't take gift into consideration. That alone is taxable. Yes. So rule number 2, people, check whether it is exempt here. Check whether it is exempt here. If it is not exempt here, then comes rule number 3, check for the limits. Check for the limits. Income tax says if you are receiving cash as a person who is receiving money, I should not receive more than 50,000 during the whole financial year from anyone. From anyone. Any people together giving me more than 50,000, the whole money will get taxable. It is not 50,000 per person, it is 50,000 during the year. It is 50,000 during the year. Second, if you are receiving an BA pass DJ asset, specified mobile assets, your gift element means FMB minus amount you paid. FMB minus amount you paid should not exceed more than 50,000 rupees from all assets during the financial year. From all assets during the financial year, every asset which I get, all assets I will accumulate and should not exceed 50,000 rupees. And then comes immobile property, where income tax says in immobile property also the gift element, where gift element means SDV minus consideration should not exceed 50,000 rupees per asset. 50,000 rupees per asset. Intentional point, people, when it comes to movable property, it is all properties, but when it comes to immobile property, it is each property. Pay attention to this one. Pay attention to this one. So if each property SDV minus consideration is more than 50,000, it is taxable. Otherwise, it is not taxable. But a special benefit where income tax says if the SDV is within 110% of the consideration, then the gift is not taxable. Then the gift is not taxable, meaning it will only be taxable if two conditions are satisfied. SDV should be more than 110% of consideration and the gift element should be more than 50,000 rupees. Should be more than 50,000 rupees. At any appropriate stages, if you receive 2 SDV in the question, you can take SDV on the date of transfer, but you will be allowed to take SDV on the date of agreement provided you receive advance money by permissible modes of account pay check, account pay draft, electronic clearing system, debit card, credit card, BHIM, Aadhaar, UPI, NEFT, RTGS, IMPS, etc. and etc. All those things can be taken that into consideration. Yes. Income tax also comes and clarifies if any item has been taxed as gift. If any item has been taxed as gift, whatever income you taxed as IFOS income will be added to your cost of acquisition of the asset. Will be added to the cost of acquisition of the asset, and because you have added it to the cost of acquisition of the asset, the revised cost will be applicable only from today, meaning the period of holding will start from today. The period of holding will start from today. It will not start from the previous owner. It will start from current owner because my cost has changed. Because my cost has changed. Clear? This is your topic on IFOS gifts. That leaves me with the last topic of your IFOS people. We have something called as dividends. This provision of dividends come and say that when you receive any dividends as a shareholder, it will be taxable in your hands under the head IFOS will be taxable in your hands under that IFOS. Income tax has notified 6 dividends for your exam. 6 dividends for your exam. First item comes and says any distribution of assets to your shareholders will be taxable as dividends in the hands of shareholders only to the extent the company has accumulated profits, whether it is capitalized or not. Meaning if the company gives you an asset, let's say machinery for 6 lakh rupees, and the company says my balance sheet only has a P&L of 5 lakhs, income tax will say dividend is 5 lakhs because that much is the profit. Other than that, whatever you give is not capital, is not dividends. Second comes any kind of bonus given to preference shareholders or any kind of debentures given to any shareholders. Any kind of bonus given to preference shareholders, any kind of debentures given to any shareholders. Note carefully that bonus given to equity shareholders is not dividends. Bonus given to equity shareholders is not dividends. That is taxable under capital gains. Third item is called as liquidation proceeds. If you receive any money during liquidation, whatever money you receive, to the extent the company has profits, that will be dividends. All extra money will be called capital gains. Point number 4 says any kind of reduction of share capital. If the company is going to give you any money during reduction of share capital, to the extent the company has accumulated profits, that will also be taxable under the head IFOS. Last 2 items which you need to pay attention to in the current year. Item number E, which is 222E. Income tax says if you are a closely held company or a private company granting a shareholder loans or advances, if the shareholder holds more than 10% of the voting power, whatever loan and advance you grant to the shareholder will be taxable as dividends to the extent the company has accumulated profits. This is what is happening. This will continue to be taxed as dividends even if the shareholder repays the money back. I don't care, and I will not proportionate profits based on his percentage of shareholding. If I have a balance sheet with 5 lakhs and he is holding only 10%, I will still tax him for the full 5 lakhs. I will not tax him for 50,000 because I don't care what his shareholding is. I am only bothered about what the profits is showing in the company. I'll give you an example. You'll understand better. Later on, people came in your amendment in the current year. The amendment of current year comes and says after 1st October, if the company decides to buy back the shares from its shareholder, every money which the company gives to the shareholder will be treated as dividends, and this will be called as dividends even if the company has no profits. Every money given to you is dividends. Even if the company says I am in losses, it doesn't matter. But because you paid money to buy the shares, whatever money you paid to buy the shares will be treated as your capital loss, which you can carry forward for a period of 8 years. Which means, people, when you buy shares back, company will give you money. You also will give company money. You initially paid company money. I then paid you back. Whatever I paid is dividends. Whatever you paid is capital loss. That is what the provisions is. And please note very carefully that this provisions will apply whether or not the company has profits. For all the other cases, you need to have profits. For this case, no profits. At the same time, income tax has come and clarified when it comes to buyback, I will not allow any expense, any deduction, any item whatsoever. This is taxable on gross level. Yes or no? Finally, people, income tax says whatever dividends you have from A to E, you can claim expenses only of interest. That too up to a maximum of 20% of the dividend income. So whatever dividend income you have, 20% of that is the maximum you can claim as interest expense. If you have paid interest more than that, ignored. Also, you can only claim expense of interest, nothing else. If you have any commission, brokerage, any other charges which you have paid, not allowed as deduction. Only deduction is for interest, and that to maximum of 20% of the dividend income. But this is also only for A to E, not for buyback, not for buyback. That is what the rule says. That is what the rule says. Last thing for you to keep in mind, if a company is going to give you dividends, company will deduct TDS at the rate of 10%. Company will deduct TDS at the rate of 10%. That is what the rules are. That is what the rules are. Yes or no? Yes or no? This is your provisions on IFOS dividends chapter. IFOS and dividends chapter. Clear with me? Yes? Yes. What we're going to do, people, is that we're going to go into two chapters together, a marathon of two chapters together. We're looking at what is called as clubbing. We are looking at what is called as set off. Yes. From an exam perspective, people, both chapters are interchangeably used in exams. You will get your part number 4, question number 1, either from clubbing or from set off or a merger of both. You'll get a 6-mark question from that. So let's look at both the chapters together, people. It makes more sense. Yes. We're starting with the chapter called as clubbing of income, people. This chapter basically comes and says that when you are a person who's trying to avoid your taxes by shifting your profits to someone else, income tax will catch you back and come and say that profits will continue to be taxable in your hands. Instances given to you under income tax, people. The first instance comes and says, if you are proposing to transfer your income without transferring the asset, it will be taxable in the hands of the transferor. It will be taxable in the hands of transferor. So I should not be transferring merely my income, I should also be transferring my asset. Case number 2 comes and says, if you are proposing to transfer your asset and the asset is transferred on revocable basis, then that is also treated as transferor clubbing. That is also treated as transferor clubbing. So you should not be transferring asset on revocable basis. Case number 3 comes and says, if you are planning to transfer an asset on irrevocable basis, then also it will be considered as clubbing, provided certain amount of benefit, whether directly or indirectly, is being transferred back to the transferor, meaning clubbing will not apply when you are giving it on irrevocable basis with no benefits coming back to you in return. Only then the clubbing provisions will not apply. Case number 4, people, where income tax comes and says, if you are going to be a person who's going to employ your spouse in a concern in which you have substantial amount of interest, more than 20% of voting power, please ensure that the spouse does not receive any remuneration which she is not eligible for, which they are not eligible for. If you go and give them any remuneration for which they are not professionally or technically qualified, the remuneration which they receive will be taxable in the hands of the individual holding substantial interest, under the same head as if it was taxable for the other person. So for the other person, if it was taxable as salaries, for me also it is taxable as salaries. Because it is getting taxable as salaries, I will now get eligibility standard deduction. Please note the fact that, people, in this whole chapter, what is getting clubbed is income. So which means if it is not an income for the other person, it is not an income for me as well. It should only be that income which is getting taxed in my hands. So don't tax revenue, tax incomes. What do you mean by a substantial interest, people? Income tax says it is not just me who should have substantial interest, it is me or my relatives. If we together also have substantial interest, then also it is taxable in my hands. What does relative here means? It means the left side of the family. It means my spouse, my siblings, my parents, my kids, lenient descendants, only the left side of the family. Any of these people, if they have along with me a substantial amount of interest, and in that concern, if my spouse receives any remuneration, then the right remuneration will be taxable in my hands, provided they do not have professional or technical qualification. Then comes the point where income tax comes and says, if you forget all revocable, irrevocable and all those things, but you end up transferring any kind of asset to your spouse or to your son's wife for inadequate consideration, income tax will say whatever income is earned by that person will become taxable in my hands. But the rule is that it will only be taxable to the first level of income. Accretions are not taxable, meaning if I give some money and they earn income, that income is taxable in my hands. Keeping that income, if they earn further income, that is not taxable in my hands. I am only taxable for the first level of income. Yes, here exception to the rule comes and says, I will not be talking about clubbing if the transfer is of a house property, because that is treated as deemed ownership under HP chapter. Second, they will not treat clubbing if there is an agreement to live apart, basically divorce. In both the cases, I will not be considering clubbing provisions. Then income tax comes and says, if I have money and I give you this money as a gift, which you invest in your business, in the form of Very good. In the form of opening capital. In the form of opening capital, whatever profit the business earns will be allocated between both the partners. Both the partners. Partners meaning me and my spouse. Me and my spouse will be allocated to both of them in the ratio of proportionate of opening capital. Proportionate of opening capital. In simple words, any contributions happening in the middle of the years will not be considered. Will not be considered. Only that amount which is forming part of your opening capital will be considered. Please note that when I give the gift, the person should be investing in their capital in sole proprietorship business, because if they're investing in partnership firm, whatever profits are coming are anyway exempt from tax, so it doesn't matter. It doesn't matter. This will only be considered as taxable when it is from sole proprietorship businesses. Yes or no? Yes or no? Yes. Then comes the point, people, where income tax comes and says, if you are going to transfer this asset to any other person, but the benefit of this is coming back to your spouse or to your son's wife, then also it is taxable in my hands. Then also it is taxable in my hands. The point to note here is, people, because it is transferred to a third party, the can also be a provisions of gift coming into picture. 56(2)(10) may also apply, because the other person may not be your relative. So first you will tax relative definition gift, and then you will bring clubbing provisions also inside. You will bring clubbing provisions also inside. So this becomes double taxability. This becomes double taxability. Then comes the last point, people, where income tax says, if you have a minor child and the minor child is earning any income, the minor child is earning any income, whether first level income or second level income or any further incomes, all incomes of the minor child are taxable in the hands of parents whose total income is higher. Parents whose total income is higher, except for three cases. Except for three cases. Case number one, if the money is coming out of child's skill, if the money is coming out of child's manual labor, and if the child is a disabled handicapped child. If the child is a disabled handicapped child, basically what you need to do, people, is that take his full income and fully taxable in the hands of parents, but then exclude some incomes, minor child labor, minor child skill and handicapped child. Remove those incomes alone, everything else will become taxable in the hands of parents, will be taxable in the hands of parents. Whichever parent is taking tax on the child will be allowed an exemption of 1,500 per annum per child, 1,500 per annum per child. But this 1,500 per annum per child will not be given to you if you are opting for default tax regime. You don't get this exemption if you are opting for default tax regime. This exemption is denied to you. This exemption is denied to you. Finally comes your topic, people, of what is called as cross transfer, where income tax comes and says, if I am having a money and I give it to my brother's wife, and my brother gives some money to my wife, whatever is the common level of income will become taxable in the hands of me and my brother. Whatever extra income is earned will be taxable in the hands of respective spouses. So in this example, people, because I gifted 5 lakhs and he gifted 6 lakhs, common income here is 5 lakhs. So whatever income generates out of 5 lakhs, that will be taxable in my hands and my brother's hands. Whatever the extra income of 1 lakh which was given by me to my brother's wife will be taxable in the hands of brother's wife. That is how clubbing provisions will apply. Please note the fact that when it comes to clubbing provisions, income tax also comes and clarifies, clubbing is not just of income, clubbing can also be of losses. So if you have any losses coming, that will also be clubbed in the hands of the respective person. The idea is that you are not taxing the revenue, you are taxing the income. So first what happens, people, you will compute the income in the hands of the original person and then club it in my hands after you compute the number. This is what clubbing provisions will apply. The last thing which is there in clubbing provisions, people, where they come and say, if I have given any asset to my HUF, and later on the HUF decides to partition, because of which the assets are transferred back, not just to me, my spouse, my siblings, other members of the HUF, then whatever other members receive is not my concern, but whatever my spouse receives will be clubbed in my hands, because it's my asset coming back to my family. So whatever my spouse receives will also be taxable in my hands out of the HUF. Although please bear in mind, people, income tax says any share of profit from the HUF is also exempt. So this is not talking about share of profit. I am saying if an asset is coming back to my spouse, whatever money is generated from the asset will be taxable in my hands. The asset will not be taxable because share of profits from HUF is exempt. Like I said, people, share of partnership firm profit is also exempt. Share of HUF profit is also exempt. So both of them are exempt. You don't take them into consideration. Yes or no? Yes or no? This is what your provisions of clubbing look like. Any doubts on the provisions? No. The next chapter is what is called as set off and carry forward of losses, people. You can complete the whole chapter in just this table. There are some rules for you to follow before you start this chapter itself. Rule number 1, never look at the question from an income perspective. Always look at the question from a loss perspective. So when you get a question and the question has incomes also, losses also, always first start with losses. Because losses will tell you what you can do with it. Incomes will only confuse you. So always start from losses. Rule number 2, people, when you have a loss in your hand, the order of set off cannot be changed. It is always first intra-head, it is after that inter-head, and then it is past year losses. You cannot start with adjusting past year losses even though the period may lapse. You always have to first do intra-head, inter-head, and then past year losses. The sequence cannot be modified. Rule number 3, while this is not said anywhere, a hidden rule is that when you have an HP loss, it is always better to set off your HP loss against salaries. For the only one reason that salaries does not have any other losses to set off. So it is better to set off HP against salaries. But also look at the question, people. If the question comes to a point where your total income is less than 5 lakhs and all those things, I would still prefer to set off against capital gains, because your slabs will be taxable only for 5%, but capital gains may get taxable for 12.5 also. Yes, so it depends on what your total income arrives at also. If a total income arrives at anything less than 5 lakhs, preferably go for adjust against capital gains. But if it is more than 5 lakhs, normally better to opt for salaries. At the end of the day, the total income will not change. You are just modifying the answer. So therefore, it will not be much of an impact. But as you present it, the answer may change accordingly. Yes or no? What is the rules when it comes to set off and carry forward of losses, people? Rule number 1, income tax says that you always look from loss perspective, and therefore we will start looking at losses. In salaries, you have no losses, so ignoring salaries. Second, you have HP ka loss. Income tax says when you have an HP ka loss, first adjust against HP income. If you're not able to set off against HP income, then you set off against other heads up to a maximum of 2 lakhs. Whatever you were not able to adjust after this 2 lakhs will get carried forward for a period of 8 years and set off only against HP income. People, the rules in set off is that what you carry forward can only get adjusted against the same head. So keep that thought in mind. Second, people, you are moving on to PGBP, where under PGBP income tax says if you have any speculative loss, the speculative loss will get adjusted only against speculative profits. If you don't have speculative profits, no options but to carry forward for a period of 4 years to be adjusted only against speculative profits. Yes, then you have something called specified business losses, where income tax says if you have any specified business losses, they can adjust only against specified business profits. If you don't have specified business profits, you will have to carry forward for a period of infinite years. To be adjusted only against speculative profits. Yes, then you have something called normal business loss, where income tax says if you have any normal business loss, you can set off against normal business income. If you're not able to set off, you can set off against any other heads other than salaries. If that is also not happening, you can carry forward for a period of 8 years to set off against business incomes. Notice very carefully, people, when I'm saying business loss can be set off against business income means any business income. It can also be speculative income, it can also be specified business income. The reverse is not true. If you have speculative loss, you cannot set off against business profits, but if you have business losses, you can set off against speculative profits. The idea, like I said, people, is to always look from losses. If you look from loss, you will get the answer properly. Start looking from profits, answer will go wrong. Yes. Then we move on to capital gains, people, where income tax says there are two capital gains, long term capital loss and short term capital loss. If you have any long term capital loss, you will set off against long term capital gains. If you're not able to set off, you will carry forward for a period of 8 years and set off only against long term capital gains. If you have a short term capital loss, income tax says you can set off against long term or short term capital gains. If you're not able to set off, there is no interhead, and therefore you will directly carry forward to be set off against long term and short term capital gains for a period of 8 years. Finally, when you move to IFOS, income tax says if you have any owning and maintaining horse race losses, if you have any owning and maintaining horse race losses, income tax says that will be set off only against income from owning and maintaining horse races. If you're not able to set off, you will carry forward for a period of 4 years to be set off only against income from owning and maintaining horse races. Other than that, any other sources loss you have, you can set off against other sources income. If you're not able to set off, you can set off against any head, but after that you can never carry forward. There is no carry forward provisions when it comes to other sources. Yes or no? Yes. Some rules for you to follow, people, is that rule number 1, when it comes to special incomes like winnings, online winnings, unexplained income, against these incomes no set off can be permitted. Rule number 2, if the income is exempt, the losses are also exempt. So if share of profit from a partnership firm is treated as exempt, the share of loss is also treated as exempt, and you therefore ignore that also. Rule number 3, income tax says if you want to carry forward any losses, you need to ensure that the return is filed on time for business and capital gain losses. Meaning items of speculative loss, specified business loss, other PGBP loss, long-term capital loss, short-term capital loss. For these items, you need to mandatory file your return on time. For items which I don't need to file return on time, HP loss, unabsorbed depreciations. Yes or no? Yes. This brings me to point number 4, people, which is unabsorbed depreciation. Income tax says if you have any unabsorbed depreciation, you can set off against any business profits. If you're not able to set off against any business profit, you can set off against any head other than salaries. If you're not able to do that also, you can carry forward for infinite years and set off against any head other than salaries. Unabsorbed depreciation gets a special benefit. In future years also, they can set off against any head other than salaries. So that's an extra provision given only for unabsorbed depreciation. Yes or no? If you get an exam question, people, where they come and say you have business profits, where they come and say you have current year depreciation, you have current year losses, you have past year losses and past year depreciation. Order of set off will be current year depreciation first, then current year losses second, then past year losses first, and then past year depreciation last. Understand, people? Current year depreciation because it's part of the same business. Current year losses because intra-head is the rule. Past year business loss is being taken first because it has a set off period of only 8 years, and then comes past year depreciation because you can take it for infinite years. So what is the sequence, people? Current year depreciation, current year losses, past year losses, past year depreciation. That is how the format is. Any doubts on the format? Clear enough to go? Yes. One last thing which I probably want to tell you, people, is not there in the book, but I wanted to clarify. You see there is something called owning and maintaining horse races. Yes. ICA has an assumption that when they see owning and maintaining horse races, that is the only thing which is considered here. Once in the past exams, people, you got a question saying owning and maintaining race bulls. It's not race horses, it is race bulls. ICA makes an assumption that owning and maintaining race bulls are not the same as horse races, and therefore they put that in business. The moment you put that in business, people, if you have owning and maintaining horse race loss, can you set off against owning and maintaining race bulls? No, you can't set off. Owning and maintaining race bulls will be assumed as normal business loss to be taken normally, which means ICA is making an impression only horse race losses can be set off against horse race profits. Horse race losses cannot be set off against race bull profits. Not allowed. That is one thing you need to keep in mind. If you are moving to DTR, people, what amendments are coming in? First amendment, which we already discussed, when it comes to HP. Income tax says under DTR you can only do intra-head, meaning you can set off against HP income. If you are not able to set off against HP income, the loss will permanently lapse. You neither set off against other heads, nor can you carry forward. Second, income tax is saying if you have losses from any of the items which I have denied to you, denied to you, then any past year losses will also lapse off those. Past year losses will also lapse off those. For example, in the exam question they give you interest on loan on SOP property of last year. Interest on loan on SOP property of last year, because of which there is a carry forward HP loss of SOP. Carry forward HP loss of SOP. If current year I am in DTR provision says there cannot be SOP, and therefore whatever is the past SOP loss will get lapsed. Same logic, people. If the question comes and says I have past year unabsorbed depreciation which is pertaining to additional depreciation, pertaining to, the moment you choose DTR, that number will get lapsed. Same logic, if the question comes and says I have loss from specified business of past years, loss from specified business of past years, we discussed specified business is also not allowed, and therefore that loss will also lapse. Yes, so basically people, when you get the losses, ask yourself if it is DTR or ATR. ATR has no problem. DTR, na, first check the losses. If it is from any item which is not allowed, the loss will get lapsed. That is what the losses look like. Yes or no? Last thing which you need to keep in mind, people, if you don't file your returns on time, only carry forward has been denied. Current year set offs is allowed. Which means in the current year itself, if you are able to set off the loss, do it. The only problem is you can't carry forward the loss. That is one thing to be kept in mind. Of late, ICAI is asking a lot of questions whether return is filed late. And therefore pay attention to the fact that if your return is filed late, you will claim the set off. You cannot carry forward the losses. The final thing, which is not part of this chapter, but I want to clarify to you, is that ICAI has made an assumption. That if you don't file a return on time, if you it is assumed that you cannot choose ATR. You are automatically liable for only DTR. This has come in from September 24 assumptions, people. After September 24 exams, ICAI has made an assumption saying if you don't file your return on time, you would have not filed a form to opt out. Because you did not file a form to opt out, you are in DTR. So please pay attention to that fact as well. Yes or no? So that is one thing to be kept in mind. We will discuss that once again when we do return filing provisions, but please keep in mind that if you file your return late, it is assumed that you are doing DTR. So even if the question does not say which income to opt for, but the moment you say that the person has filed a return late, assume that the person is doing DTR, unless the question itself comes and says go for ATR. Yes or no? Yes. Apo people, what is going to happen? In exam, they will say compute tax in the manner most beneficial. You have to do both. If they say compute tax assuming the person has filed return late, you will do DTR. If the question says as compute tax assuming the person has opted out of default tax regime, you will do. That is what the understanding is. Clear enough, people? Any doubts on this? Good enough to go? Yes, great. We're going to do a quick revision of what we are doing of chapter 6A, people. A chapter 6A deduction chapter, most likely relevant more from your total income perspective. Yes, we're looking at what kind of deductions can you be claiming against your incomes. For you to claim chapter 6A, people, certain rules to be established. Rule number 1, you can only claim chapter 6A against your gross total income. You can't claim it beyond your gross total income, which means chapter 6A can maximum adjust against your gross total income. It cannot go beyond that. Rule number 2, if you have unexhausted chapter 6A, it will get lapsed. You cannot carry it forward. And rule number 3, and the most important rule, when it comes to chapter 6A, you can only claim chapter 6A against slab rate incomes. You cannot claim any chapter 6A against special incomes. So when you have a question of chapter 6A, people, it's always better what you do, that when you find out gross total income, also find an additional line saying gross total income excluding special income. Do chapter 6A on those, find the net income, and then add your special incomes once again, so that you get the proper answer. Otherwise, what will happen, people, you may get confused and you may end up doing chapter 6A even on special incomes, and your answer will go wrong there. Yes, so that is first rule to be followed. Now when it comes to chapter 6A, people, there are 3 headings which you need to understand. One is heading number B, heading number C, and heading number CA. Heading number B talks about all your investments and expenses. Heading number C talks about all your income based deductions, and heading number CA talks about all your interest based deductions. Yes. What is heading number B, people? We start with section 80C, the important section of exam, which comes and says that when you have a person having such expenses or investments, you will be eligible for 80C. you'll be eligible for 80C with a maximum limit of 1,50,000. What are the items, people? The first and the most critical item is something called life insurance premium, where income tax says if you have taken life insurance premium on self, spouse, children, that's all, self, spouse and children, you are not eligible for deduction on any parents. You're not eligible for any deduction on parents. And when it comes to child, whether dependent or not, both are covered. Both are covered. You'll be eligible for a deduction up to 20% of the premium paid if the policy is taken before 2012. You'll be given premium of 10% of sum assured if the policy is taken after 2012, and you'll be given a premium of 15% of sum assured if the policy is taken after 2013 but is taken for a handicapped person. Other than this, people, income tax says if you have contributed anything to PF, understand this is not employer's PF, this is employee's PF. Any employee's PF is contributed to RPF, SPF, PPF, whatever it is allowed as deduction. Then items, people, are something called contribution to Sukanya Samriddhi scheme, any kind of repayment of housing loan, tuition fees which you have paid for children, for maximum 2 children with an education in India, any kind of 5 years term deposits you have taken from a scheduled bank, any other items like subscription to NSC, National Saving Certificate, superannuation fund and all the like items will be 80C. In exam, if you see an investment which you don't understand because it has a special name, it is always 80C. Yes, only investments are under 80C. Yes or no? After 80C comes, people, something called 80CCC, which talks about pension fund. If you have any kind of pension fund contributions, then it is also allowed as deduction for a maximum of 1,50,000. Then comes your 80CCD. 80CCD comes and says 2 people can contribute here. One is employer, one is employee. If an employer contributes, you will be eligible for 10% of the salary as a deduction. But if you are opting for default tax regime, you will be eligible for 14% of the salary as a deduction. Yes, where salary here means basic plus DA forming part, When it comes to employee, income tax says whatever he contributes, first 50,000, no restriction, full allowed. First 50,000, there is no restriction, fully allowed. Whatever extra he contributes, he will get a deduction maximum of 10% of the salary. He'll get a deduction maximum of 10% of the salary, where again salary means basic plus DA forming part, Yes or no? Yes. However, then comes a section called 80CCE. This 80CCE comes and says that 80C, 80CCC and 80CCD, part of 10% of employee, the part of 10% of employee will have an overall restriction of 1,50,000, which means overall you can claim, people, is 1,50,000 plus 50,000 for employee contribution plus 10% of salary for employer contribution or 14% of salary of employer contribution. That is what you can maximum claim. You cannot go beyond this. If you are opting for DTR, people, neither 80C nor CCC nor CCD is eligible for deduction. The only one thing which is eligible for deduction is the employer's contribution to the maximum of 14% of salary. So in the 3 items, only employer's contribution can be claimed as deduction. Everything else is not allowed as deduction. Then we have something called as 80D, people, the next important section from exam perspective, which says if you are going to have any kind of medical insurance for self, spouse, dependent children, dependent children and any parents, whether dependent or not, you will be given 80D. Income tax says do one thing, split your buckets into two. Bucket number 1 has self, spouse, dependent children. Bucket number 2 has parents. Both the buckets, each bucket will get 25,000 deduction. Each bucket will get a deduction of 25,000. But in that bucket, if any one person is also a resident senior citizen, the bucket will get 50,000 worth of deduction. What kind of expenses can you claim here, people? First, medical insurance. Second, any kind of central government health scheme payments. And third, any kind of preventive health checkup for a maximum of 5,000 rupees for both the buckets put together. both the buckets put together. So when you claim preventive health checkup, either you put it in bucket 1 or bucket 2 or together, but maximum claim 5,000 rupees. At any appropriate stages, if you find out that there is a resident senior citizen who wanted to take insurance but was denied insurance, he can then claim his actual expenses as a deduction because he does not have a insurance. People understand it is not whichever is higher or whichever is lower. It is if no insurance, then expenses. If insurance is there, expenses will get rejected. Expenses will get rejected. Yes or no? Yes or no? For this 80D people, income tax comes and says the medical expense, the medical insurance, the central government health scheme, all the 4 items need to be paid by other than cash. Need to be paid by other than cash, except for preventive health checkup. Preventive health checkup can be paid by cash. At any stage, if you find out that the medical insurance premium has not been paid for 1 year, has been paid for lump sum, split the medical insurance over the previous years in which the policy is alive. For the previous years, if the policy is alive, which means if the policy was taken on 1st April, then no problem. Whatever is the number given, as it is, take it off. But if the policy was somewhere like 3rd, 31st March or 2nd April and all, then what will happen? You will have a spillover. In that case, 1 year will get added. For example, if the question comes and says medical insurance has been taken on 2nd April for 5 years. If you actually calculate, people, you will get 6 years in previous year terms. You will get 6 years because 1 more year will get added for 2 days. Therefore, income tax will say that premium should be split over 6 years and not 5 years. In simple words, lump sum on 1st April, the years will match. Lump sum after 1st April will be plus 1 year. That is what the rule will be. Yes or no? Yes. 80D also not eligible for default tax regime. You can't claim 80D under default tax regime. Then comes 80DD and 80U, which income tax says if you are going to have a handicapped person, and you are paying expenses for maintenance, understand this is not for medical insurance or life insurance. If it is medical insurance 80D, life insurance 80C. I am talking about maintaining the person, meaning I am incurring some expenses for taking care of him, or I am giving some expenses in LIC for contributing for his future benefits. Any kind of maintenance expenses, income tax says you will get a flat deduction of 75,000 rupees, and if it is a severe disability of 80 or more, then it is 1,25,000. Notice carefully, this is a flat deduction, meaning I don't care what you spend. Even if you spend 1 rupee, I'll give you 75,000 rupees. That is what flat deduction means. Again, 80DD and 80U not eligible under default tax regime. After this comes 80DDB, which talks about medical treatment to specified disease, where income tax says if you are going to have any specified disease for which you incur any kind of medical treatment expenses, you can claim up to a maximum of 40,000 rupees of this expense, or 1 lakh rupees in case the person is a resident senior citizen. DDB also not eligible under DTR. After this comes people here 80E series, where 80E comes and says if you are going to take a loan, for higher education, the loan amount is not allowed as deduction, but the interest on the loan can be claimed as deduction for the next 8 years. Where this loan has to be taken either for self, spouse, children, or any guardian children. Understand, this is only for those kind of educations which is happening post 12th standard, higher educations, and it has no restriction to happen in India or outside India. No matter where you spend it, it is allowed. After this comes people something called 80EE and EE. Now this is all old provisions. This is not relevant for your exams, but sometimes they may ask you a question. In the current years, the only thing you need to remember is if the question section says that there is some loan taken of past years and is eligible for deduction, whether they use EE or EE, it doesn't matter. If they use the word EE, then it is 50,000. If they use EE, it is 1,50,000. That is what you have to remember. But the one thing to be kept in mind, people, is that these deductions will only be granted to you if there is any unconsumed balance from HP. Meaning you should have an interest on loan in HP which you could not claim as deduction, like SOP interest, which got restricted to 2 lakhs. Whatever extra you have is what you can claim under EE or EE. If it is EE, then it is 50,000. If it is EE, it is 1,50,000. Where EE is for loan taken in 16-17 and EE is for loan taken between 19-20 to 21-22. 22. Both 80E and 80EE and EE do not get deductions under default tax regime. Then comes EEB people, which talks about loan taken for electric vehicle. If you have taken a loan for electric vehicle, the interest on that is also not allowed as is allowed as deduction up to a maximum of 1,50,000. Will be allowed as deduction up to a maximum of 1,50,000. This also is not eligible under default tax regime. After this comes your important section, people, your 80G. Income tax says when it comes to 80G, 4 categories are there. Category number A talks about 100% donation without any qualifying limit. Category B talks about 50% donation without any qualifying limit. Category C talks about 100% donation with a qualifying limit of 10% of your adjusted total income, and category D talks about 50% of the donation with a maximum of 10% of the adjusted total income. What are the items, people? Income tax says if it is category B, then it is Prime Minister Drought Relief Fund. If it is category C talks about family planning and Olympics. If it is category D talks about charity. Charitable trust. Anyone else falls into category A. Category A predominantly talks about all ministers and nationals. Wherever you see minister and national, that is category A. In simple understanding from an exam perspective, if it is not an Prime Minister Drought Relief Fund, if it is not family planning, if it is not Olympics, if it is not charitable trust, it is category A. Income tax says when it comes to 80G, people, qualifying limit means 10% of the adjusted total income, where adjusted total income means take your GTI, remove the special incomes, arrive at GTI with slab, and then reduce all deductions of chapter 6A except 80G fully. 80G fully means except all 80G, category A, B, C and D, all four. You will arrive at a number. That number is called adjusted total income. That adjusted total income you can maximum donate 10%. I am clarifying myself once again. What you are going to donate is the 10%, meaning that is not the deduction amount, that is the donation amount. What does it mean? It means if the 10% comes as 1 lakh and you have donated it in charity, you will donate 1 lakh, get a deduction of 50,000. You can't come and say I want a deduction of 50,000, 1 lakh, that is not allowed. You will get a deduction of only 50,000 because you donated 1 lakh rupees. So the 10% is the donation amount. It is not the deduction amount. When it comes to 80G, people, income tax says some rules to follow. Rule number 1, all donations you make should be in monetary value, cannot be in kind payments. Rule number 2, whatever donation you make, if you are making it in cash, you can only make up to 2,000 rupees in cash. If you make any donation more than 2,000, the donation will get rejected. You don't get the deduction for that donation. 80G also is not eligible for default tax regime. After G, people, comes your 80GGA, which talks about scientific research donations. Income tax says if you want to claim a deduction of scientific research, first claim it under PGBP. But if you tell me that you are not liable for PGBP, then you can claim it under GGA. Only if you are not under PGBP. Amount allowed as deduction 100%, provided you don't make donations more than 2,000 rupees in cash. After GGA comes, people, GGB and GGC, which comes and says if you are going to donate anything to political parties or electoral trust, you can claim that as a 100% deduction, subject to the condition that you don't pay any money in cash. Again, GGA, GGB, GGC, all the three are not eligible for default tax regime. Then comes your 80GG, which I generally don't tell you to read. It's okay to ignore. We are moving on forward to heading number C. Which talks about income based deductions, where income tax says one of the most important sections from exam perspective, and one thing which always comes in exam, 80JJAA. Income tax says when you have employees increase in the current year, when you have an employees increase in the current year, you will be eligible for a deduction of 80JJAA subject to some rules. Rule number 1, take all your employees all your employees. Remove all the employees who are getting salary more than 25,000 rupees per month. Rule number 2, whatever employees are left, remove all those employees who are not participating in PF. Rule number 3, after you have removed those employees, remove all those employees who are employed for less than 240 days or 150 days in case you are in leather, apparel or footwear business. Leather, apparel or footwear business. Rule number 4, if last year you had rejected some employees for 240 days, add them in the current year. Add them in the current year. Rule number 5, whatever employees you have, multiply that with the salary which you paid them, but ignore all the salary which was paid other than by permissible modes. Other than by permissible modes. At this point of time, you will get the salary which was paid to these employees. Take the salary, multiply by 30% over the next 3 years. Over the next 3 years, you will get a deduction. So this is what the step process is, people. You will take and check whether the person is liable for tax audit. Then take all the net increase of the employees. Check whether you have any employee who is not participating in RPF and remove those employees. Exclude all the employees who are employed for less than 240 or 150 days in the current year. Add all the employees who are more than 240, sorry, less than 240 or 150 in the last year but satisfied 240 and 150 in current year. Exclude all the employees who are having salary more than 25,000. Compute the salary and ignore any salary which is paid other than by permissible modes. You will get the salary paid to the employees. Multiply that number with 30% and you will get the deduction eligible under 80JJAA, not for 1 year, for 3 years. Please note, 80JJAA eligible for both ATR and DTR. Eligible for both ATR and DTR. After JJAA comes, people, QQB and RRB, where income tax says if you have received any royalty, if you have received any royalty for either books or for inventions, you will be eligible for a deduction of 3 lakh rupees subject to the condition that you have offered it to tax. Subject to the condition that you have offered it to tax. So you add it to IFOS and then claim a deduction maximum 3 lakh rupees. Maximum 3 lakh rupees. Some conditions to follow. They say if you are going to receive royalty, you should only maximum receive royalty of 15% of the value of the books. 15% of the value of the books. If you have received any royalty more than 15%, you will tax the whole thing under IFOS, but claim a deduction only for 15%. Claim a deduction only for 15%. Second, if you are receiving royalty from outside India, you should receive the money in India within 6 months from the end of the financial year. Third, if you have already claimed any expense in your IFOS, you will not claim that much deduction under 80 QQB and RRB as well. And fourth, after you get the number, restricted to 3 lakh rupees. So it's a 4-step process, people. Step number 1, restrict the amount to 15%. Step number 2, check how much amount received within 6 months. Step number 3, reduce all the expenses already claimed as deduction under IFOS. Step number 4, restrict the number 2. You will get the deduction eligible. That is QQB and RRB. Income tax says for JJA, QQB, RRB, you will only get these 3 deductions provided you file your return on time. But if you are opting for DTR, QQB and RRB not eligible. Only JJA is eligible. This leaves me with the last one, people, which is heading number CA, your 80 TTA and 80 TTB. Income tax says if you have any interest income which you are ready to offer to IFOS, I will give you a deduction of 10,000 rupees under TTA or 50,000 rupees under TTB, subject to some conditions. Condition number 1, if you are a resident senior citizen, you are under TTB. If you are not a resident senior citizen, you can only claim savings account interest. But if you are a resident senior citizen, you can claim any interest, whether it is FD, RD or savings. One thing to keep in mind, people, if the question says post office savings, first go to IFOS, allow a deduction of 3,500 rupees. 3,500 rupees. Whatever remains is what you will get a deduction for 10,000 rupees under TTA or 50,000 rupees under TTB. Again, for TTA and TTB, you can't claim this deduction if you're opting for DTR. In simple words, people, under income tax, DTR you will get only for 3 items. You will get only for 3 items. Employer's contribution to NPS, CCD. Central government contribution to Agniveer Corpus Scheme, CCH, and 80JJA. These are the 3 items you can claim as deduction under Chapter 6A for DTR. Other than that, everything else is denied under DTR. Everything else is denied under DTR. Yes or no? Yes or no? Yes. After that, people, the last deduction which is left off is something called as 10AA. This section of 10AA basically comes and says, if you are an SEZ, before 2021, if you are in SEZ before assessment year 2021, you will be eligible for something called as deduction under 10AA, subject to a maximum of 100% of the export profit in the first 5 years of incorporation, 50% of the export profit in next 5 years of incorporation, and 50% of the export profits subject to investing the money in SEZ reinvestment reserve in the last 5 years. What are you getting, people? You're getting it 100% of export profits, where export profit means take the profit of the unit. Which unit? SEZ unit. Take the profit of the SEZ unit multiplied by ETO by TTO, which is export turnover by total turnover. That is what the formula is. Yes. For your exams, people, let's pay attention to the fact that the last time you could have started a business is 1920. You are right now in 24-25. So the deduction would be as 1920, 2021, 21-22, 22-23, 23-24. 5 years are over. 5 years are over, which means your exam you can only have 50% deduction. You can only have 50% deduction. If it comes to a point in exam, people, where you see no, you are in the 4th year of business, 3rd year of business, say no deduction itself. Say, because then you would have been incorporated after 1920. If you are incorporated after 1920, anyway, 0 deduction for you. 0 deduction for you. Yes. So the hint for you in the exams, people, if you see 50% happening, do it. If you don't see 50% happening and you're falling in the 100% bracket, say no deduction. Say no deduction, but there cannot be a possibility that in the current year you will get 100% deduction. If you are getting it, you are wrong. That's a hint for you in the current year, people. Yes. Now, how does this export profit work, people? Income tax says if you want to claim 10AA deduction, certain rules to follow. Rule number 1, if you want to claim 10AA, please file your return on time. Rule number 2, if you want to take export profit should be received in India within 6 months from the end of the previous year. Same as QQB. But I'm giving you a special benefit. If you don't want to receive the money in India, it's okay. It is okay. You can keep this money outside India also, provided you get a approval from RBI. Rule number 3, income tax says if you have paid some expenses outside India, like telecommunication charges and all those charges, and that money has been adjusted against export turnover, meaning when you receive money in India, you will receive net of this number. In that case, those expenses cannot be claimed as deduction. In the sense, you will remove it from ETO. In simple words, people, ETO means money which is received in India within 6 months minus expenses paid outside India. When it comes to TTO, total turnover, income taxes, every turnover will be taken. But since you have reduced the expenses from export turnover, reduce this expense from total as well. So whatever expenses you remove from export turnover, same expenses you will remove from total turnover. That is what the section says. People, the whole 10AA provisions are not eligible under default tax regime, which means whatever profit you make in SEZ will first get added to PGBP. If you are under ATR, you claim 10AA. If you are not under ATR, no deduction. PGBP taxes as it is. Yes or no? That is what the provisions are when it comes to 10AA. Yes or no? Yes. 2 things to bear in mind, people. 1, you only claim deduction on SEZ unit. Even if you get an exam question which says there is an SEZ unit, there is a DTA unit, and even if DTA unit is making exports, even if DTA is making exports, will you give deduction for that? No, you will only give deduction for SEZ location. You will only get deduction for SEZ location. Second, this is same as chapter 6A, which means you can only claim this deduction if you have a gross total income. If there is no gross total income, no 10AA, no 10AA, 10AA cannot make you losses, which means if you have a gross total income, you claim 10AA. If you don't have gross total income, no 10AA will come into picture, Third thing, while we will discuss subsequently, but if you are claiming 10AA, 99% of the cases you will have to check for something called as AMT. You'll have to check for something called as AMT, alternate minimum tax. Next topic, but we are giving you right now. 10AA questions, 99% AMT has to be verified. If the question asks for computing tax liability, if the question comes and asks you for computing tax liability, AMT will have to be checked because this is a huge deduction. It's a huge deduction. Yes or no? Yes or no? This is your provisions relating to 10AA and chapter 6A deductions. As you complete your total income, people, comes in an important step in exams, something called as AMT, alternate minimum tax. Alternate minimum tax in income tax means a case where income tax is saying if you are claiming huge deductions, because of which you're not paying enough taxes to me, I can force you to pay a tax in a different regime called as alternate minimum tax, asking you to pay a certain amount of tax in the current year, which you can claim in the future if you have normals higher. That is what is the provisions of alternate minimum tax. Alternate minimum tax works in a weird fashion, people. Income tax comes and says, you tell me what is happening. For an instance, if I come and tell you that in year one I am computing my normal tax. What is normal tax? ATR, normal tax of ATR. If I am computing my normal tax of 3 lakhs, department says I was expecting from you alternate minimum tax of 2 lakhs. Income tax will say great, pay 3 lakhs, no restrictions. I am in year 2. I was ready to pay 4,50,000. Government said alternate minimum, I want 7 lakhs. Income tax will ask you to pay 7 lakhs because that is the minimum requirement. I am in year 3. I was ready to pay 8 lakhs. Income tax said in alternate minimum, I want 12 lakhs. Income tax will say pay 12 lakhs. I am in year 4. I am ready to pay 20 lakhs. Government is asking me for 16 lakhs. People, I will pay 20, correct? Will I pay 20? No. I will come and say, why should I pay 20? I have already paid you extras. People, second year I paid extra of 2,50,000. Third year I paid extra of 4 lakhs. Why should I pay you 20 lakhs? You first refund me what I paid extra. How much extra did I pay? 6,50,000. If I reduce 6,50,000, it becomes 13,50,000. So I am telling government I will pay 13,50,000. Government says no, I want. Government will ask me to pay 16 lakhs. Now understand, people, I was supposed to pay 20. I paid 16, meaning I claimed refund of 4 lakhs, which is coming from past years. Which means I technically have extra paid now 2,50,000. I am in year number 5. I am ready to pay 23 lakhs. Government says I'm happy if you pay 18 also. Hey, government will say pay 23. I will say I'm not paying 23. I have already paid you extra 2,50,000. So first adjust 2,50,000. 23 minus 2,50,000 gives you 20,50,000. Becomes 20,50,000. Now you are saying you will pay 20,50,000. Government is saying I want only 18 lakhs. Government will say pay 20 lakh 50,000. The moment I paid 20 lakh 50,000 people, whatever extra I paid, I got credit. I got a refund or a credit, whatever you call it. Yes. Do I have any extra payments? No. I'm in year 6. I am ready to pay 70 lakhs. Government says enough if you pay 56. You went to government and said, sir, I am ready to pay 70. Government says 56. Government will say pay 70. Hey, do I have any extra payments? Anything to refund? I'll have to pay 70 fully. People, because I've paid 70, can I go and tell government I want refund? No, because I am paying as per normal, whatever I wanted. If I am itself ready to pay 70, why will government give me refund? Government will only give refund when I pay what they want me to pay. When I pay what they want me to pay. In simple words, people, income tax is saying if you pay AMT, whatever extra you paid will be called as AMT credit. Can be claimed in the year in which normal is higher than AMT, but at any point of time don't set off more than what you have to pay to government as AMT. At any stage, if the normal is higher, normal is always right. You never get refund for normals. There is no credit for normals. There is only credit for AMT. Now, whatever credits you made, people, you can carry forward for a period of 15 years. 18 is not normal. 18 is AMT. Why? You are ready to pay how much? 23. Government is asking 18. From your perspective, you are ready to pay 23. Will government give you extra refund? You are ready to pay already that number. I will only give you refund when you don't want to pay that much. Government is forcing you to pay. Right? This is not a government force because you are paying what you want to pay. Yes, that is what your AMT provisions look like, people. Yes or no? This is the simple logic of what we call as AMT credit. Now, how do you compute AMT, people? Income taxes, AMT is nothing but 18.5% of your adjusted total income. 18.5% of your adjusted total income. How do you compute adjusted total income? Income tax says take your total income. Add three components. Component number 1, 10AA SEZ deduction. Component number 2, heading C of chapter 6A, which is 80 JJA, 80 QQB, 80 RRB, and the third and the most important component, section 35 AD, specified business. But the moment you add back the deduction of 35 AD, you can claim depreciation on the assets. When you do this computation, you will arrive at the adjusted total income. On that number, I want 18.5%, and that number becomes my alternate minimum tax. That is what I have to give as government's expectation. Some things to be kept in mind, people. Alternate minimum tax is only applicable if you are under ATR. You will not be applicable if you are under DTR. In DTR, you will only do DTR. You don't do AMT. Rule number 2. Even if your total income has any special incomes, when you compute AMT, it is 18.5% on all incomes. It doesn't matter whether you have specials or not. All income will be computed at 18.5%, meaning even if the question says you have winnings inside it, for the purpose of AMT, it is always 18.5%. The winnings ka 30% is only for ATR and DTR, not for AMT. Rule number 3. If your AMT income, your adjusted total income is more than 1 crore, more than 50 lakhs, more than 2 crores, more than 5 crores, you will levy surcharge and cess as well. It doesn't matter even if normal is less than surcharge limits. If your adjusted is more than surcharge limits, you will apply surcharge on those. Yes. Rule number 4. If an exam question comes where they say, I don't know what you want to do, you compute tax as if the manner most beneficial. You will check ATR, DTR, AMT, all the three. How will you check which one is better? It is ATR or AMT, whichever is higher, compared with DTR, whichever is lower, compared with DTR, whichever is lower, because DTR ka AMT will not come. So take ATR or AMT, whichever is higher, that will be compared with DTR, whichever is lower, whichever is lower. Now, do you have to do AMT in all questions in exam? Answer is no. Income tax says you only need to do AMT if any of the three items are claimed. If any of the three items are claimed, 10AA, JJA, QQB, RRB and 35AD. If only these items are there, you have to check for AMT. If these items are not there, don't check for AMT. So in an exam question, they will not tell you that you have to do AMT. They will simply give you these deductions. You need to keep in mind that you have to do AMT and then compare whichever is higher, whichever is higher. Point number 4, income tax says if your AMT becomes higher, if your AMT becomes higher, the adjusted total income which you have will be deemed as the total income, will be deemed as the total income, which means it will be assumed that your total income is as per AMT and not as per ATR, and not as per ATR. These are some rules to follow. These are some rules to follow. Yes. So for example, people, if I give you a question in which I come and say my ATR is 100, my DTR is 120, my AMT is 110, you will choose ATR or AMT, whichever is higher, compared with DTR, whichever is, therefore I'll pay. But the moment I pay 110, people, I can claim AMT credit for 10 rupees. I can claim AMT credit for 10 rupees because I paid as per AMT. I paid as per AMT. Correcta, correcta, correcta. People, I have 100, 110, 120. I would like to pay 110. I would like to pay 110. Now some people may come and say, Rahul, it is better to pay 120. No, because you'll get 20 ka credit. You'll get 20 ka credit. I agree. That's completely right. But the problem is, when will you set off the credit? No one knows. No one knows. I am rather comfortable paying that extra 10 rupees right now than maybe losing the 20 rupees in the future. So I would rather pay 110. I would rather pay 110. People, have I paid any AMT tax? This is not the same. Independent cases. Tanya cases. I'm not looking at together. Tanya Pakna. Yes, yes. Will your AMT credit come in this case? Will your AMT credit come in this case? No. No. I am having case number 3. It is 100. It is 110, 100, 120. I will choose 100 DTR. I will choose 100 DTR. I have 110, 120, 100. I will 110 is the answer. 110 is the answer. It is whichever is higher compared with whichever is lower. Compared with whichever is lower. I have 120, 100, 110. It is 100 DTR. 100 DTR. And finally, I have 120, 110, 100. I will pay 110. I will pay 110. That is what the answer is. That is what the answer is, which means in any combination, only one combination will have AMT credit, which is the first combination. Every other combination will not have AMT credits because you're either paying as per ATR or as per DTR. As per DTR, the only one case where you can pay as per AMT credit is the case number 1. Ideally, the logic is ATR, AMT, whichever is compared with whichever is. That is what the idea is. That is what the idea is. Clear? 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 As much as we are in AMT, people, one small topic which I wanted to complete along with it is called exemptions. It's called exemptions. The last page of your chapter, which comes and talks about what kind of exemptions can you claim. What kind of exemptions can you claim? People, not everything has to be read, but some things are very important from exam. Yes, exemptions are basically those items where income tax is coming and telling these are incomes which you have earned, but I don't want tax on it. I don't want tax on it. This is not a deduction. This is an exemption, meaning you will not even take that into consideration. You will not even take that into consideration. Some items we already discussed till now. Agricultural income, share of profit from firm or a HUF. Reverse mortgage. We discussed about reverse mortgage. Point number 4, when we did residential status, I told you allowances and perquisites given by a government to a embassy person, exempt. All those items we discussed. More items for you to keep in mind, people. 1042 comes and says if you have any interest income which is coming from an NRE account, non-resident external account, these incomes are fully exempt. These incomes are fully exempt. Very, very important from exam perspective. Having an interest income from NRE account, an interest income from NRE account. Next, income tax comes and says if you have received any kind of compensation from a central government or a state government for any disaster related things, some disaster happened for which government has given you compensation, fully exempt. But please note, this is only exempt if government gives it. If any random charity guy coming and giving you money is fully taxable, Next item which I want you to keep in mind is the 1017. 1017 comes and says any kind of daily allowance or constituency allowance which is received by MPs and MLAs is fully exempt, but this is only under ATR. Under DTR this is fully taxable. And finally, if you get any kind of compensation because you have received an award from government like Veer Chakra, Paramveer Chakra, Mahavir Chakra, Sam Chakra and all, it is all exempt. When you hear a weird name, take it as exempt. But when you see weird name in income, it is exempt. Weird name in investment is ATC. Weird name in donation is ATG, category number A. Weird number in TDS is not liable for TDS. And weird name in investments is investments as in capital asset is 54 capital gains exemptions. 54 capital gains exemption. That is how weird name works. Clear? Yes. This is your exemptions chapter. Great. Let's quickly summarize what is your default tax regime, people. We've already discussed this when we came to our other topics. Yes, we've already discussed it here and there, but a quick summary of what a default tax regime looks like. Income tax comes and says if you are preferring to have a lower tax rates, you can choose to forego some of your incomes and therefore you will be put into something called as default tax regimes. The slab rates of the current year has been notified as 0 to 3 lakhs, 0, 3 lakhs to 7 lakhs, 5%, 7 lakhs to 10 lakhs, 10%, 10 lakhs to 12 lakhs, 15%, 12 lakhs to 15 lakhs, 20%, and after 15 lakhs directly 30%. That has been notified. If you are going to have a total income which is up to 7 lakh rupees, you will be eligible for something called as rebate with a maximum limit of 25,000. If you are going to have an income more than 50 lakhs, you will be liable for surcharge at the rate of 10%. Income more than 1 crore will be liable for a surcharge of 15%. Income more than 2 crores will be liable for a surcharge of 25%, and you will leave it there. Any person who's falling exactly near to 7 lakhs, 50 lakhs, 1 crore or 2 crores will be eligible for something called as marginal relief. Understand, marginal relief of rebate is only applicable for default tax regime, has not been notified for alternate tax regime. At any point of time, if you have any special incomes like capital gains, unexplained income and all those things, those will continue to be taxable at their respective rates. What are the items which are foregone when it comes to default tax regime, people? We will discuss this headwise. On a headwise basis, first thing when it comes to salaries, the first item denied to you is HRA. Then when it comes to other allowances, people, they have denied you all other allowances except for 4 items. One is your transport allowance for disabled people, your travel allowance, your conveyance allowance and your daily allowances. After that, you directly move on to your perquisites where you have a disregard of leave travel concession and something called as food coupons. After that, you get into deductions, where deductions, they say if you're going for salaries, then you get a higher standard deduction of 75,000, but all other items like entertainment allowance and professional tax are not allowed as deduction. Coming to the chapter of house property, income tax comes and clarifies if you are going into default tax regime, you will not have the option of self-occupied property. Therefore, the self-occupied property will become 0. When it comes to PGBP, people, only one item which has been denied to you. They come and say you will not be able to claim any additional depreciation. But other than that, they have also denied you what is called as your specified businesses. Your specified businesses have been denied to you, where you will now move back to normal business and therefore claim normal depreciations. You will claim normal depreciations. And the last item and the most critical item, if you are getting default tax regime question, that if you are going for scientific research, income tax will come and clarify. You can have expenses in house. You can't have donations. You can't have donations. Donations will get denied as a deduction. Yes, no changes in capital gains. The capital gains remain the same. When it comes to income from other sources, two items to be kept in mind. One is that if you are going for family pension, default tax regime will give you an enhanced deduction of 25,000, which was normally 15,000 under alternate regime. And second, we discussed in exemptions people that if you are getting any MP and MLA's daily allowance or constituency allowances, these become fully taxable. The next chapter of clubbing will come and clarify that if you have a minor child and you are going to get any exemptions of 1,500, this exemption of 1,500 will get denied under default tax regime. When it comes to set off chapter, two things to be kept in mind. Income tax says any past year losses which pertains to items income tax does not allow under default tax regime, those losses will lapse. Other than that, in the current year, if you are having HP loss, you can only set off against HP income. If you don't have any HP income, this loss will lapse permanently. This loss will lapse permanently. After that, you get a chapter 6A people where income tax says under chapter 6A everything is not allowed as deduction except for three components. First item is 80CCD employers contribution, second is 80CCH government's contribution, and third thing is 80JJAA. 80JJAA, three items are allowed as deduction to you. Fourth, if you are going into AMT provisions, income tax says no AMT provisions will apply, but if you have any past AMT credit, that will also get lapsed. That will also get lapsed. Finally, people, if you are having any kind of 10AA deductions, that will also get lapsed. That will also get lapsed. This is what your chapter on default tax regime looks like. Two things which is to be kept in mind, people. Can you opt default tax regime every year? Answer is yes and no. Answer is yes and no. If you are a person not having business income, income tax says you can choose DTR every year. You can choose DTR every year. When mean this year you can choose DTR, next year you can do ATR. Again, go back to DTR, perfectly allowed. But if you are having business, you will be under DTR normally. If you want, you can move to ATR by filing a form. You can move to ATR by filing a form. Once you move to ATR, you are always in ATR. You are always in ATR. But once in your lifetime, you will be allowed to come back to DTR. If you come back to DTR, no more ATR will apply. So which means you will start with DTR, go to ATR, come back to DTR, and full stop. And full stop. You can't move after that. You can't move after that. Notice one thing carefully, people. This is default tax regime, meaning this is the primary regime. This is the primary regime. To choose ATR needs to get an approval by filing a form. Gets an approval by filing a form, and income tax comes and clarifies this approval will have to be granted before the due date of return filing. Before the due date of return filing. So when you start filing your return, first apply for a form, then opt for ATR, Without filing the form, you cannot opt for ATR, which means income tax has not clarified that you need to file your returns on time. Income tax only wants you to file a form. But from your exam perspective, ICI has made an assumption that if you don't file your returns on time, it is assumed that you would have not filed the form also on time, and therefore ICI is making an assumption that if a return is filed late, you are under DTR unless the question mentions you are under ATR. So for every case where you file a return late, notice what is happening in the question. Nothing given, assume that the person is opting for DTR. This is what the provisions are with regards to DTR. Clear enough, people? Yes. Last thing for you to understand more from a TDS perspective, income tax comes and clarifies if you are a salaried person, you need to inform your employer which regime are you choosing at the start of the year. You need to inform your employer whether you want to go for DTR or ATR. Depending on what you inform your employer will deduct taxes under section 192. At any appropriate stages, if you feel like you want to move out of DTR or ATR, do not inform the employer. Once an information has been informed to employer, he will continue with the same until the year end. Question to you: if you have informed employer that you want DTR, during return filing stage you find ATR is better, can you move to ATR? Yes. You have only informed employer for the purpose of computing TDS. He is not the person deciding your regime. Only I can decide my own regime. which means whatever you inform to employer is only for the purpose of deducting TDS, will not impact your regime change. You can always change your regime during return filing stages. You can always change your regime during return filing stages, perfectly allowed, but don't keep hanging the employer in the middle. Employer, you inform one regime, that will continue for the year. That is what the rule is. Yes. Now coming to the business case, people, where I came and told you that if you are in DTR, you can move to ATR and come back to DTR. Imagine on a subsequent date you feel like no, now ATR is better, I want to go back. Can you ever go back? No. But income tax says I will permit you to do that if you are not going to continue with your business incomes, people, because salaries and all I came and told you, you can choose every year. So income tax says this restriction will only apply as long as you are following PGBP. The moment you stop PGBP, you will become a normal person, and therefore normal person can choose DTR and ATR every year. So it is not like it's permanently lapsed, but it is permanently lapsed as long as you are running business, a business or a profession. This is what a DTR provisions look like. Clear enough, people? Are we good to go? Yes, great. This is what your provisions are on DTR. Let's move on to the next topic, people. We are looking at what is called as payment of taxes. Here is me coming and telling you that after you have computed your income, you have computed your tax liability. How do you discharge your tax liability? Income tax says in India you can discharge your tax liability by 5 methods. First is by TDS. Someone else will do your taxes. Second is by doing advance tax. You will estimate your own taxes. Third, you will do something called self-assessment tax. This is where you are paying taxes in the assessment year. Fourth is something called as regular assessment tax. This is tax which is paid during assessment stage. And finally, something called foreign tax credit, which is taxes deducted in other countries. The last two topics of regular assessment tax and foreign tax credit is part of final level syllabus, so we are not discussing it right now. We will be discussing TDS, advance tax and self-assessment tax. When it comes to advance tax, people, income tax says you will be liable to pay advance tax the moment your advance tax liability exceeds 10,000 rupees. But this provisions will not apply if you are ended up becoming a resident senior citizen who does not have business income. Now what do you mean by advance tax liability, people? Income tax says advance tax liability means nothing. It means your final tax liability minus the TDS, which has already been deducted and deposited. If it is not deducted or deposited, you cannot reduce that TDS. So what is advance tax liability? Take your final tax liability, claim all your credits and everything, and reduce your TDS. You will arrive at a number. That number is called advance tax liability. Understand, people, the tax liability which you are talking about is not the tax liability which you are estimating. It is a tax liability which is as per income tax return. It is your tax liability as per income tax return, meaning during the previous year you will estimate what your tax is, but income tax will assume your tax only as per return. So if there is a mismatch between both, you will be liable for interest. Yes. So what is the provision? Income tax says you should have an advance tax liability more than 10,000 rupees in order to be attracting advance taxes, but not applicable if you are a resident senior citizen, not liable for PGBP. When you have to pay advance taxes, people, income tax says advance taxes are paid in 4 installments, where quarter 1 stands on 15th June, quarter 2 stands on 15th September, quarter 3 stands on 15th December, and quarter 4 stands on 15th March. Income tax says by quarter 1 you should have discharged 15% of your total advance tax liability. Quarter 2 you should have discharged 45% of your total advance tax liability. Quarter 3 you should have discharged 75% of your total advance tax liability, and 15th March you should have discharged 100% of your total advance tax liability. Please bear in mind that the 15, 45, 75 and 100 is cumulative numbers. You're not paying 15 and then 45. You're paying 15 and then difference of 30, which means if you have paid less than 15, you can pay the balance by the quarter 2. Don't end up paying 15 plus 45 plus 75. That is wrong. Yes or no? At the same time, people, income tax also comes and clarifies, even if you have not been able to pay 15 in quarter 1, it is enough if you have paid 12 in quarter 1 and enough if you have paid 36 in quarter 2. How does it work, people? 15 becomes 45, so 12 becomes 36. Multiply by 3. So quarter 1 you should have at least paid 12. Quarter 2 you should have at least paid 36. If you have done that also, income tax will let you go. If you don't do that, then you will be liable for interest. You will be liable for interest. Exception to the rule number 1. Income tax is if you are opting for presumptive taxation. Do not pay 4 quarters. Pay only last quarter. But this is only for business and profession. It is not for transport operators, because transport operators are paying all 4 quarters. Exception number 2. Income tax is you will have to estimate all your incomes and pay taxes right from quarter 1. But there are 4 incomes which I am okay if you don't pay from quarter 1, but rather pay from the quarter in which you have earned it. Items where you don't expect money coming regularly. Items like winnings, capital gains, dividend income, except for 222E, which is your loans and advances. And item number 4 is called first time PGBP income. If any of these 4 items are accruing to you in the current year, you don't need to pay advance tax from quarter 1. You need to pay advance tax only from the quarter in which the money is taxable. Also bear in mind, people, that if you are having capital gains in quarter 2, you will not end up paying 100% of the tax in quarter 2. You will end up paying 45% of the tax in quarter 2. The balance can be paid in subsequent quarters. Similar logic, people, if you have winnings in quarter 4, you will not pay anything in quarter 1. You will not pay anything in quarter 2. You will not pay anything in quarter 3. You will end up paying everything in quarter 4. Imagine I have first time PGBP income earned on 20th March. People, my last due date was 15th March. In that case, whatever I have to pay on 20th March, should I pay, not pay? I will still have to pay before 31st March. Because, people, even though you will not be liable for 234C, you will become liable for 234B, and therefore please ensure this payment is also done by 31st March. Yes or no? Yes. If I give you another example where I say I want dividend income in quarter 3. Quarter 1 I'll pay nothing. Quarter 2 I'll pay nothing. Quarter 3 I'll pay 75%. Quarter 4 I'll pay the balance 25. And I'll close the answer with that. Yes or no? Yes. Please understand that just because an income is accruing post 15th March does not mean you don't have to pay. You have to pay it before 31st March. That is what the rules are. A failure to pay these items, people, as advance tax will be making you liable for something called 234C interest, which accrues 1% per month or part thereof, which means whatever number you have not paid in quarter 1, you will be liable for 3% interest. Whatever number you have not paid in quarter 2, you will be liable for 3% interest. Whatever you have not paid in quarter 3, you will be liable for 3% interest, and whatever you have not paid in quarter 4, you will be liable for 1% of interest. Notice one thing carefully, that if you have missed the due date of 15th, and paid it on 16th, can this 3 become 1? No. Any payment happening after 15th of that month will be assumed as payment of next quarter. What does it mean, people? Imagine quarter 1 I have to pay by 15th June. If I have not paid it by 15th June, I paid it on 16th June. Income tax will assume this was never paid. It was directly paid on 15th September. Which means quarter 1, whatever remains, you will have to do interest or 3%, even though next day itself you made payment. Meaning the 3% will not change. The next 3 also will not change. The next 3 also will not change, and the next one will also not change. The number remains the same. Any payments happening after that 15th of the due date will be assumed as payment of next quarter. Yes or no? Yes. Now, people, if I have defaulted in not paying the money by 31st March also, 234C will stop on 31st March. After 31st March, from 1st April, you will be liable for 234B interest. Where income tax says whatever number is remaining as on 31st March, you will be computing self-assessment tax right now. Before you start computing self-assessment tax, please pay 234B interest at the rate of 1% per month or part thereof right from 1st April. 1st April of assessment year till the date on which the tax is paid off, till the date on which the tax is paid off. So you'll do 234B at the rate of 1% per month or part thereof from 1st April of assessment year till the date of actual payment, till the date of actual payment. Yes or no? Yes or no? Which means, people, if you are doing 234B, if I have 1 lakh amount outstanding on 1st April and I pay 20,000 in April, I pay 20,000 in May, I pay 20,000 in June, income tax will say, before you pay 20,000 in April, first compute 234B for April, then pay some number, and then again compute 234B for May, and then compute the number, and then do 234B for June, and then compute the number. That is how you will keep doing it. So you will keep reducing your 234B interest as much as you keep paying your self-assessment taxes. Yes, yes, yes. Finally, people, income tax says if you are going to pay self-assessment tax, you cannot adjust your self-assessment tax against tax directly. First, self-assessment tax will always be adjusted against late filing fee. Next, self-assessment tax will always be adjusted against interest. Whatever is remaining alone will be adjusted against tax liability, so as to ensure department gets more interest. And finally, for the purpose of this chapter, income tax says whenever you compute interest, you will always round down the tax to nearest 100. You'll always round down the tax to nearest 100. So take your tax liability, round it down to the nearest 100, and then compute the taxes. That tax will be multiplied by interest for the purpose of computing 234C or 234B. Please note that after you compute interest, the tax will remain the same. You will not round down the tax, because tax will get rounded off to the nearest 10 rupees. Will get rounded off to the nearest 10, which means only for the purpose of computing interest I am rounding down. After I compute interest, I will round off to the nearest 10 rupees. That is what the section says. So that is what will happen, people. You will round down your tax to the nearest 100 by rounding down. Compute the whole thing, and then you can round off to the nearest 10 rupees. Yes or no? This is what the computation says. And like I said, when it comes to order of set off, you will first adjust against late filing fee, then compute interest, and then adjust against interest, then compute tax, and finally what you have, you can adjust against taxes. Clear? Yes. Let's start with the lengthiest topic of your syllabus, people. We are looking at what is called as TDS and TCS. From an exam standpoint, carries 4 marks. Will come as a part of question number 2B. Unfortunately, people, for the current year, there is not much amendments in your TDS, and therefore any question can be asked. 2 critical amendments which you need to know probably is: 1, rates have changed. Wherever there was a rate of 5%, the rate has become 2%. So therefore there is no more 5%, there is only 2%. Second is in an amendment of 194 IA. We will discuss about those. As such, let's start with the chapter, people. The understanding of the chapter: income tax comes and says whenever a person makes a payment to another person, he is liable to do something called as TDS, tax deduction at source, which means before I make the payment to you, I will withhold some money and then give you the net payment. Income tax says it is mandatory for a deductor to do so, because it ensures that the deductee reports his appropriate incomes. Failure to do so by the deductor will make him liable for 3 consequences. Consequence number 1, he will be made a disallowance under PGBP at the rate of 100% of non-residents and 30% for residents. Issue number 2, he will be liable for an interest under section 201 at the rate of 1% for non-deduction, 1.5% for non-payments. And issue number 3, he can be levied penalties, which is not part of your syllabus. Yes. For your inter-syllabus, you will only be discussed about TDS payments happening for a resident. Non-resident payments have been moved to finals, so you don't discuss it with me here. For you to start TDS, people, some rules for you to follow. Rule number 1, TDS always happens on payment to the party or credit of the party in your books, whichever is earlier. Meaning, I am the deductor. In my books, either you should have been received a payment or I should have booked you as my creditor. Either of the 2 events happen, I will be liable for doing TDS. Some exception to the rule, people. Exception number 1, if you are going to make a payment for salaries, then in that case it is done on payment basis. Winnings, because I don't know who the winner would be. Dividend income, because I cannot determine who the shareholder is. Compensation for compulsory acquisition, because capital gains itself comes and says you are going to tax in the year in which installments are received. Premature withdrawal of RPF, because I need to know whether you will hold it for 5 years or not hold it for 5 years. Maturity of life insurance proceeds, because it is taxable only when the life policy matures, and cash withdrawals only when I know you are going to withdraw more than 1 crore or 20 lakhs. Yes, these cases you will do TDS only on actual payment basis. Case number 2, people, income tax says if I notify your rate under any section, the rate will remain as it is. You will neither add surcharge nor add cess, except for 2 components. If it is payment for salaries or it is a payment made to non-residents, those payments will be liable for surcharge and cess. This is me coming and clarifying you people that when you have winnings, TDS will happen at the rate of 30% flat without any surcharge and cess. But when you pay tax, you will pay tax 30% plus surcharge plus cess. And therefore, if the question comes and asks you to compute advance tax, you will get TDS credit only for 30%. The balance surcharge and cess you need to pay. And therefore, if that number goes more than 10,000 rupees, you are liable for advance tax. Yes or no? Yes or no? So if you get a question, people, where they come and say 1 crore is my winnings, you know 30 lakhs would have been deducted by the giver, but whatever happened on that surcharge and cess has not happened, and therefore that surcharge and cess you need to compute. If you compute the surcharge and cess and that number goes beyond 10,000, you are liable for, from the quarter in which winnings is taxable. Yes or no? That is what the theory question looks like, people. Yes. Next, income tax is coming and saying TDS normally happens on all sections except if you are individual or HUF who is not having turnover more than 1 crore in case of business and 50 lakhs in case of profession, not in the current year but in the previous year. For your exam it is 23-24. For your exam it is 23-24. In 23-24 PY, if the turnover was less than 1 crore in business and 50 lakhs in case of profession, income tax for some items you will not do TDS. The rule of thumb is hijacker. 194H, 194I, 194J, 194A, 194C and 194R. These cases will not be liable for TDS if your turnover does not exceed 1 crore in business and 50 lakhs in case of profession in the immediately preceding previous year. H stands for commission, I stands for rent, J stands for professional payments, A stands for interest, C stands for contract and R stands for perquisites, business perquisites and gifts. Then people, income tax says when you have to do TDS will happen whether you are doing commercial payments or personal payments, except for 3 sections where you will only do TDS if it is commercial in nature. Case number 1 is 194C, contract payments. Case number 2 is 194J, which is professional payments, and case number 3 is 194R, which is business perks. These payments only happen TDS when you are doing it for official reasons. Then comes the threshold limit, which is given in every section. People, income tax says if a section says a threshold limit, you will apply TDS only if the threshold is crossed. Meaning if the threshold is not crossed, TDS is 0. If the threshold is crossed, TDS is from first rupee. You will do TDS on the whole amount. Don't do it exceeding threshold. It is from the whole amount, except for 2 sections. People, income tax says if you have 194Q, which is purchase of goods, and 194N, which is cash withdrawals, you will do TDS only from the threshold limit. Where Q ka threshold limit is 50 lakhs and cash withdrawals ka threshold limit is 1 crore or 20 lakhs. Every other case, people, wherever threshold limit is given, you will start from rupee 1. At any appropriate stages, if you are the deductor, you need to collect from the deductee his PAN number to deposit the TDS. Failure to collect PAN number from the deductee will make the deductee liable for a higher TDS at the rate of actual rate or 20%, whichever is higher. However, this rate will become 5% in case you are in 194O or 194Q. 194O is not part of your syllabus. 194Q original rate is 0.1, will become 5. Every other case, no matter what the rate is, it will become 20%. It'll become 20%. The last year when this exam will be tested of people, that income tax comes and says, if you don't file your returns on time, if you don't file your returns on time and income tax finds out that your TDS in that return was more than 50,000, the deductor will now be liable to deduct TDS on your payments at a higher rate of 2x of the rate or 5%, whichever is higher. This is the last year this section is going to be tested. Next year it has been deleted off. Therefore this is important. Should be coming for either of the exams. Yes or no? Yes. If you are a person who is neither having a PAN number nor giving return filings on time, income tax says take the highest of all the two. Whichever is the highest number will be the TDS which is liable. Yes or no? Yes. For example, people, if I come and say I am in contractor payments, I neither give you PAN number nor give you returns. In that case, income tax will say, because you did not do PAN number, 20%. Because you did not do returns, it is 2x the rate, which is 4 or 5, whichever is higher. Therefore 5, higher of both is 5 or 20, whichever is higher. Therefore 20 becomes the rate. Clear, not clear? Clear. This is what the section operates on. Yes. After you know the basics, people, what does income tax come and say? Every section has their own respective deductor, deductee, nature of payment, rate of TDS, and finally the limit up to which you should not deduct TDS. When it comes to section 192, income tax says deductor will be the employer, deductee will be the employee, nature of payment will be salary payments, payment deduction will happen based on the employee's slab, and therefore there is no threshold limit except for what he is liable for. This section also comes and clarifies that while employer is liable to do TDS only on the salary component, if the employee also gives him other income details, employer can consider those and deduct the net TDS. When employee is reporting you any losses, employee can only report losses pertaining to HP, because no other losses can be set off against salaries. So only report HP ka losses. Then whenever an employee furnishes any deductions, exemptions, declarations, employer is bound to verify all those details. From an exam standpoint, they may ask you questions as if you are planning to give HRA exemption to your employee. As an employer, what kind of deductions and proofs should you collect? The answer is very simple. Check what is the exemption. Exemption is list of 3. First one is actual. You are only going to give, nothing to verify. Second, 50% of salary or 40% of salary, depending on the state. People, salary data 50-40 also nothing to verify. Third becomes rent paid minus 10% of salary. 10% of salary also what you don't know, rent paid. So you will go and ask an employee to give him how much did you pay, to whom did you pay, what is his PAN number, and give me the agreement. So data which you can collect: rental agreement, rent receipt, proof of payment, landlord's PAN number. The cases like these is what you can answer questions in exam, people. Just use your head, use the exemption, get the answer. There is no rocket science in this. Max to max, they'll ask an MCQ question, so figure it out from there. Wherever you see more items are asked, that is the right answer. Then you have 192A, people, which talks about withdrawal of RPF. Income tax says if you are going to withdraw any money from your RPF account, which ends up becoming taxable, because you withdrew within 5 years, then the amount which is withdrawn will be liable for a TDS at the rate of 10%, provided you have withdrawn more than 50,000 rupees. You have withdrawn 50,000 rupees or more. Yes. Although please bear in mind, people, this TDS will not apply if you find out that the money withdrawn within 5 years is for reasons which is approved under salaries, like for illness, transfer to another company, company itself is shut down. All those cases you will not be liable for TDS. You will only be liable for TDS if there is no reasons specified in this. Then comes 193, people, which comes and says if you are going to have any interest on securities, income tax says you will be liable for a TDS at the rate of 10% on those securities. Just thought in mind, in exam if you get a security and there is weird names in it, TDS is not applicable. If it is a case where simple they have come and said debenture interest, TDS will be at the rate of 10%. So look out for weird words, no TDS. No, TDS is what the answer is. Then you have 194A people, the important section from exam, which says you are going to get interest on deposits. Interest on deposits. Income tax says interest on deposits can be given by two people, either banks or companies. Banks or companies. If you are receiving interest from a bank, in the nature of savings, TDS is not applicable. If you are receiving interest in the nature of FD or RD, TDS will be applicable if you cross 40,000 rupees for normal citizens, 50,000 rupees for resident senior citizens. If you are in companies and you give a deposit where the interest is more than 5,000 rupees, then you will be liable for TDS at the rate of 10%. Income tax comes and clarifies, when you are talking about banks people, you will need to check whether the banks have something called as core banking solutions. If the bank has core banking solutions, you will look for 40,000 per bank. If you don't have core banking solutions, you look for interest per branch. Please mark this as important in case you're reading the chapter of. Yes. Next, income tax comes and clarifies, if you are going to have any kind of fixed deposit made with the courts because you're fighting a case, bank will not deduct TDS until the case is won and the money is transferred to the winner. TDS will not happen in the hands of the registrar of the court. You cannot do TDS on the court, you will do TDS on the winner of the case. Then comes section 194B and 194BB. This section 194B and 194BB comes and clarifies that if you are going to have any winnings, you will be liable for a TDS at the rate of 30%, provided the winnings quantum is more than 10,000 rupees. Please note that winnings will be liable for TDS whether it is received in cash or in kind. Even if the winnings is received in kind, the person giving you the winnings will first have to collect cash for the TDS from you and then discharge the winnings to you. If he does not discharge the winnings before collecting cash, this is a default. You can be treated as assassin default. Yes. After B and BB comes people BA, the last year's amendment provision, which comes and says if you are going to receive any online winnings, income tax says that will also be liable for a TDS at the rate of 30%, either on withdrawal or if there is no withdrawal on 31st March. The formula remains the same. The formula is closing balance plus withdrawals minus opening balance minus deposits. Take the number, that is the winnings you have. In that, how much ever you withdrew first, TDS on that already happened, and therefore what you did not withdraw, you do TDS on 31st March. That is what the rule says. Then you have 194C people, which talks about contract payments. Income tax is if you are going to make a payment to someone for contract of work, you will be liable for TDS at the rate of 1% if the person receiving it is an individual or HUF, and 2% if the person receiving it is a other than individual or HUF. The threshold limits given here is 30,000 per payment and 1 lakh rupees per annum. This is what the section says. Where and all will you apply 194C people? You will apply it in the case of advertisement charges, food catering charges, any kind of job work charges. All those kind of payments will be liable for 194C. But when it comes to subcontracting or job work, income tax comes and clarifies 194C will only apply in case you are providing raw materials, meaning it can only be 194C if you provide raw materials and he manufactures the product. If you are not providing the raw materials and he is buying the raw materials on his own, it is 194Q. You are purchasing goods. Only when you provide raw materials and he manufactures the product, it is supply of service, and therefore it is 194C. The important thing from exam perspective, where income tax says you are a transport operator. If you give me a declaration where you confirm that you have less than 10 vehicles and you have also given me your PAN number, I will not deduct TDS on you. TDS will only happen on you if you don't give me a declaration or don't give me a PAN number. Please notice carefully that if you don't give me a declaration, I will still do normal rates of 1% and 2%. But if you don't give me PAN number, I will deduct higher rate of 20% off. The last circular people, which comes and clarifies if you are in advertisement if you are in advertisement and I come to you and come and say I want to make an advertisement, you have two options. Either you come and tell me, sir, advertisement is already ready, you just have to pay money and I will broadcast. Or option number two, you come and say, you sit with me and tell me what kind of advertisement you want. Income tax says if the advertisement is already ready and you are just buying, this is like a goods. This is like a goods and therefore 194C will not apply. But if you are sitting with me and discussing with me how to make the advertisement, then it is contract of work and therefore 194C will apply in that case. Yes. So items to be marked important, people, is when it comes to work, you will have to have sold raw materials. Items where you are not liable for TDS if you are a transport operator furnishing declaration with less than 10 vehicles and a PAN card. And if you are going to do broadcasting services, then you should check whether there is a content already available or it is something you are newly making. It is something you are newly making. Clear? 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 Yes. Next comes your 194D, people, talks about insurance commission. If you are going to receive any insurance commission, the payment which you receive will already be liable for a TDS at the rate of 5% before the threshold limit of 15,000. Unfortunately, this is the only section in the whole income tax this year that has not changed. That has not changed. This remains at 5. Every other thing becomes 2%. Every other thing becomes 2%. Next comes 194DA, people, life insurance proceeds, where income tax says if your life insurance proceeds have become taxable, because of some reasons. Reason number one, your premium amount has exceeded. Your premium amount has exceeded 20% of sum assured or 10% of sum assured or 15% of sum assured for handicapped people. Or from 2023, if your premium amount is more than 5 lakh rupees, you will be taxable for 194DA. You will be taxable for 194DA at the rate of 5% up to September and at the rate of 2% after October. After October, where income tax says you should have received at least 1 lakh rupees in your hand. You should have received at least 1 lakh rupees in your hand for you to be liable for TDS. Notice carefully, people, there is September and October, meaning if the money comes to you before September, it is 5%. If the money comes after September, it is 2%. That is what the rule is. That is what the rule is. Although bear in mind, people, 1 lakh rupees is for the whole year. Is for the whole year, which means in September, people, I received 1,30,000. I received 1,30,000. I will deduct TDS on full 1,30,000 at the rate of 5%. In October, I received 2,30,000. Already threshold crossed there. Therefore, directly 2% in the October payment. 2% in the October payment. Although bear in mind, people, that this is insurance proceeds and therefore the insurance company already knows how much premium you paid. How much premium you paid. Therefore, TDS is not happening on the amount you receive. TDS is happening on your income. TDS is happening on your income, where income means money you received minus premiums you paid. Minus premiums you paid. So understand, people, the 1 lakh rupees is the amount received. But TDS is not going to happen on 1 lakh rupee. TDS is going to happen on the income which is taxable. On the income which is taxable. Yes or no? Yes or no? After DA comes, people, 194G, which talks about lottery commission, where income tax says if you are going to be selling lottery tickets and receiving commission out of it, TDS will happen at the rate of 5% before September, 2% after October at a limit of 15,000 rupees. And finally, the next section, which is the important one, 194H, which says if you are going to receive normal commission, threshold will happen 15,000 rupees. TDS will happen at the rate of 5% up to September, 2% after October. Here it is commission, people, and brokerage, which means there should be a principal agent relationship. There should be a principal agent relationship. Doing a transaction on a principal to principal basis will not be liable for 194H. You will either check for C or J. You will check for C or J. That is what the section comes and clarifies. Then comes your 194I, people, which talks about rent. Income tax says if you are going to take a property on a rent, you will be liable for TDS under section 194I at the rate of 2% if you are renting something called as plant and machinery or equipment, and 10% if you are renting any other things like immobile properties. But for both the things, people, you should have at least paid 2,40,000 to this person. 2,40,000 to this person. Notice one thing here carefully, that if I go to one person and I ask him to give me land also, and I ask him to give me furniture also, furniture also, people, both will be checked for the purpose of limit, but land will be done at the rate of 10% and furniture will be done at the rate of 2%. That is how it will operate. That is how it will operate, which means when you check from me to him, you should check for a limit of 2,40,000. But the moment the threshold limit crossed, every payment will be liable as per their respective rates. As per their respective rates, it is not 2,40,000 for 2 separately and for 10 separately. It is 2,40,000 liable for both together. For both together. Notice that the whole TDS chapter comes and says limits are from me to you. Are from me to you. Between us, limit is 2,40,000. If I am paying you some number and if I am paying someone else some number, for that number 2,40,000 will apply separately. For you 2,40,000 will apply separately. I cannot club both. I cannot club both. TDS threshold limits are deductor, deductee specifics. Deductor, deductee specifics. Yes or no? Yes. At the same time, people, income tax is coming and clarifying. 194I talks about rent, which means I want to enjoy the property. I am not interested about the service. I am not interested about the service, which means if you get a question in exam and the question exam says, I have rented a truck for transporting my products. I have rented a truck for transporting my products. People, am I interested about renting the truck or for transporting the products? I am interested about transporting the products. Therefore, this is not I, this is C. It's not I, it is C. Correct, not correct? Yes or no? That is how it will operate, people. That is how it will operate. Similar logics, people. If I come and tell you that I have taken a cold storage facility, cold storage facility for storing my ice creams, for storing my ice creams. Am I more interested about the warehouse or am I interested about the cold facility? I am interested about the cold facility, which is not 194I, it is 194. That is what the idea is. That is what the idea is. So watch out for what you are doing with the payment. If you are going to make the payment for enjoying the property, it is 194I. If you are giving the payment for enjoying the service, 194. That is what the answer is. Next, if you are getting into 194IA, the amendment of current year and therefore expected question in exam, the amendment of current year of 194IA comes and says, if you are planning to buy a house property, you need to deduct TDS at the rate of 1% on the property at SDV or consideration, whichever is higher. At SDV or consideration, whichever is higher. But amendment of current year comes and says, this is not just per owner, this is also per property. This is also per property. What does it mean, people? If I go to a person and I say, I want to buy your house, I want to buy your house. The house which is bought is actually owned by 3 people. Is owned by 3 people and I am paying him 1 crore. I am paying him 1 crore. Ideally, people, I am not paying him 1 crore, I am paying all 3 people together 1 crore. So which means each person is getting 33 lakhs. In that case, people, will TDS apply? Until last year it was no. From the current year, amendment comes and says it will apply, because now it is not just per owner, it is also per property. It is also per property. So current year amendment comes and says, if there are multiple owners in the property, then the multiple owners' money will be accumulated for checking the limit of 50 lakh rupees. 50 lakh rupees. That is what the provisions come and say. So you can expect a question in exam like this, people, where they can come and say, there is a person from whom you are buying a property, from whom you are buying a property, where there are 2 owners. To owner 1 you paid 40 lakhs, to owner 2 you paid 30 lakhs. Will TDS apply? Answer is yes, because they both are a part of same property. They both are a part of same property and the property value should have exceeded either on SDV or on consideration, whichever is higher. TDS to be done at the rate of 1% on this payments. 1% on this payments. Are you clear? 1% on the total payments. Clear? 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 After IA comes, people, IB, where income tax comes and says, if you are going to have a person who's going to rent a premises from someone, you will normally be under 194I. Under 194I. But because of hijacker rules, or because of the fact that you don't have turnover less than 1 crore in business and 50 lakhs in case of profession, you may not be doing 194I. In that case, you will be liable for 194IB, where if you are an individual or a HUF not liable for 194I, you will come under IB and deduct TDS on your immovable properties at the rate of 5% before September, 2% after October, provided you make a rent payment more than 50,000 rupees per month. Rules are as follows. For this payment, income tax says TDS will not happen every month. TDS will happen only on the last payment of the year. Only on the last payment of the year. Whenever you make the last payment, you will deduct TDS. You will deduct TDS at any appropriate stages. If it so happens, people, that your last payment is not enough for doing TDS. Last payment is not enough for doing TDS. You deduct the whole rent and give it to me. I am enough with that also. I am enough with that also. What does it mean, people? If I come and tell you that I am working in your premises for 1 full year, and I am paying some rent to you. I'm paying some rent to you. In the month of February, I decide to quit and I leave your premises. For the month of February, I am due for a rent of 10,000 rupees. But from April to Feb, because I used your premises, I wanted to do TDS at the rate of 5%. That number came to 30,000. Now, will you pay 30,000 rupees? No, because you only have a rent of, income tax says deposit the 10,000 to me as TDS and I will let you go for the balance. You will not have to pay me the balance TDS of 20,000 rupees because you're making the TDS payment on the last payment. Because of the amendment in the current year, people pay attention to the fact that even though services are for April to September, TDS is still happening in the month of February, and therefore TDS will happen at 2%, will not happen at 5%, because TDS is only accruing on February. So don't come and tell me, Rahul, April to September let's do 5, October to Feb I'll do 2. No, October, whatever payment you have, full payment will be liable for 2%. That is what the rule says. So you consolidate the whole rent you have paid April to Feb, multiply by 2%, whatever is the TDS should be done on February payments. Are you clear? After 194, it's not done based on reverse working. So what will happen is when you deposit the TDS, you will still inform the income appropriately, while the rate number will be lower. While even though you have deposited 10,000 rupees, your income you are going to report is full April to October. So therefore it still doesn't matter because I will still be able to catch you. The problem what will happen is it will happen for the landlord, because landlord now has got lesser credit and therefore he needs to pay advance tax. The intention for TDS is never to collect TDS. The intention for TDS is to always to report incomes. I want to know what your income is. I am not bothered about the TDS because that anyway you will have to pay by advance tax also. Yes. After IB people comes your 194J, the next important section from exam perspective. Section says if you are going to make payment either in the nature of FTS, fees for technical service, FPS, fees for professional service, royalty or non-compete fees, and any kind of director sitting fees, basically directors who are not your employees, you will be liable for a TDS at the rate of 10%, provided each nature of payment exceeds 30,000 rupees. Meaning I should exceed 30,000 for FTS, I should exceed 30,000 for FPS, I should exceed 30,000 for royalty and non-compete, and I don't worry about director's remuneration. Every money is liable for TDS. Meaning people, if I come to you and I give you 28,000 for FTS, 26,000 for FPS, will I do TDS? No, I will not do TDS because nature of payment is not exceeding 30,000 rupees. Here is a case where even though you are my deductor and I am paying more than 30,000, I am not doing TDS because every payment is liable for 30,000 limit. Every nature of payment is liable for 30,000 ka limit in order to do TDS. Yes. Now normally people in the section the rate of TDS is 10%, but for two cases income tax says rate of TDS is only 2%. Case number 1, if you are having fees for technical service. Case number 2, if you are into royalty for cinematographic films, if you are receiving royalty for cinematographic films. And the last is a circular which comes and clarifies you will also do TDS at 2% for a call center service. This is what is 194J payments. Item to be kept in mind here from an exam perspective, people, is that if you receive a payment, 20,000 for FTS, 25,000 for FPS, you will do TDS 0. Because the nature of payment has not exceeded 30,000 limit ka TDS. Yes. After J comes your LA, people, which talks about compulsory acquisition. This is what we discussed, where we said if you are going to have any compulsory acquisition by government, you will be liable for a TDS at the rate of 10%, provided the threshold limit is 2.5 lakh rupees per annum. They are going to pay you more than 2.5 lakh rupees. Please note that this will only happen at the date of payment and not on credit, because you are going to tax this in capital gains only in the year in which the first installment is received. Then comes your 194M payments, people, where income tax says if you are not liable to do TDS under C, under J or under H, contract, professional payment, commission, then you will be liable for TDS under 194M. Basically, people, cases where you will be liable for 194M is case where you have no turnover more than 1 crore or 50 lakhs. Case where you are making personal payments under C and J, these payments will all come under 194M, will come under 194M, and therefore will be liable for TDS at the rate of either 5% before September, 2% from October, provided the threshold limit or the nature of payments which I am making to you exceeds 50 lakh rupees per annum. 50 lakh rupees per annum. This is 194M. This is 194M. After 194M comes 194N, which talks about cash withdrawals. Income tax says if you are going to withdraw money from a bank exceeding 1 crore rupees, then every money you report after 1 crore will be liable for a TDS at the rate of 2%. Will be liable for TDS at the rate of 2%. But if I find out that you have not filed your returns for the last 3 years on time, you have not filed your returns for the last 3 years on time, then I will do TDS at the rate of 2% from 20 lakhs itself. From 20 lakhs itself. So which means 0 to 20 lakhs, no TDS. 20 lakhs to 1 crore, 2%. After 1 crore, 5% will apply. After 1 crore, 5% will apply. But income tax has also come and clarified that if the person withdrawing the money is a cooperative bank, if the money withdrawn is by a cooperative society, then wherever you saw the word 1 crore, the number will become 3 crores. The number will become 3 crores. In simple words, if the cooperative society is filing its returns properly, no TDS up to 3 crores. TDS at the rate of 2% after 3 crores. But if it's a cooperative society not filing its return on time, then first 20 lakhs, no TDS. 20 lakhs to 3 crores, 2%. After 3 crores, 5%. That is what the section says. Please note carefully that whatever TDS is deducted under 194N is not an income. This is merely a credit which will be granted to you later on. So you will treat it as a refund at the subsequent stage. You will treat it as a refund at the subsequent stage. Or if you have other tax payables, you can reduce it against tax payables, but withdrawals will not be deemed as incomes. Will not be deemed as incomes. After N comes your 194P, which says that if you are a resident senior citizen having an age more than 75 years, and you only have two incomes, income number one is your pension income, income number two is interest income, which is coming from the same bank in which you are depositing your pension. Yes, so it should have pension income and you should have interest income from the same bank in which you are depositing your pension. The bank which is handling your account will now be liable to compute your tax and pay the TDS, will be liable to compute your tax and pay the TDS. The moment the bank computes the tax, pays your TDS, it is deemed that you have filed a return, and therefore no more filing of returns, Here is why income tax has come and clarified that the senior citizen will also have to report his declarations, his investments, his exemptions, every other data to the bank, for him to recompute the numbers. But please note that bank will only take this responsibility when you have two incomes, one for pension, one for interest. If you have any other incomes, bank will not take ownership. You will have to do TDS on your own. You will have to pay taxes on your own. Yes or no? Yes or no? After P comes your last section of TDS, which is 194Q, where income tax says if you are going to be purchasing goods more than 50 lakh rupees in a financial year, then to whomever you are making this purchase from, you will have to do TDS at the rate of 0.1% on the number above 50 lakh rupees, where TDS will happen on payment or credit, whichever is earlier. But understand, this TDS will only go when you have a turnover more than 10 crore rupees in the previous year. If you have a turnover less than 10 crores, then you will not be liable to do this TDS. That is what 194Q says about. Last section, people, is 194R, which talks about business benefits and gifts. If you are receiving any business benefits or gifts, then before you receive the gift, you will be liable for a TDS at the rate of 10% for a price exceeding 20,000 rupees. So if you receive a gift more than 20,000 rupees, it is liable for TDS. People, notice, gifts can be either in cash or in kind. It doesn't matter. If it is in kind, then you will take the market value. You will take the market value as your value for the purpose of computing gifts. Your next section of 194T was notified in Finance Act, but has been scrapped by ICI. This is not part of syllabus. You can strike it off. Will not be coming for your exams. Yes, this was an amendment for your Finance Act, but since it was delayed and applicable only from 1st April, ICAI has not notified this for your exams, therefore this is scrapped from syllabus. Yes, couple of things to be kept in mind as you proceed forward in TDS, people, is that if you are going to have a payment including GST, TDS only happens on the amount without GST, but if you are not able to split the GST in the invoice, you will do TDS on the whole number, Second, income tax comes and clarifies that you should not be doing any TDS on government payments, So any payment you make to government will not be liable for TDS, because it doesn't make sense. You withdraw money and you deposit to the same account. You can't do TDS on those. At any appropriate stages, if it so happens that the person to whom you are doing TDS is not having sufficient taxes and therefore would not want so much of TDS to happen, he can submit to you something called as a lower withholding certificate, in which case you will do TDS as per what government approves, for this person alone. That also can happen. And finally, if you don't know to do TDS because the other person is not agreeing to TDS, you can have an option to gross up the number. Meaning if I was supposed to pay him 100 and he is saying I want 100 only, then you will report to income tax that you paid him 111. You report to income tax that you have paid him 111, so that the TDS becomes 11 rupees and therefore you net pay him 100. This is called grossing up. The matter remains the same. The reason why I did it is because he wants full 100 rupees in his hand. That is what the section comes and clarifies. Yes, some things to be kept in mind from an administrative provisions, people. While nothing of this is important, the only thing to be kept in mind is that if you deduct TDS, the TDS has to be deposited by the 7th of next month. But if it is TDS pertaining to March, then you can deposit up to 30th April. That is all you need to know from this page. You can ignore everything else. Yes, you don't need to know anything else. What is then important is your 2-mark MCQ question, which says if you don't do TDS on time, you will be liable for an interest at the rate of 1% per month or part thereof. And if you deduct TDS but you don't deposit to government on time, then you will be liable for interest at the rate of 1.5% per month or part thereof. For 1%, interest will apply from the date of actual liability of deduction to the date of deduction, and 1.5% will apply from the due date of payment to the actual payment. This is one question which I say asks multiple times in MCQ, so therefore pay attention to those. After that, people, the last item of your topic, which is your miscellaneous topic of TCS, which is tax collection at source. Income tax says if you are a person who's going to buy a goods which income tax has found out, then when you make a payment to a person, don't just make him the actual payment, also give him extra TCS. In TDS, what happens, people? I make the payment after removing a number. In TCS, I make a payment increasing the number. The concept is same as GST. When I make him a payment, I give extra payment to him. This is something like GST. Yes, TCS provisions apply the same rules as GST. Income tax says you should do TCS at the time of receiving the payment or debiting the party in your books, whichever is earlier, because now you are looking from the perspective of the person receiving the payment. Yes or no? Yes. Other than that, the same rules will apply, people. If you have not filed your return on time, income tax says TCS will happen at the rate of 2x or 5%, whichever is higher. If you have not given the PAN number also, it is 2x or 5%, whichever is higher. What are the cases where TCS will apply, people? Income tax says if you are planning to buy any of these goods, you will have to make payment exceeding the payment number. What are the items, people? You have alcoholic liquor for 1%, tendu leaves for 5%, timber and forest produce like we did in yesterday's class for 2.5%. You have scrap for 1% and coal for 1%. If you are going to have any kind of parking lot, any kind of leasing for any kind of toll plaza and all, then you will have to do TCS at the rate of 2%. And if you are going to buy any motor vehicles exceeding a value of rupees 10 lakhs per vehicle, the TCS on that motor vehicle will happen at the rate of 1%. the TCS on this motor vehicle will happen at the rate of 1%. Some rules for you to follow. Income tax comes and says TCS will not apply if you can give a declaration saying these products are going to be used for further production. These products are going to be used for further production, meaning if you buy these products as raw materials, then it is not liable for TCS. It is not liable for TCS. Second, TCS will only apply if the person collecting the number has a turnover more than 1 crore in case of business and 50 lakhs in case of profession in the immediately preceding previous year. When it comes to motor vehicles, income tax says TCS will only apply if the car is for personal purposes. If you are a dealer in cars, you will not be liable for TCS. When you sell the car to the ultimate customer, customer will be liable for TCS. That is what TCS rules apply for. Yes, the important thing which I want you to pay attention to for your exam perspective is the next line, which is your foreign payments. Income tax comes and says if you are going to make a payment outside India, then tell me what kind of payments are you making. If you are making the payment outside India for doing an overseas travel, but this is a package model. You're going for a trip. Income tax says for the first 7 lakh rupees you will be liable for a TCS at the rate of 5%, and after 7 lakh rupees you will be liable for a TCS at the rate of 20%. This is for overseas travel package. What do you mean by overseas travel package, people? Income tax says overseas travel package means you have gone and paid someone money, not just for one thing but for multiple things. Like he is arranging my travel also, my accommodation also, my roaming around also, or any other similar natures. For whatever payments you there, people, it should not be just for one payment. It should be at least combination of two. Either you should give me travel or accommodation, travel or roaming around, or stay and roaming around, stay and accommodation, whatever it is. Any two items should be there. Then only it's called a package. If you simply make a payment for travel alone, it is not liable for TCS from this rules. If you make a payment outside India for any other reason, income tax says for the first 7 lakhs no TCS. After 7 lakh rupees, I will start asking you, why are you making the payment? If you tell me that you're making the payment outside India by taking a loan for the purpose of foreign education, we discussed it somewhere, section 80E. Income tax says before you make the payment outside India, collect a TCS at the rate of 0.5%. If you say no, I am actually making payment outside India for education, but not through loan, but from my own money, then it is TCS at the rate of 5%. If you say you are making payment outside India for medical reasons, then it is again 5%. But if you do it for any other reasons, then it is liable for 20%. Some of the classic questions which ICAI has asked in the past, they say that I am transferring money from India to my sister living in Dubai. You will say for the first 7 lakhs, no TCS. After 7 lakhs, it becomes 20% because where is it said that the sister is receiving it for education purposes? You are sending money to your sister which is not covered in education or medical reasons. It is liable for 20% TCS. That is what the rule says. Clear? For this payments, people, income tax is clarified. TCS will not apply if you make the payments through credit cards. If you're making payments through card and all, then it is not liable for TCS. You should make cash, rokda, hard cash. I want hard cash as payments. Finally, the last item, people, which is your 206C1H, which comes and says if you are not doing 194Q purchase of goods, if you're not doing purchase of goods, but you are the seller of goods, if the purchaser of good is not doing TDS on you, you will be liable to do TCS. At the rate of 0.1% on an amount exceeding 50 lakh rupees. But TCS on 206(1)H only applies on payment basis. It does not apply on credit basis. Notice Q applies on credit or payment, whichever is earlier. TCS applies only on payment basis. Here also the rule is the same. I will only do TCS if my turnover exceeds 10 crores, which means if the purchaser's turnover exceeds 10 crores, he will do TDS. If the seller's turnover exceeds 10 crores, he will do TCS. If both of them are increasing turnover of 10 crores, TDS will do. TCS will not apply. Understand, for the same transaction, two things cannot happen, which means TDS will apply. In simple words, TDS is superior than TCS, but both the sections come and clarify that I will not do TDS or TCS if the goods are covered somewhere else, or if the services are covered somewhere else, meaning they are inferior to other sections. So order of priority, do other sections. If other sections are not there, do TDS. If TDS is also not there, do TCS. If TCS is also not there, sleep at home. Nothing is required. Nothing is required. Yes or no? Yes. Amendment of current year for TCS also is the same people. Income tax comes and says whatever issues you had in TCS, the same issues you will have in TDS. Meaning if you don't collect your TCS on time, you will be liable for interest at the rate of 1%. And if you don't pay your TCS on time, you will be liable for an interest at the rate of 1.5%. Yes. The one thing which I wanted to clarify to you people, because it is being tested in ICA exams multiple times, ICA is coming and saying when it comes to your foreign payments, if the question mentions that I am having two bankers, technically 7 lakh applies per bank. Technically 7 lakh applies per bank, which means from this bank I can do up to 7 lakhs no TCS, and from this bank I can do up to 7 lakhs no TCS. But if the ICA exam question comes and says the first bank is aware about the second bank's payments, the first bank is aware about 7 banks payment, then in that case you will check 7 lakhs together. Meaning if you have made 3 lakhs from bank A and 5 lakhs from bank B will come and say I know you have done 3 lakhs from bank A, so I will take only 4 lakhs here for no TCS, balance 1 lakh I will do TCS. Normally whole TDS and TCS happens deduct R, deduct T specific, but for foreign payments alone they have come and clarified if the other bank knows, then they will cumulatively do it. This is something which ICA is doing more, and therefore you should pay attention to that. Clear? Everyone, are we good to go? Yes, great. This is your chapter on TDS and TCS. Alright, last topic to complete your marathon people. We are looking at what is called as return filing provisions. Yes, your 4-mark question from your exam perspective. A simple, sweet, beautiful chapter of your question number 4, part number B. We are talking about what is return filing. Yes, some rules to follow when it comes to return filing people. First of all, who should file a return? Income tax comes and clarifies when it comes to filing returns, any company and any firm is liable to mandatory file a return. Anyone else has to file a return if their gross total income, meaning total income ignoring chapter 6A, ignoring any kind of capital gain exemptions, 54 exemptions, are exceeding your basic exemption limit of either 2.5 lakhs, 3 lakhs or 5 lakhs under alternate regime, or 3 lakhs under default tax regime. Yes, so income tax says companies and firms mandatory return filing. Any other person will have to file a return if their GTI exceeding capital gain exemption is more than basic exemption limit. But ignoring this people, income tax has also come and told you that if you have other items where transactionally if you are doing a lot of business, then in that case I will also ask you to file a return. Cases like depositing more than 1 crore in current accounts, more than 50 lakhs in savings account, doing any kind of foreign travel exceeding 2 lakh rupees, any kind of electricity expenses paid more than 1 lakh rupee, having a sales from a business more than 60 lakh rupees, gross receipts from profession more than 10 lakh rupees, any kind of TDS and TCS showing in your 26 years more than 50,000 rupees for resident seniors and 25,000 rupees in case of others. And finally, if I find out that you are an ROR having any assets outside India or maintaining any bank account outside India, then you are mandatorily required to file a return. Either you are the owner of this or you are beneficiary of this, as the case may be. These are the cases you need to file a return. If your question is coming from exam part number 4B, 99% will be this question. Who should file a return? They'll give you an instance and they'll ask you, should you file a return in this scenarios? Yes, 2 options will be given, one based on income, one based on transaction. So based on income it will be no, and based on transaction it may end up becoming yes, or vice versa, as the case may be. Yes, so pay attention to this one question from your exam perspective. Rule number 2 people, income tax comes and says, if you are into composite business meaning having agriculture, having normal business, in that case income tax comes and clarifies you will only have to file a return if your business income is more than basic exemption limit. Don't take into consideration your agriculture income because that is exempt from taxes. Then comes the question as to when should you file a return. Income tax says you should mandatorily file a return by 31st October if you are liable for any audit, and 31st July if you are not liable for any audit or you are opting for presumptive taxation. At any point of time, if you're a partner in a firm which is liable for audit, then the partner will also be liable for 31st October. Partner will also be liable for 31st October. In simple words, people, the provision comes and says 31st October for everyone liable for audit, and a partner in a firm which is liable for audit. Everyone else will do 31st July, which means salaried people and presumptive people. Salary people and presumptive people. If you have not filed your original return on time, income tax says no worries, you can file a belated return on or before 31st December of your assessment year. On or before 31st December of your assessment year. But like we discussed earlier, people, if you don't file your returns on time, you will have some issues. Issue number 1, you cannot carry forward any losses. Issue number 2, you cannot claim heading C of chapter 6A, JJA, QQB and RRB. Issue number 3, you can't claim 10AA as a deduction. Issue number 4, you will be mandatory forced to go for DTR. Issue number 5, you will be levied a late filing fees of rupees 5,000 rupees, but late filing fee will come down to 1,000 rupees if your gross total income is up to 5 lakh rupees. Gross total income is up to 5 lakh rupees. And finally, you will be levied an interest under section 234A on whatever number is pending on the due date of return filing. On whatever number is pending on due date of return filing, which means you'll take your total tax, reduce TDS, reduce advance tax, also reduce self-assessment tax which you have paid up to return filing due date. On that date, whatever is pending, on that you will do interest at the rate of 1% per month or part thereof from the next day of return filing. From the next day of return filing up to you file your return, until the date on which you file your return. This is what will happen. At any appropriate stages, if you have filed a return already, people, and you feel that there are mistakes in the return, you can always file a revised return up to 31st December of assessment year. Income tax comes and clarifies, when you file a revised return, it will take the characteristics of the main return. It will take the characteristics of the main return, which means, can you file a revised return for original return? Yes. Can you file a revised return for belated return? Yes. You can also file a revised return for belated return. Can you file a revised return for a revised return? Yes, you can do that also, because revised return, the moment you file, it became original return, and therefore revision of revision is also revision of original, and therefore it is permitted. In simple words, you can file revised return any number of times until 31st December. Until 31st December. This is what the rule says. At any appropriate stage, if you file a return and the return has some errors, department will issue something called as defective notice, and will give you time for up to 15 days to respond on the same. If you respond within 15 days of receiving the notice, department will consider the return as it is. If you don't file the return within if you don't file the response within 15 days, income tax will assume the return is defective and will treat the return as invalid, which means it will be assumed that no return was filed at any day. No return was filed on any day. Yes, if you are planning to file returns, people, who will file the return? For an individual, it will be filed by himself. If he is not available, any person who has the power of attorney can file it for him. If the return filing person is a minor, return will be filed by parents or guardian. If the person is of unsound mind, return will be filed by guardians. If the return is of HUF, return will be filed by Karta. Karta is not available. Any non-minor members will file the returns. If it is a company, managing director is not available. Any other director. If it is a firm, managing partner, if managing partner is not available. Any non-minor partner. If it is an LLP, designated partner is not available. Any other partner. LLP cannot have minors. That is what the rule is. Yes, this is what the rules are. At some point of time, people, it was also clarified that if you want to file a return, you need to ensure that you file a return even if it is a loss, because if you don't file a return for loss, you cannot carry forward the losses. However, you can still carry forward two kinds of losses. One is HP, one is unabsorbed depreciation, but you can only carry forward HP loss if you opt for ATR, or you have at least filed the form for ATR. Otherwise, if you go for DTR, that return will also lapse. After that comes your other provision, people, which is called updated return provisions. Updated return basically comes and says that if you have filed a return earlier or not filed a return also, return also. Income tax will permit you to file an updated return for the next 2 years from the end of the assessment year, to report more income than what you have earlier reported, which means updated return is only for the purpose of paying tax. You cannot file an updated return when it is resulting in refunds or lower losses. Income tax says updated return can only be filed when the loss converts to income or the existing income increases. If the income is decreasing, updated return cannot be filed. If the loss remains a loss, updated return cannot be filed. If you have already claimed a refund and want more refund, updated return cannot be filed. You can only file an updated return when you have extra tax payable. Income tax has 2 rules on this. Rule number 1, income tax says if you file an updated return, you cannot revise updated return. Updated return can only be filed once. Rule number 2, income tax is coming and saying when it comes to updated return, you can only file an updated return if department has not picked you up for any scrutiny. If department has picked you for scrutiny, then no updated return. Department will do assessment and put penalties. If you want to file an updated return, people, income tax will say if you file the return within 1 year, from the end of the assessment year, whatever tax payable accrues to you, you will have to pay 125% of it as tax final payment. And if you are filing the return after 1 year but before 2 years, you will have to pay 150% of the additional tax payable. Notice carefully that the extra 25 and 50 I am paying is not on the full tax, I am paying on the extra tax, which means if you have already filed a return earlier and now you are filing an extra return, the difference of that 2 is what you will pay additional tax. On that you will pay 25% in year 1 and 50% in year 2. That is what the rule comes and clarifies. Yes or no? How to compute additional tax and all, people, is not relevant for exams. ICI will tell you that. You don't need to worry about it. Yes, after updated return comes your smaller topics, people. One is called as TRP. Where income tax says if you don't know how to prepare your own return, you can seek support from a person called TRP, tax return preparers. TRPs can only be those kind of people who are CA inter qualified, BCom qualified, or any kind of persons who are holding a bachelor's degree. But you will not be permitted to be a TRP if you are either an employee of the company, if you are a officer of the bank in which the person has an account, or you are a CA qualified. Also, income tax comes and clarifies if the original return was filed by the individual on his own, revised return cannot be filed by the TRP. Second, if the person is liable for audit, then TRP cannot help you on this. Return will have to be filed by himself, meaning TRP can only file returns when you are not liable for audits. Either way, if TRP is not doing the original return, he cannot file your revised returns. That is what the rule says. Finally, people, we have discussed about 234A and 234F. Last topic which comes and says what happens in case of PAN cards. Income tax says, do you have to get a PAN card in India? Not mandatory, but you will have to get a PAN card in India if your total income exceeds basic exemption limit. Or if you satisfy any of the following conditions, which is having a person with a total sales gross receipts more than 5 lakh rupees, resident person entering into a transaction more than 2,50,000 during the year, any kind of MD of these persons, or if you are in a person who's depositing cash more than 20 lakh rupees at any time during the previous year in any financial year for any accounts. Please get a PAN card, because income tax is saying I am now going to start asking you to quote your PAN card in certain places. There is a huge list given to you, people, almost about 18 line items where you need to quote your PAN numbers. This comes in exam once in every 5 years. Not very important. Take a chance. It's okay to let go. These are the cases where you have to get a PAN card. But then comes the last item, people. What happens if you don't quote your PAN number, or you quote a wrong PAN number? Income tax will levy a penalty at the rate of 10,000 rupees for every default you make. And finally, income tax has come and clarified last year that you have to ensure that your Aadhaar and PAN is linked. Failure to link your Aadhaar and PAN will make the PAN inoperative. Which means it will be assumed that the PAN is not there. Because the PAN is not there, people, all provisions will apply accordingly. Meaning, no having a PAN means you will not get refund. You will not get any interest on refund. TDS will happen at a higher rate of 20%. TCS will happen at a higher rate of 2x or 5, whichever is higher. higher, and because you are quoting this PAN number to other people, you can be levied a penalty at the price of 10,000 rupees. If you want to ensure that your PAN becomes operative, please pay a late filing fees of 1,000 rupees, and within 30 days the department will link your PAN with Aadhaar. At any point of time, Aadhaar number is not required in case you are a non-resident, not a citizen of India, residing in Jammu and Kashmir, Assam, or if you are a person aged 80 years and more. This is what will happen if you have an Aadhaar and a PAN linking. The final thing income tax has come and clarified is that if you have an Aadhaar card, if you have a PAN card, you don't need to quote both in both the places, since it's already linked. Even if you quote Aadhaar number in case of PAN, it is still valid. They don't need to get your PAN number mandatory because your Aadhaar is linked with your PAN card. Clear? Yes. Sweet.